We're very close to the Russia-Ukraine conflict with our Kazakhstan business. We also are the primary supplier of natural gas in Israel and have offshore platforms that have been shut down during the conflict in the Middle East. We've had ships that have been attacked by the Iranian Navy within the last few months in the Straits of Hormuz. We've got ships that transit through the Red Sea that we work very closely with the U.S. Navy and other military forces to ensure safe passage of those vessels. The reality of doing business around the world in our industry is we face these kinds of risks.
At Chevron's Mike Wirth last night on Last Call talking about the geopolitical risks facing oil and gas producers, including Houthi rebel attacks on ships in the Red Sea. Numbers from one cargo booking platform highlight the impact. Spot container rates for shipping goods from Asia to Northern Europe now have soared 173% since mid-December. Meantime, the IMF says Suez traffic is down 28% in the last 10 days. You got Maersk, Jim, now, as we said earlier, going back to diversions. This is starting to show up. IKEA, A&F, talking about delays.
I mean, I thought that, Mike Wirth's view is he's gospel, and it's obvious that this market's in incredible turmoil. We had those EOG comments. I want to go back to them for a second. Good company saying there's going to be a decline in growth. Remember, it's not a decline in growth in the U.S. I don't believe that, but I think that EOG is too conservative. But through all this, why isn't oil at 80? I mean, the market seems to be taking this stuff in stride for the moment. Right. It's really interesting. Like, Mike Wirth is basically talking about almost everything being a suspect, and yet they're still producing.
As far as container rates, Journal, a great piece today about how some of the shippers, their stocks are doing well because of these surcharges.
Right.
But you got so much capacity coming online this year, 11% of the current fleet. It's going to offset some of that.
Well, that's why I was going back and forth yesterday with Herbjorn Hansen for Nordic American Tanker. That should be the big winner. The stock's at 4. It's been at 4. I mean, it's not doing anything. And I was saying, look, Herbjorn, I know that you're supposed to be the way to play this, but it's not moving. He's obviously just saying, just wait. He talks as his book. I don't have a book. But again, no one's making any money off this stuff. It's just, we're just watching the geopolitical tension. Typically, geopolitical tension should mean something. But this is not 1973. It's 2024.
Right. We do have Blinken going back to the Middle East, his 4th trip there since the October 7th attacks. Then you have sort of the larger, almost rhetorical battle against American companies, which is what McDonald's talked about yesterday.
Right, and I think we have to remember that as franchises, I'll tell you, it's so difficult. My Chapel Trust owns Starbucks, and Starbucks doesn't have any stores in Israel, but is viewed as, there was a TikTok post that basically implied that you're buying. I don't even want to dignify what the TikTok post. It's just, you're buying from someone who's the strident, militant Palestinian faction doesn't want to buy from, and it was not true. And so therefore, I don't want to dignify it. But what does matter is that some of the stores had bad numbers, and now people hear what I just said and they'll say, "Oh my God, that's all we care about." But as you said, the tape never stops. I'm not here to opine on what should happen. I'm here to opine on what did happen and the impact on the quarter, and it could be significant.
Yeah. Here's what Chris Kamchinsky said. Associated misinformation affecting brands like McDonald's, disheartening and ill-founded. Separately, I mean, Oppie does cut McDonald's today to market perform. That's largely about they think comps are going to be in line this year. Pricing benefits start to fade.
I find that when you to understand a stock like McDonald's, you just have to look at the chart. And you can see that the chart says, well, that's an unbelievable move. And that's a reverse, it's reverse head and shoulders. So ultimately it's going to be okay. But right now, like a lot of companies did really well, they're saying, listen, the valuation's peaking. I say you sell that stock at your own risk. That's just a really great company. And when it rolls over, you buy it. And that's what you do. And look, if you really want to avoid all that, just go buy Chipotle, because that stock, Chipotle and Lululemon want to combine. And it's like, hey, we're unassailable. You can't sell us. We're like, great, Chipotle Lulu. Because those are two growth stocks that people just simply say buy. And I feel the same way about McDonald's, but it's obviously these are Chipotle's. I read the other day, I looked at Dylan Reebok, who works with me, showed me all the different grades that all the Chipotles have in the city, they're all A's.
Oh, you mean-
I mean, everyone, I think, close the store if it's not an A. By the way, don't look at Cava because you might want to sell Cava.
Really?
Yeah.
Interesting.
Don't look at Cava. You'll say, wow, bad numbers.
We'll cover some more restaurants. There are a bunch of calls in the space this morning, including Yum and QSR.
Yeah, someone downgraded Yum. What is it? Oh, we also had an upgrade. We have face-off Yum.
Yes. We'll get Kramer's Mad Dash countdown to the opening bell. Busy Friday in light of the jobs number. More Squawk on the Street in a minute.
The NBC.
Take a look at a 1 month of the 10-year. You might remember a couple of weeks ago, got down to 379, let's say, on a close. We got to 410 this morning. That's the best since December 13th, but now backing off to Jim's point as people take a closer look at the internals of this jobs number. We'll get the opening bell in about 5 minutes. And don't forget, you can catch us anytime, anywhere. Just listen to and follow the Squawk on the Street Opening Bell podcast. let's get Kramer's Mad Dash. Countdown to the opening bell.
Okay, so Constellation Brands reported today, STZ. They're going to be on tonight. It's a tale of two cities. Beer is just incredible. I cannot believe how strong beer is. Their particular beers are doing amazing, much better than we have actually at Bud today. But if you want to kill it, you want to buy Modelo and Modelo Especial. However, people are just wine and spirits not going there. I continue to believe that the most challenged category in this year of 2024 will be the browns and the clears of hard liquor. People don't want a gin, they don't want vodka, they don't want whiskey, and people have to start understanding that bourbon sales are going to be down, and also they've got some good wines, but it's a tale too. They're going to have to get rid of spirits. I'm going to propose that to Bill Newlands tonight.
You want them to spin off or sell the beer?
Whoever can buy it. You know, but by the way, Elliott Partners is in there, and I'm sure that they feel the same way. I think Bill Newlands feels that way. I just don't know if there's a buyer. The man who ran that division kind of mysteriously left, and Bill took it over yesterday. But it is incredible. This has nothing to do with them. This is, by the way, it's only going to get worse with GLP because the taste of whiskey is uniquely like water, they tell me. But
if you're on GLPs.
Yeah, it's like whiskey, water. Wow,
remember years ago when the Fortune cover was, "Are we in a bourbon bubble?"
Oh my!
You're saying it's the opposite of that?
Yeah, and they're companies, they're actual banks that got caught with barrel futures. They're like too long barrels. But there is, I think people are under. Plus, the Chinese are not buying the very expensive.
Oh yes.
Forget it. I mean, don't.
Well, you and I talked the other day about the potential impact of cannabis on alcohol sales.
Is killing it.
And now the rumors this week of all this DEA rescheduling. Right?
Yeah, no, I mean, now, of course, Constellation Brands owns Big Check and Canopy. Do not buy Canopy. There's nothing there. I think there's nothing there. I mean, there's Tilray, but I don't want to recommend anything having to do with cannabis other than to say that cannabis is really hurting the browns and the clears. Really hurting.
We'll watch that. We'll just get the opening bell here in the CNBC Real-Time Exchange. Speaking of beer, at the big board today, it's the professional bull riders and Anheuser celebrating the partnership of the sports competition at MSG this weekend at the NASDAQ. It's XBP Europe, a payments technology company celebrating recent listing via SPAC.
What a pincer movement by Bud, this professional bull riders. That's PBR, my favorite brand. You know, get a PBR at the River Carrillo.
But I assume you mentioned the Modelo. That's the swing factor in this beer guidance.
Look at this. We're talking about 11. We're talking about numbers for the beer. Beer is not being affected. Modelo Especial grew 12%. Beer is not being affected by GLP. Their beers are doing great, which is why you would think the stock, if they missed on the earnings per share, would be down 10%. But no, because beer's great, and if they do, we'll talk to Bill about it, find some buyer for their mid-lane. Actually, by the way, they have Casa Noble, which is a really fabulous tequila, and that's doing well. They should keep that. The tequila growth is 11%. The mezcal growth is 22% in the category. But forget it when it comes to wine is really slowing. But hard liquor. They're High West, which is a very good brand.
Oh, delicious, yeah.
Yeah.
Jim, we managed to open basically higher on the S&P, not by much.
Everyone's kind of fed up with. Look, I'm calling it early, 9:31. There's like been cross currents. You know, we had a decline 2 days ago in the last 8 minutes. Like, wow, what happened? There's just sellers, I think, who just have been waiting and waiting and waiting. And any lift, they want to sell the Mag 7. And I just say, look, guys, things don't go down a straight line. This is a bad week. There's a lot of people who are short those probably, and they can bounce. Remember my cufflinks, NVIDIA, that's the good luck. We used to do that when on the trading desk, put rally caps on and do all this silly stuff. Kind of like when I wore my same green shirt every day to the Eagles, and we went to the Super Bowl, and I told Tammy Reed that the reason we did was because of my green shirt. And she goes, well, you don't think Andy Reid had anything to do with it? So, all right, maybe so. It's like there's a lot of superstition on the trading desk. But I do think that what's happening is that stocks just don't go straight down. They just don't go straight down. I mean, Apple every day. I mean, Loop Capital's a little late to the game of the negativity, given the fact that the Morgan Stanley call is a very powerful call on the App Store, which everyone has dumped on the App Store, and it versus the Foxconn, which is a negative story. So, look, accept the fact that stocks don't go straight down. Yeah. That's all I'm saying.
There's some impressive action in some semis. AMD is the second biggest S&P-er.
I pushed AMD pretty hard last night because I think AMD really surprised people with the forecast. And Remember I did this PC refresh thing with the Microsoft button?
Yes.
It was so clear that everyone had me on mute. They're like, oh, mute him. He says PC refresh. But I think there will be a PC refresh.
We'll watch for some of the impact on some of those names.
How about Costco?
Yeah, I was going to say Costco, December comps, not just the comp, Jim, but discretionary non-food with a nice 4% print.
Wasn't that something? Rich Galanti, who's the CFO, who's just remarkable, has a little quote about gold today. I bought my gold. I bought my gold from Costco.
At Costco?
Yeah, well, like, they finally came up. You finally could get some yesterday online. Of course, like, you shouldn't say, I mean, but they sold $100 million in gold. You can buy it. There was an article in the journal about why do it. Well, how about the fact that there's no premium if you're, like, I'm an executive card member, okay? And I have the Visa. And I don't understand why everyone doesn't. I mean, if Carrefour banning Pepsi, well, why don't you go to Costco and you see real prices? And Costco is real price for everything.
Do you think, to help viewers understand, and yesterday we talked about AXP being a shelter from the worst of the household balance sheet situation. Is that the same thing rhymes with Costco?
I think so. I mean,
higher income shopper?
Costco's always legendary by count the Beamers and count the Mercedes and the lots.
Membership fees.
Yeah, but it is this, it's an amazing bargain. Remember, they make it, they're doing a special dividend, but the way they make their money is off the card. They want volume. And I think people keep misunderstanding. They want you to go there and beat them, so to speak. I remember when Jim Sinegal, I came in and I talked to Jim Sinegal when he opened the store in Harlem, and he said, listen, you probably want to go, and we've got some Zegna stuff over there. And I said, I'm wearing Zegna. He goes, we had that thing for so much less. You like, ridiculous. I went over, I bought some Costco ties. I wore them for weeks. Mary Duffy, who's our major domo, didn't even know I was wearing a Costco tie.
Senegal was one of the best.
Oh, my God, Craig Jelinek. Now I got a new guy. I got to tell you that there is something to be said for if you want to look at Costco, you get the economy, sundries, food, and cooler were the strongest departments. Fresh foods were up high single digit. Better performing departments include bakery and produce. Well, isn't that where we're really being hurt? At the supermarket. You want revenge, they have lower prices. I think people should just stop complaining, go to Costco.
Right.
Okay? Just stop complaining, go to Costco.
To tie it back to the jobs number today, where you got wages up 4.1, inflation's 3.1.
Right.
So you're in a bit of a sweet spot on the consumer right now.
Thank you. Yes. And that's why I say I don't want to get negative, because these are the numbers I want, a really good economy without that much inflation. Jay Powell's done a great job, and I think that it's not perfect for the stock market, but if you're worried about a recession, that's a mistake.
Yeah. The tape right now would definitely back that up, given the fact that Delta, Carnival on an upgrade today over in Wells.
Wasn't that interesting? Although it was a shuffle because Norwegian Cruise downgraded, and I thought that was just gratuitous. They're doing well. Royal's doing the best, by the way, if people want to play that group. But I know that travel is still back. It's still still works, and that's Boeing and GE. Take a longer-term view.
Boeing, once again, top pick at Wells. You know what the names? I watch the top picks all week.
Yeah.
Boeing gets a bunch, NVIDIA, and Nike gets a ton. Yeah. Again today out of UBS.
What's crazy is you don't even have to be doing well. Right? Isn't that terrific? Nike's not doing well. They get it. Look, if you want one of the ones that is, I think, undervalued, that people are realizing is good and it's not up today, you got to focus on Domino's. Because, Russell Weiner's got that thing humming again. And that is, I think, if you want to be in that that restaurant story, it's that one. By the way, it's a great bargain.
Well, I was going to say, because we got yet another cut of pizza today.
I know, they're really knocking that one.
And we talked about another one yesterday, is the Papa John's Domino's share shift. You think that's going on? Hard to say.
Yeah, I think it is. Papa John's only has 6 ingredients. I like their pizza too, but I'm a total Domino's guy. I mean, by the way, Domino's, Russell has reinstituted getting more and more technology again. You kind of want to do that. But I just like the way his attitude. He's really starting to get the franchisees moving. That's who drives that one. So I like that. That's my favorite of the group.
Netflix, interesting piece in the Journal this morning about gaming, looking for ways to make money in what they're calling a possible pivot, in-game purchases, ads, charging extra for games.
Why not? Did you see the number of downloads? It was like 4 times what it was the year before. I think that they're absolutely right to do it. It's a very forward-looking company. And I think that they've got, by this time next year, they're going to certainly worth monetizing.
Right.
Look, nothing's changed. You go to, people say you're over, we have too many streamings. If that's the case, why is Netflix doing so well?
Right. Although
by the way, Apple Plus.
I feel like we haven't tended the garden much on media this week, given how much conversation there was about Paramount, about Peltz and Disney earlier.
Well, you ever write about that?
Yeah?
I mean, what happened to that stuff? Disney apparently another couple of bad movies. I mean, Disney is. I think Nelson Peltz gets ammo every day. I think Ike Perlmutter, who built Marvel, has to be unhappy, given the fact he's a huge shareholder, and the stock does nothing. That is not going to endear. I know that they have new people, and I respect the new people, but I do think that when you have a stock with a total shareholder return that is so bad, it does invite people who want to get on the board and who have shaken up other companies, and it tends to work. I know that's very contrary to what people think.
Yeah. Software, a couple of moves. Jeffries, I'm sorry, no, it's Snow. No. RBC, Initiate, outperformed 230. And then this downgraded Palantir over at Jeffries. They go to underperform, down to 13.
I know. Last quarter wasn't bad. But that was their only negative. They just love all that high multiple stuff. Oh, my God. They love Monday.com, HubSpot. I finally saw an ad for HubSpot. Bill.com. It's incredibly expensive. They want those enterprise software stocks. They never stop. ServiceNow, 650 goes to 775. A must-own for a growth stock. I happen to like ServiceNow, but let's just understand each other. These are the stocks that get sold when interest rates go higher. They get sold until they report their quarters, and they're good, because that's what... people want to buy Ingersoll Rand. They want tool and die. It's okay.
Right. EMR.
Yeah. I don't really like EMR, but they like it right now. They, meaning the institutional money managers who want to be in stuff. Like, I happen to like the stock of Honeywell. They made a really good acquisition from Carrier. I happen to like Carrier. They made a really good sale to Honeywell. I mean, these companies can do no wrong, and their multiples aren't that high versus Bill.com. I mean, come on. Monday.com. They're expensive. I saw another positive comment about Salesforce. I've owned Salesforce for my Chapel Trust since my Chapel started. I'm not pounding the table 30 times earnings. I'm not. And, Benioff, I'm probably just hoping to see him next week, but I don't know. He's not around. But look at Micron. They upgraded Micron. There were several positive pieces about Micron, and all that happens at the end of the day is down.
Yeah. One of the laggards today. Speaking of quarters, a week from today, we're going to start getting the banks. We'll talk about credit quality and funding costs and deposit flows. We always talk about going into the quarter hot or cold.
JP Morgan looks like Nvidia after the May quarter. I mean, look at JP Morgan. I mean, that is not, now it still sells only at 10 times earnings. But what pressure? Now, of course, they'll say, Jim, we're under no pressure at all other than from you, so why don't you stop? Right. No. How's their show doing? What time is the JP Morgan show on? Is Jamie, he's on the 10? No. I mean, I get to talk, he doesn't. It's Jamie Dimon, he's the CEO. He does a really good job. But that chart is the stock of a red-hot semi meets AI. No. It's a bank.
You're not saying it's overdone, are you?
No, I'm just saying, I wish it weren't coming in so hot. I mean, every number, every line item is going to be scrutinized. And that's, by the way, Charlie Scharf had a really great quarter. That's Wells Fargo. And the stock's been good, but, the stock is still down substantially from where it was in 2018. I prefer that. Way down from 2018.
Sort of in that space, in the fintech-y space. Yet another downgrade today for PayPal as BTIG joins the chorus, going to neutral.
Oh, my God, that was such a negative piece. 10 times earnings, and yet they see no reason to buy it. I invited Alex Chris on the show last night. He's the new CEO. Because Ben Stoddard and I were saying, listen, you can't slam it again. Just invite the guy on to tell the story. Chris, Alex, we're on at 6 p.m. Just trying to give him a
your evening program.
Giving him an invite.
Yes.
And it's not an invite to his funeral. It's an invite to tell the story.
Right. Sort of like you had with Lisa Gill last night.
Look, I think Lisa's amazing. And one of the things that I think when CVS was at 50, she was saying, listen, load up the boat. That was a great call. And she is so enamored of Walgreens here. Walgreens. Because she believed, when you get the stock at 23, that Tim Wentworth, as I do, CEO, is an amazing money manager, amazing money maker for money managers. So watch Walgreens. And there's so much about what's going on in so many different areas. Healthcare is probably the most in flux I have ever seen it. And so many companies need to buy so many other companies. But watch Walgreens, because this guy is a miracle worker, and I'm setting the standard a little high for him now.
If you missed Lisa Gill at JP Morgan with Jim last night, sort of raising the curtain on the healthcare conference next week. Take a listen.
One of the things to think about when you think about pharmacy, it's the highest touch point of anything in healthcare. It's been proven time and time again that if you can keep a patient adherent on the medication, and think about GLP-1s, right? It's all the rage right now.
Topical.
Yes. Hey, by the way, there was a lot of misinformation about the Lilly call yesterday, and one of the reasons why the stock was up 9 and finished down. All they were saying was, look, we're going to use traditional places, touch places to get GLP-1, but don't use counterfeit, and don't use this if you're just trying to get thin. We don't discourage it. Now, you have a lot of stocks coming in very hot there. Regeneron is at an all-time high, Amgen at an all-time high, but those stocks turned out to be very inexpensive. Merck was very in 14 times earnings. So these were companies that I really like, because they do not trade at the multiples of enterprise software, which are insane.
Jim, interesting to see, on a morning where the thinking was, oh, we got to rethink rates. Names like Pulte are up 1% or better.
Look, I think that you posted a very good point on X.
From Fitch?
Yes. Yeah. It's not a hot number, which means that housing will continue to be good. They're not building as many homes as they did before. The raw costs are down. They're making a lot of money. Toll Brothers bought, I have like Toll Best here. Toll Brothers bought a huge amount of stock. I mean, this is not your grandfather's home builders where they'd be putting them up like mad and they have no buyers, or even the 2008 period when I literally went out to the Imperial Valley to see if I shouldn't just buy land and become a home builder, which of course I should have. Instead, I watched my daughter play field hockey.
I was surprised. Goldman put out a forecast for the mortgage rate, the 30-year fixed, and ending the year still with a 6. I mean, a low 6. But it's not like that's going to collapse in their view.
Remember, the mortgage rates are going to stay there, and the price of housing is going to go down a little. Don't look at Manhattan. That is a separate area. You're going to be able to... I think you're going to be able to do well because I think there's going to be a glut of apartments that were all started at the same time. Now, I know I say ignore Manhattan, but anybody who wants to see Venice, the Gowanus. The Gowanus, the number of apartments that are being built along the Gowanus, you would think it's the Riviera.
Really?
You really would. I mean, thousands of apartments are coming out. They all start at the same time. And I know that's anecdotal, but believe me, if they're building them around the Gowanus, which, by the way, sometimes is blue, sometimes is green. It's like the river in the movie The Fugitive on St. Patrick's Day. I mean, sometimes it's bubbling. Sequence. I'm always afraid someone's going to be smoking a cigarette while I walk over the bridge.
Yeah, well, the new supply online is definitely a story in the Southeast.
Stay close to that story. People are not talking about the number of apartments that were started after COVID that are now coming on. And they don't talk about it because a lot of them are these private developers. But there's going to be a glut of rent, and therefore there will not be that wonder of where you can stay in your rental or get a rental and be very inexpensive. That drives home prices down.
We're going to watch shelter, especially given CPI on the way next week.
Absolutely. And I know that Jay Powell's not happy that housing prices are up 35% from 2019, but he can't be happy about the grapefruits doubling. There's some things that don't have anything to do with the Fed funds rate. Right. You Planters peanuts.
Yeah, can't change the weather.
No. You can't. Thank you.
Quick reminder, you can always get in on the CNBC Investing Club with Jim. You can sign up and find out more at cnbc.com/join the club, or just use the QR code on your screen if it gets out of the way from the tape there, and it takes you right there. As we go to break, watch bonds. We are going to get a little Fed speak today, Barkin at 1:30 p.m. Eastern Time. For the time being, though, watch the 10-year, S&P holding 4,700, Dow's marginally positive. Don't go anywhere.
At 10 a.m. Eastern Time, we get US ISM data. Services PMI forecast 52.5 on the prior 52.7, with a range of 54 to 50.7. Services employment forecast 51 on the prior 50.7. Services new orders forecast 56.1 on the prior 55.5. Services prices paid forecast 57.3 on the prior 58.3. And US factory orders month on month forecast 2.4% on the prior minus 3.6%, with a range of 5.4% to 0.8%. Durable goods revised forecast 5.4% on the prior 5.4%. Core durable
Take a look at some S&P laggards for the week to date. Jim mentioned this call out of Wells today where they do upgrade Carnival, but cut Norwegian, saying they prefer CCL's deleveraging path, valuation, their EBITDA growth upside risk. We'll watch that. Enphase as well. VF Corp, kind of a mixed bag with semis in the mix as well. We'll get stop trading with Jim in a minute, and the Dow up 31 points.
Protect your trades from macro headline risk with Financial Juice Pro. Now only $99 a year for our real-time service.
Biden says strong job creation as inflation falls to 2%.
Lodge.com.
Let's get to Jim and stop trading.
Now, I did make a joke earlier about a stock called How I Met Your Mother, How Met. But here's 4 recommendations for it. Now, what people don't know is that this is a $21 billion company that used to be the fastening business of Alcoa. And 4 recommendations, the most recommended stock so far this year that I've found.
Really?
Yes, and it is a very good company. It does forgings for aerospace, and GE's up a lot. I mean, people are saying, well, listen, I should just go and be in How I Met Your Mother, HWM. All I can say is that Elliott Partners was right. There was money within Alcoa if we broke it up, but it was all in this company, Howmet.
Wow. I guess it's sort of a comment on the need for airline capacity.
2 million screws in the 747.
Jeez.
Yeah.
And you heard Eunice, our correspondent in Beijing yesterday, talking about the prospect of opening up more U.S. flights.
It's got to happen. Look, I think that there's if you want to buy, remember Macy's is the one to play. They used to send
At 10
the
a.m.
Chinese
Eastern time, we get US ISM
junkets to
data.
the U.S.
Services
were
PMI
10 times what they are
forecast
now.
52.5
They need
on the
more
prior
aircraft.
52.7,
That country is in. I
with a
just don't
range
know
of
what's going on in that
54 to
country. But that was
50.7.
the way that
Services
a lot of our
employment
retailers did well in
forecast
New York
51
was
on the
because of
prior
the
50.7.
of these huge
Services new
Chinese
orders
travel
forecast
ventures that are now 1/10 of what they were.
on the
They
prior
need planes.
55.5.
So tonight,
Services
what do we look at?
paid
Okay, I have
forecast
Constellation. Let's find out whether,
57.3 on the
other than
prior
Kim Crawford, it's been
58.3.
good wine.
US
You're going to do your M&A consulting.
Yes, I am, and I do think.
On the
I know
prior,
Bill
minus
knows, like
3.6%.
everybody else, that the
The
decline
range of 5.4%
in
to
bourbon
0.8%.
and whiskey is really
Durable goods
extraordinary. We've never seen anything like it. Again, some of it's cannabis, some of it's
5.4%
GLP,
on the prior
but
5.4%.
these were
And
the
US
greatest
core
cash
durable
cows
goods
in the world.
revised
Now they're not growing at all.
forecast at 0.5%.
Very interesting.
And then I imagine you'll look ahead to, as we said, the busy week we get next
Oh
week.
my! We have so much going on in healthcare. That never forget that while all this stuff is going on, that Amgen is doing incredibly well. That Regeneron's a very inexpensive stock. These companies became inexpensive. Why? Because of the Mag 7. These all became sources of funds. And Cencora by the Mercer's Bergen.
How many interviews are you doing in 2 days?
I'm doing 17 interviews.
In over 2 days?
Yeah, last time my wife said, she looks at my schedule. She goes, I count that you're doing 17 interviews. I said, actually, there's one more I just added. And she said, you're insane. And then she went to bed. What else?
You're going to be busy, man. But good for the viewer. Thank you, Jim. We'll see you tonight. And, of course, Jim will be at JPM Healthcare next week. When we come back, NEC Director Lel Brainerd with White House reaction to the jobs number and a lot more as we got the Dow hanging on to some modest gains, 18 points. Don't go anywhere.
Rating says most North American sector outlooks are deteriorating on slowing economy. One minute remaining. I'll lead with US ISM Services PMI.
The NBC.
Good Friday morning and welcome to another hour of Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla. We are live for you, as always, from Post 9 of the New York Stock Exchange. David has the morning off. Take a look at stocks this morning. Reaction to jobs is a little bit better than we initially saw. S&P 500 up a quarter of 1%, NASDAQ up 0.2%. Dow's rising about 19 points. You are seeing some strength in groups like financials at the top of the list today, up 0.5%. Consumer discretionary, energy, communication services. What's not doing well? Well, more defensive groups like real estate and healthcare at the bottom of the pile. For the week as a whole, though, we're down 3% on the NASDAQ, 1.5% or so on the S&P. Treasuries, in reaction to jobs, the gut was to sell treasuries, pushing yields higher. We see that continuing with the 10-year note yield above 4%. We got there, actually, after the European CPI numbers, which we'll talk about. But it's backing off a little bit. Look at the 10-year. Just went below 4. We're 30 minutes here into the trading session. Here are some movers we're watching right now. Fresh numbers out of beer maker Constellation Brands, posting better than expected profit. Those sales did fall short, and the company had to lower its full-year guidance. Berkshire Hathaway buying more shares of Liberty Media, an SEC filing showing Berkshire purchased nearly 3 million shares of the voting and non-voting tracking stock for about $82 million. Now holds a 20% stake in that name. And a number of top picks from the street this morning: Nike, Boeing, Occidental, and more. We're going to break them all down for you. They're all in the move, and they're all higher right now.
Let's get some ISM services and factory orders and get back to Rick Santelli. Hey, Rick.
Yes, a litany of numbers, and I'll try to go slowly here. Factory orders for November expected up around 2.5% to up 2.6%. You have to go way back. You have to go back to Jan of 21 to find a bigger number. I call that 3 years. That's pretty good. But once you strip out transportation, you can see where all the horsepower came from. It drops from 2.62 up 0.1, which is still better than the down 0.1% we expected. And if you look at durable goods, now these are final numbers, so you're going to look for less movement. 5.4 remains at 5.4. That's the best since July of 2020, by the way. And if we look at durable good orders, ex transportation, we can see what happens there. It drops to 0.4. Once again, same dynamic. Transportation, aircraft really kicking in there. Up 0.4 isn't bad, though. That's the best level going back actually to May of last year. Now let's look at capital goods orders, non-defense, ex transportation, a proxy for capital spending. It remains up 0.8, and shipments down 0.2. That's 0.1 worse than our mid-month read, which was down 0.1. Now, let's go to those ISM services. The headline index, 50.6. That is indeed a miss, 50.6. We were looking for a number to be at 52.5. That was expected, and 52.7 in the rearview mirror. Prices paid, 57.4, pretty close to expectations, lower than 58.3 in the rearview mirror. That's a good thing. If we look at employment, which we just had that report today, of course, 43.3, that is a big miss. And, of course, that goes into contraction territory. 43.3, Wayback Machine, weakest since July of 2020. And finally, new orders, expected to be around 56, is a miss, but still in expansion territory at 52.8. So 3 of the 4 are in expansion. We had some disappointments, but the big disappointment seemed to have been December employment read. We see that interest rates have backed off on those data points. We moved from basically 404 right down to, 398 now, folks. We're under 4%. And do keep in mind that we've seen big jumps on the week in terms of yield, Sarah. But, of course, as we dip below 4%, we're going to take some of that back to you.
And the equity market follows suit, likes the yields moving south. Thank you, Rick. Rick Santelli. With a miss there in services, may be important for the market to see, as we know that's been the hot part of the economy. But if you add that onto the jobs report, I think we should talk about it. There's a number of factors to highlight. First of all, overall headline was much better than expected. More than 200,000 jobs added in the month of December, 216,000. That was better. It closes out what was an extraordinary year of job creation, 2.7 million in total employment for 2023. I think that was better than most people expected the year to go. The strength was somewhat offset by downward revisions that we got in the prior 2 months. It left the level of payrolls in December only 145,000 above the previously reported level for November. So it takes a little bit of shine off the number, but it was still a good number. I think we should also talk about wages, because that's what the market initially reacted to in terms of that spike in yields. They came in a little bit hotter than expected. Of course, good news for Americans, maybe unsettling for the Fed, which is trying to target wages and inflation. Average hourly earnings increasing 0.4% in the month. So from last year, that's about 4.1%. And it was a little bit of a step up from the 4% that we saw in November. I think that the reaction, Carl, on the street from economists is this is not a number that's going to want to make the Fed cut rates anytime soon, urgently. It plays into the let's keep rates restrictive for longer to make sure that we have some progress coming down in inflation, which we have seen. But a number like this makes you wonder if there's a risk that it sparks back up a little or stays high.
Yeah, although household survey was so weak. True. We got these negative revisions. We just got ISM services employment. Nick Timbros of the Journal looks at the 3-month average on private sector, 115 in December. That's the lowest since basically the economy reopened in 2020. October, 44K. Given all the revisions?
Yeah, there have been a lot of downward revisions lately. So it makes you wonder whether this one's going to be downwardly revised too. Also, December is always kind of seasonally and holiday. But, you know, we're also seeing real wage growth. We're seeing wages grow above inflation, something we did not see.
Yeah.
And that's good. That bodes well for the consumer. It's something that the Fed is definitely going to be paying attention to. I think that on top of did you see the European inflation numbers overnight? Eurozone, highly anticipated. They were expected to tick up a little bit. We did get that. Headline number goes up to 2.9%. That was a little bit more than expected. Although on the plus side, core was a little bit lower. Core was 2.4%. Sorry, core was 3.4%, and that was a little bit lower than November. So that was
prior
good.
3.6, yeah.
Yeah, so it's still above target, but you know, people are wondering if maybe it was too aggressive to price in 190 basis points of cuts for the ECB. That's where we were last week. Now we're down to maybe 140 basis points of cuts. So it matters in that the market is trying to figure out how many cuts we're going to get next year and when those cuts are going to start. Are they going to happen in March? Those odds are definitely decreasing for the Fed after the state.
I mean, Europe's a complicated story. Germany, in particular, where retail sales fell almost 3 times the estimate, down 2.5. The construction PMI there is under 40 for the 4th month in a row. I mean, Germany's got some issues, which, of course, is not the only thing that's driving ECB policy.
No, but the economy there is in worse shape, no question about it, than it is here, which is why the market was more aggressive in terms of pricing the cuts for the ECB. But, you know, when energy prices go up, then the headline inflation numbers go up, and that's something that the ECB has to pay attention to. You know, for every week number, how about the consumer, the Costco numbers that were reported last night? I saw a big jump in December, both in same-store sales and in overall sales. Big jump over November. And then the only other thing I would highlight is this soundbite from the Royal Caribbean CEO. He was on with Brian Sullivan last night on Last Call's great interview. And I know that cruises are having a moment, but here's how he describes the consumer. It really stuck with me.
Well, I can tell you that the consumer is very healthy. And when we poll our customers and we look at credit card data, you know, they're sitting on a lot of wealth, a lot of savings, and low credit card balances. And so we're very encouraged by that. But what we have seen is about a 30% increase versus 19 on onboard spend.
Very bullish. Let's talk about the economy. The jobs report coming in better than expected. Just to review, U.S. employers added 216,000 jobs in the month of December. Unemployment rate holds at 3.7%. Lael Brainerd, National Economic Council Director and former Federal Reserve Vice Chair, joins us now first on CNBC. It's great to see you, Director Brainerd. Welcome. How surprised are you by these strong numbers at this point in the cycle?
Well, I think the data that we saw this morning really confirms 2023 was a great year for the U.S. economy. The economy entered 2023 with a lot of strength in the labor market, and it carried that strength all the way through to the end of the year. So we are up 2.7 million jobs over the course of 2023, more than the best year of the previous administration. And that took place at a time where the unemployment rate was consistently below 4% throughout the year. And inflation, core inflation, came down close to that pre-pandemic benchmark of 2% over a 6-month basis. So that's a really very healthy economic picture.
And what adds to it is that wage growth ticked up for the month of December. I mentioned the 4.1% from the 4%. But does that make you a little bit nervous? Because we know the Fed has been trying to target inflation, and wage growth certainly plays into that it's going to be hard to do this last mile down to 2% target.
Well, I think you will find that President Biden will always take a healthy wage growth number. And this is just very good news for American workers. Wages are growing. Their purchasing power is actually up because wages have exceeded, on a price-adjusted basis, have grown over the course of the year, over the course of the administration overall. But what does that reflect? It reflects productivity growth, over 2% productivity growth over the previous year. And inflation is actually coming down, core inflation down to that 2% range on a 6-month basis. So that's a very good picture for American workers, the American economy.
The jobs report shows a very healthy economic picture.
You know, financial conditions have loosened a lot over the last month on hopes that the Fed is going to start cutting rates, and it does make you wonder, especially when you see mortgage rates drop and the stock market up, whether we're going to have stickier inflation or potentially another flare-up in inflation after all the progress that's been made so far. How do you assess the risk of that?
You know, I think we just got the numbers on the supply chain index, and that shows that supply chains are actually all the way back down to normal pre-pandemic conditions. So biggest drop in supply chain pressures I think that we've ever seen from very, very elevated levels. That is really what's been driving inflation, and that's why you see that core has come into the 2% range much faster than a lot of forecasters expected. So I think the picture is much better balanced than any forecaster had predicted just a year ago. We're seeing those wage gains on the back of strong productivity.
But the inflation is not in the supply chain as much, or the goods sector. Now it's in services, right? And it's in housing as well.
Yeah,
but those are the sticky parts.
Yeah, so I think in terms of the core inflation numbers, we did see those coming down last month to 2% on a 6-month basis. So that includes and is very focused on services. So even there, we're seeing progress. Housing, as you know, we have new rental numbers that had been coming down. Those haven't fully shown through to average rentals, but of course, we're going to keep focusing on housing affordability, a huge issue for Americans. Really important to continue working on that.
Well, I wonder what you make of sort of the noise that we get every Jobs Friday. Today, it's usually about the household survey versus the other one. The response rate on NFP has gone from 60% to 40% over the past decade. Do you have a lot of confidence in the actual data that we get every month?
Well, I would say that we are very, very interested in those payroll numbers. They have always told us a great deal about where we are on the economy. But as you say, there are discrepancies with the household survey that we're also very attuned to. And so, you know, every data release, we try to take what signal it might have about the longer-term trajectory of the economy, recognizing there are going to be revisions just like there were over the last 2 months. But the general trend, I have to say, again, below 4% unemployment every month for 23 months at a time when inflation has come down into its pre-pandemic benchmark range. Those are the kind of underlying trends that we are seeing month after month in this data.
Headline today, Maersk, one of the biggest shipping companies in the world, rerouting Red Sea ships for foreseeable future. We've seen container rates spike on the back of these Houthi Yemen attacks, even with the U.S.-led coalition to try to ensure more security in the region. How threatening is this to global inflation?
So I would say this is something that our national security team is very engaged on. This is unacceptable. And they are working with a broad coalition of partners and in close contact with shippers on this. Now, as you know, some shippers are diverting. That adds days to delivery times, and it also adds to delivery costs. The U.S. is somewhat less subject to some of those because we are less reliant on those. You've seen very little effect, actually, on prices at the pump. Americans are seeing a gallon of gas. The median is at just a touch below $3, so down $1.90 over the course of last year. So in terms of Americans' pocketbook issues, we are still seeing very good progress on gas prices, and we're actually seeing progress at the grocery store as well. These are things that really matter to Americans.
Right. So I know you must be frustrated, along with the administration, that the president and the administration doesn't get credit for the strong jobs market that we've seen, the fall in inflation rate that we've seen, in gas prices. We continue to see these polls and sentiment indicators that President Biden doesn't get credit. And I think it's because, in part, the administration gets the blame for helping spark the inflation problem that we're dealing with. Why shouldn't people blame President Biden for that?
So I think if you look at the economy that the president inherited, the incredible supply shocks that we have had to navigate through, starting with the pandemic, continuing on with oil and gas prices. I mean, the president's done an incredible job of addressing supply chains. Again, this morning we saw supply chain pressures are all the way back down to pre-pandemic. They were at a record high during these supply shocks that he has taken policies to address. And if you look at inflation, inflation follows that supply chain index almost 1 for 1 with a few-month lag. So really, all the work that's been done, trucking, shipping, infrastructure investments, chips investments. We just announced the second chips investment a few days ago, and the private sector is making a lot of investments there that are already paying off. Those are the kinds of things that led to big spikes in auto and washing machine prices. And you're seeing the results. You're also seeing milk, eggs, chicken, fruits and vegetables prices coming down at grocery stores. That's going to mean a lot to American consumers.
Well, Brainerd, thank you very much for joining us. We appreciate it.
Thank you.
First take on jobs and the economy. We're going to get CPI numbers next week, Carl, which is exciting, along with some of the big bank earnings. Interesting to note this turnaround. Post services coming in weak, ISM services, more buying of treasuries, and the dollar went weaker.
Yeah, CPI and PPI, some argue, really all that matters at this point. We'll get it on Thursday. As we go to break, take a look at the roadmap for the rest of the hour. Apple sliding to some 8-week lows, down more than 5% to begin the year. And now Microsoft closing the gap as the most valuable company. Which is the better stock to own right now? We'll talk about it.
Plus, a number of new bull calls in the energy space, as well as some Dow stocks. We'll break all the new calls down for you.
And Bitcoin pushing a bit higher this week as the deadline approaches for the SEC's decision on this Bitcoin ETF. What's at stake for crypto investors and the big ETF providers as Squawk on the Street continues after this.
Deals today.
As Apple continues its tough start to the year, another mega-cap name closing the gap on being the most valuable American company. Microsoft, now worth $100 billion less than Apple. That is the narrowest gap seen since November of 21. Which stock is a better bet from investors right now? Joining us this morning, Jefferies analyst Brent Thill and Oppenheimer analyst Martin Yang. Brent just named Microsoft a top pick, raised his target from $400 to $450. Martin is a $200 target and a buy rating on Apple. Guys, it's great to see you. Brent, let's talk about, I guess, the momentum on Microsoft. What does it have at this point that Apple does not, even if they may be in somewhat different businesses?
Yeah, what Microsoft has this year is the AI move. They have the best AI lineup in software, and they'll be monetizing in the back half of the year. Yeah, there's a little bit of hype inside the stock in AI going into the beginning of this year, but we think that from a fundamental perspective, they have the strongest lineup, and you're going to really see that in the back half. So you have prices going higher. You effectively have value creation for clients going higher. This management team delivers margins over time. Even while AI is expensive, we believe they will deliver upside to margins. And you have the consistency of Nadella and Amy Hood, which have been phenomenal co-pilots to fly with. And this co-pilot offering that's coming is going to be a huge impact for everyone, both consumers and enterprises, probably more likely enterprises first. So we continue to be as excited about Microsoft as ever. We think the software industry has a 10% plus price lift on overall pricing because of AI. Some of these companies are charging double the price of their seats for the software. We don't think they'll get that, but there's a natural price list for the entire software industry. So, given the run we've had last year, I don't expect the same magnitude of outperformance this year, but we do expect relatively good upside based on the fundamentals that we're seeing.
On really quick, Brent, on this keyboard button that would launch Copilot, it got some attention today, but I've heard some takes saying it's akin to an iPhone moment for AI at large. Are you going that far?
Yeah, I'm not super excited. I've said this repeatedly. I'm a big fan of the enterprise business and what they're doing there. I've not been as excited on some of the feature sets that they're adding around this area. So we'll see. But I think ultimately Microsoft is trying to reinvigorate Windows. They're trying to effectively get everyone to stick around on that platform. And I think maybe this will be a good helper. But I'm not as excited. Some have called it, remember the Clippy paper clip when you ask questions and everyone just wanted to deactivate Clippy and shelve them. We don't know yet. But again, I think across the products that we've seen, we're encouraged by the progress they're making on broader enterprise AI, which will be a big driver.
Martin, what's the case for Apple over Microsoft?
Yeah, the case for Apple is we believe 2024 will be the first year we see mass adoption of consumer on-device AI, and then Apple will be the single source of trust for a lot of currently what perceived as a very fragmented consumer-facing AI apps.
What about what do we know about the AI apps or the AI story for Apple? It seems much clearer for Microsoft, as Brent laid out.
Yeah, I think there are twofold stories. Number one is we're already seeing implementations of large language models for a correction of the inputs on iPhone, starting from iOS 17. And over time, I think, especially for this year in June by WWDC, we'll likely to see more enhanced AI functions that enhance photos, and then there are journal and personal note-taking functions that will be assisted by large language models run on the device. And the second layer will be, running other apps that use on-device large machine learning functions provided by Apple that will open to a much wider third-party developer ecosystem.
Pretty interesting. Both names have given us a lot to talk about with the flip of the calendar. I look forward to chatting with you guys in the coming weeks. Thanks, Brent and Martin.
Thank you.
Thank you.
As we head to break, check out the biggest gainers on the S&P to start the year for the week. Again, the S&P itself is down about 1.4% for the week. Moderna, that's a little bit of a comeback story. It was one of the biggest losers in 2023. Also some other healthcare names on there like Merck and other laggards of last year at the top of the list. Verizon on there too. More on some of the market movers, plus this little bit of a buying we're seeing here. Post services coming in weak. NASDAQ up 0.6%. All the sectors go positive in the S&P. We're back in a moment.
Peacock.
5 years from now, the world will be using more oil and gas than it is today.
More, not in 5 years, more.
5 years from now, it'll be using more than it is today. We meet demand. We don't control demand, we supply demand. And so we will grow our oil and gas business over the next 5 years. We'll also grow our lower carbon energy businesses. We'll grow renewable fuels, we'll grow our hydrogen business, and we'll grow our carbon capture business. So we need to reduce the emissions from traditional energy, which we're doing, reducing our carbon intensity of oil and gas that we produce today, at the same time as we invest in new technologies to grow new sources of supply as demand for all forms of energy continues to grow.
That was Chevron CEO Mike Wirth. Case for the business as energy stocks go from laggards to leaders this week. That's been a theme for stocks as we kick off 2024. Let's get to Dom Chu with more on what's moving. Hi, Dom.
It's still, Sarah, kind of early in the new trading year, but there are those three sectors that are off to that better than expected relative start here. You've got healthcare, utility, 1.5% to almost 2% here, just again in the first few days of 2024. Today, the traders are watching three of the bigger names, including ExxonMobil, Chevron, and Occidental Petroleum. Each of those stocks is being tagged as a top pick by analysts over at Bank of America. They cited, amongst other things, positive momentum for growing cash flows and risk-adjusted values at current levels. Separately, also, ExxonMobil said it would take a charge of as much as $2.6 billion to write down the value of assets tied to oil and gas production along the coast of Southern California because of its inability to resume production, given some of the regulatory hurdles there. So ExxonMobil up about 0.5%. On the industrial side, Boeing shares are in focus after analysts at both UBS and Wells Fargo named it a top pick in aerospace and defense. Boeing shares right now just down about 5% on the year, but up 1% today. And Nike is getting tagged as a best pick at UBS as well for softline retail. They think the athletic apparel and footwear giant, and of course Dow Component along with Boeing, is a strong growth story with an outlook that has not yet been priced into the stock. So Nike shares up 0.5%, Carl. Some of the movers so far today. I'll send things back over to you.
All right, Don, thanks so much, Dominic Chu. Coming up after the break, Goldman Sachs chief economist Jan Hatzius is with us. We'll get his first take on this morning's jobs number, what it may mean for some potential rate cuts ahead, when we're back in a couple of minutes.
And Yellen says real wage increases mean Americans are getting ahead. And Yellen says what we're seeing now can be described as a soft landing.
Welcome back to Squawk on the Street. I'm Bertha Coombs with your CNBC News update. The FDA just gave Florida the green light to import drugs from Canada, where medicine is less expensive. Regulators also said they were committed to working with other states to make similar approvals, despite fierce opposition from U.S. pharmaceutical companies. Florida officials have estimated that the savings in the first year alone could add up to $150 million. Former Paralympic standout Oscar Pistorius is out of prison nearly 10 years after he shot and killed his girlfriend at his home in South Africa. Pistorius has maintained that he mistook her for an intruder. A parole board approved him for release back in November. Prison officials say he will be under constant monitoring until December 2029. And the United Nations says global food prices fell in 2023 from the previous year's record highs. According to the UN, international prices for commonly traded food commodities fell nearly 14%, with only the prices of sugar and rice growing in the past year. Sarah, back over to you.
Disinflation. Bertha, thank you. The American labor market still going strong. Latest jobs numbers out this morning showing solid hiring and firm wage growth. So what does it mean for the Fed and the future of rate cuts? Steve Leisman here to put some of these numbers in context. Steve, good morning.
Sarah, yeah, this stronger than expected job report, I think, offers markets a lesson in what the Fed has been trying to communicate. Improvement on the inflation front and the slowing of the economy are not going to be a straight line. But beneath the hood, there's actually some slowing, I think, is worth noting. I want to look at the 3-month average for total and private payrolls. The current total number is up 165,000 over the past 3 months, but that's down from 334,000 a year ago in January 2023. Private sector also, more importantly, 115,000, down from 221,000, more than half of the number from last year. Private sector gaining just 164. But that's because government's up 52,000. Government is trying to recap or recoup the employment levels it had from before the pandemic. It's just barely reached it now, but that doesn't account for any growth in the economy. There's leisure and hospitality doing well as it's done, along with healthcare. That's just going to do well no matter what's going on in the economy. But transportation and warehousing and temporary help, perhaps that last one, a leading indicator, also softening and softening now for several months. Construction and retail both up 17,000. Wage growth was a tenth higher. Work week was down, and worth noting, by the way, the ADP wage data, it has a much bigger data set, like 10 million. It has shown a consistent cooling. Other cooling signs, yeah, the ISM service sector came in. The top line was below expectations, and the price and employment indices both fell. All of this data creating tons of volatility in the outlook for the Fed. Take a look here. Before the jobs number, you had a 65% probability of a March cut. After the jobs number went down at least as low as 57, maybe lower than that. And now post those ISM services numbers back up. We're now pretty darn confident it's going to happen in March again. On balance, what you have, economic and job strength, it should make the Fed less likely to cut. I got a lot of commentary that says these are not the kind of numbers that the Fed is going to cut with. But there's 2 more jobs report before the March meeting, 3 more inflation reports. All that's going to be the most important to figure out what the Fed does. The best hope here, guys, is for the market is that the 2023 trend continues. Good job growth, and yet surprisingly, that falling inflation. I just want to say, Sarah and Carl, you guys are having entirely too much fun this morning with the jobs report.
Just wait. We're just getting started, Steve. Thank you.
Sure.
Steve Leisman this morning. In fact, speaking of which, let's get some reaction from the street today. Goldman Sachs chief economist, head of global investment research, Jan Hatzius, is here at Post 9.
Here for the party.
Yes, Jan, it's great to have you.
I definitely want to participate.
Are you, well, great call at 190. You were not far from the actual print. Are you leaning toward the softer elements of this or the nice print itself?
Probably more the softer elements. I mean, I think it was a little bit more mixed than the unemployment rate and the headline payroll number suggested, with some of the factors that Steve just walked through, and also the ISM on the softer side. So I think it's a bit weaker. So I don't think it's necessarily a roadblock to cuts from the Fed relatively soon. But the main driver of cuts from the Fed in our forecast is weak inflation. The inflation numbers have been very soft, and if that doesn't unwind, then I think we'll be at a point before too long, maybe by the March meeting, where they say inflation is now sufficiently close to 2% that we should start to reduce rates.
That said, you have not been seduced by all the talk of March cuts or June cuts, right?
We do have a March cut in the forecast.
You do?
Yes,
okay.
We do, basically because Chair Powell said at the press conference in December that they want to get moving if it becomes clear that we're moving back to 2%. The minutes said the same thing. And, we think that year-on-year core PCE inflation is falling to, 2.5% by the end of the first quarter. And I think in that sort of environment, with more deceleration expected, what they have said is consistent with cutting, at least gradually.
But the other thing that the jobs report showed today, Jan, is that we're really seeing some real income growth, some real wage growth, which I know has been part of your soft landing scenario. But now that wages are rising faster than inflation, that bodes very well for consumption, which also may make it harder for inflation to come down.
Well, we certainly agree that the economy is pretty solid, and strong real income growth is an important part of that, but it has not stood in the way of very significant disinflation in the United States and really across the world. And we think that's going to continue to be the case. There will be additional disinflation. And as there is disinflation, even in a healthy growth environment, I think the Fed's likely to say, 5 3/8 for the funds rate is too high. That's the signal that they have been sending.
What about financial conditions? That's the other argument. And we know they're watching it. It was mentioned during the minutes of the last report. Does that threaten to keep inflation stickier than they'd like?
Again, I think it is a good reason to expect the economy to be solid from a growth perspective. It's not necessarily going to have a big impact on disinflation. Yes, at the margin, you're right, of course, that all else equal, easier financial conditions, stronger real income growth, a stronger economy means a little bit more inflation than you would see otherwise. But I just don't think it's something that's large enough to overturn that.
Do you think they are wary of cutting too close to the election? That they want to get any cuts of the year done earlier rather than later?
No, that's not really part of our thinking. We think, they're focused on the employment side and the inflation side of the mandate, and that's how they make their decision.
What about conversations last couple of weeks about maybe slowing or ending QT, right? And thinking of Treasury supply?
Well, there have been conversations about that for quite a while, and certainly market participants for much of 2023 thought that QT was going to end much earlier than what they had signaled. We don't really see it as imminent. We're really thinking start sending signals late in the year and then end it, very end of the year or early 2025.
So you think they're going to cut in March, and then how many times in 2023?
5.
24?
So we have cuts in March, May, and June, and then 2 more quarterly cuts in Q3 and Q4.
So you're more where the market is than where the Fed is in their projections and consensus, I think, Wall Street economists.
Yes, but we also have a lower inflation forecast. So the Fed's forecast, if you take the median projection in the summary of economic projections, is 2.4% for core PCE in the fourth quarter. We're at 2.2%. And that's not a huge difference, but when you're getting close to 2%, it probably matters.
Well, your recent track record has a lot of people paying attention, John. Good to have you. Thanks so much, as always.
Thanks so much.
Jan Hatz,
Great to be on.
Goldman Sachs.
By the way, Treasury Secretary Janet Yellen not seeing any meaningful effect on energy prices from Red Sea shipping disruptions. What we're seeing now can be described as a soft landing. Still ahead, tough start for the year for NVIDIA, but our next guest says the stock still got room to run, calling it a top pick. Find out how much higher he believes the stock can go from here. We're back in a moment with the Dow up 120.
the heart.
Mega cap stocks suffering a sharp drop to start 2024, with AI darling NVIDIA down 3% this week so far. But that said, it's not stopping the street from naming it a top pick. Our next guest forecasting $100 billion in free cash flow for the chip stock by 2025. 45% upside from here. Joining us now is Bank of America senior semiconductor analyst Vivek Arya. $700 price target on the stock, reiterating a buy rating. Vivek, I guess one of the debates on NVIDIA is if there's going to be a point in the near future where they reach sort of peak growth when it comes to this big AI leap that they're taking.
Yeah, good morning, Sarah. The point we made in our note is that the free cash flow generation, which, to be sure is 24 plus 25 combined based on our projections, is just the cherry on top of what is a very delicious cake. So what are the layers of that cake? Number one, we think generative AI is still in very early stages. These cycles don't just start and end in 1 year. These can be decade-long cycles. And there is at least 3 to 4 years of upfront hardware deployment, and we are just in year 2. So number one, generative AI is still in very early stages. Number two, NVIDIA's competitive position is exceptionally strong, all the way from chips to systems to software. Number three, towards the end of the year, there is a new pipeline that they have with the B100 and Grace Hopper and other products, which will have much higher ASPs. So I think that promises more growth in 25. And then top of all that, they're able to generate very strong free cash flows. And that's really the key point made in our research, that if I look at the free cash flow generation between this and next year, it could be close to 100 billion. That leaves 60 to 70 billion dollars of ammunition for NVIDIA to go and look at inorganic opportunities, right? Because NVIDIA is a very strong company from a hardware growth perspective, but generally hardware companies are not awarded the same multiples as software companies with recurring revenue engagements with their customers. And that, I think, is the opportunity that is not being recognized, that the cash flow that NVIDIA can generate can help them look outside at engaging and partnering or even doing M&A of software companies that are adjacent to their AI business and really take them to the next level and help them get the price to earnings multiple that the stock deserves for this kind of very strong growth rate.
Although it's interesting, you guys have also done some work on the software side where you are raising the possibility that AI-driven revenue might fall below expectations over the next 5 years. And I'm wondering if those concerns migrate into things like hardware.
Carl, I think it is possible that, look, we are in early stages of what is a brand new technology. Not every thing has been sorted out. There is a lot of process of discovery that is ahead. But you have to realize that technology is its own growth driver, right? In that the cheaper and more accessible you can make technology, the broader the adoption of that technology. And that's an important role that NVIDIA can play because they are very well aligned with the cloud providers, but they're also well aligned with the enterprise customers. And enterprise AI adoption is really the next leg of growth. But what enterprises require is a way to make this technology more accessible, right, easier to use. And that's where we think NVIDIA's broad range of partnerships, right, their ability to deploy this technology on premise and their ability to then go and partner and potentially conduct M&A can help provide a greater level of engagement with the enterprise. So that's why I think it's in some ways a little too early to forecast where this technology could be 4 or 5 years from now, because we are in early stages. And I think NVIDIA has the opportunity to drive much broader adoption than what I think consensus is projecting right now.
All right, Vivek, thank you for coming on and stating the case. Appreciate it.
Thank you.
Still ahead this morning, a pretty volatile ride for crypto investors as this SEC ETF deadline nears. Can Bitcoin hold on to its gains until then? We'll talk about it when Squawk on the Street is back in a moment.
Checking in on the markets as we close out the hour, we've continued to push higher here, especially in the wake of that data we got at the top of the 10 a.m., which showed ISM services a little bit weaker than expected. Saw Treasuries rally, although they were already rallying a little bit off the initial reaction to the jobs report. Now we've got a broad-based rally. Bob Pisani here to break down the action, as well as what's going on with Bitcoin. Bob, good morning. What are you watching?
Good morning. Good morning, Sarah. Yeah, you're absolutely right. The ISM service is weaker than expected. S&P futures moved up 20 points. Remember, we want slightly weaker, but not really weak data. That's helping. It's been a rough start, though, to the 2024. I mean, some big sectors are down here. Just take a look here. Cathie Wood's ARK, which was a big speculative tech sector, had a huge year last year. It's been down 6% this week. The Russell 2000, great November, December, been down. NASDAQ 100, there's mainstream tech down 2.5%. The only thing that's up is defensive stuff, healthcare, utilities, and consumer staples. So we had a rise in yields this week. It looks like some people are questioning whether the Fed really is going to cut 5 or 6 times next year. That's, I think, healthy. So we're working off some overbought conditions. I'm not terribly worried yet. Hey, speaking of Cathie Woods and ARK, and we are finally hopeful we'll get some ruling on the Bitcoin ETFs. This has been 10 years. We've been waiting for them to do something here. The important thing is there are 13 companies that have filed for a Bitcoin ETF, including Cathie Wood. She's first in line. They're supposed to give her a thumbs up or no next week here. There's a wide range of fees here, and it's a rather complicated approval process. Let me run it through you real quickly here. Basically, this is a new thing. We've never had a spot Bitcoin ETF before. So there's 2 steps here. There's what's called a 19B4 filing, where the exchanges have to file with the SEC how they're actually going to do the trading. So NYSE, NASDAQ, CBOE is involved in negotiations about how this product is actually going to work. That's the first thing. And then we have the normal S1 filing. Everybody with a new security has to file an S1. It describes what's the security, how does it work, who's in it, who's running it. That's normal. So this is a 2-track process. We don't know how it's going to work. The industry is hoping that they will approve the 19B4 filings and the S1s all at the same time. Now, we don't know if that's going to happen or not. They may approve the 19B4 and only approve some of the S1s, saying they don't like the application process. We just don't know. We're expecting something maybe as early as this weekend, but likely Monday or Tuesday here. The important thing is, remember, guys, they've got all sorts of games going on here still with the SEC and legal issues. Here's the fee structure. A lot of people are interested in this because, look, people are going to put a lot of money into this. So ARC 21's going to try 80 basis points, Fidelity's 39. We have Invesco at a different fee structure here of 0.59. They're going to waive that for the initial 6 months and the first $5 billion in assets. So there's going to be a lot of competition for the Bitcoin dollars here. As for Bitcoin itself, you saw the minute that we had an announcement there from BlackRock, it's rocketed up at the end of last year. So 30 to 40,000. And guys, I guess the question here is this a lot of pull forward? Just like you get companies going in the S&P 500, they get pulled forward. Look at that Bitcoin price, pulled forward in anticipation that this is going to be happening. Guys, we'll have Cathie Wood on Monday, 12:35 on halftime, and on ETF Edge at 1:10 p.m. Get an interesting little discussion with her on Monday.
Good stuff, Bob. Thank you. Bob Pisani this morning, helping us understand some of that complicated story. That does it for Squawk on the Street this morning. Money Mover starts after this break.
SPX.com.
Good Friday morning. Welcome to Money Movers. I'm Carl Quintanilla with Sarah Eisen live on the floor of the New York Stock Exchange. Today, J.P. Morgan's chief U.S. economist reacts to this morning's stronger than expected jobs number. Does it officially take a March rate cut off the table?
Plus, the largest producer of natural gas in the U.S., the CEO of EQT, is with us. How's the conflict in the Red Sea impacting business? Nat gas down more than 4% here in early trade.
And despite the strong jobs print, some companies are still struggling to fill openings. We're going to take a look at how one industry is turning to high school labor to fill that void. First, we'll look at the markets topping the tape for us today. A bit of a seesaw between the jobs number and then this reaction out of ISM, where we got the employment index in the 40s, which took some of the pressure off of yields. They reversed course. Market hangs on to gains. Let's bring in CNBC Markets senior markets commentator Mike Santoli. Mike, I think one put it, choose your own adventure kind of jobs day.
To a degree, and maybe if you blend them together, you have something that nets out toward, yep, we're moderating, we're slowing. Maybe the soft landing scenario, still you could check off the box, we're on pace for it, but you need constant replenishment of confidence that we're on track for it. I don't think the March rate cut is the make or break thing, but the Fed being in a position to cut, if necessary, if inflation cooperates, I think that's part of the premise. 1 year ago today, 3,900 or so on the S&P 500. You started to have Fed fund futures price in cuts at the end of last year. And there was a big talk of, oh, the Fed says they're not done tightening and all. And we didn't get the cuts because the economy did better. And the S&P ended up at 47 and change.
I feel like the market has to choose between which is worse, right?
Yeah.
Weaker economic data or stronger economic data, where the Fed doesn't cut as much?
I think the answer is almost always what's worse is weaker economic data, because the other part of it is it's more of a temporary.
I don't know.
We can
cheered on that weaker services number today.
When it came as a counter to the stronger number. And I also would point out that the S&P had kind of recovered off the reflex retreat after the jobs number. I mean, we're slicing it pretty fine.
In the jobs numbers.
Sure, we're slicing it pretty fine here. I still don't think 4% 10-year Treasury, investment-grade corporate bonds went from 6.4 down to 5.2. It does make things a little more accommodating for the market. We're a couple percent off the highs in the S&P. I don't think anything much has happened here that changes the overall story, except that we kind of went a little nuts at the end of last year, and we've retraced everything back to the moment of the Fed meeting in December. S&P went back there, 10-year Treasury went back there.
Right. Not the only thing going on, though. There's the risk of a more regional war, wider war in the Middle East. China's recovery still not happening. Bull bear, B of A today, still elevated levels of sentiment, right?
Yes, elevated, but it's interesting because it feels as if it's kind of a shallow reservoir of bullishness. If you look at the put-call ratios in the last few days, they've picked up. Money market flows really heavy in the latest week, so it's not like people have sustainably chased this rally. So we had definitely over-optimism had to cool off at the end of last year, and the process is underway. Also, sell-side strategists, in aggregate are expecting almost no upside at the median. So to me, it says, yep, we got a little ahead of ourselves at the end of last year. We'll see if this remains an orderly routine pullback or something more.
All right, Mike, we'll talk in a bit. Thanks, Mike Santoli. Following the jobs number today, this is what NEC Director Lael Brainerd told us last hour.
The economy entered 2023 with a lot of strength in the labor market, and it carried that strength all the way through to the end of the year. So we are up 2.7 million jobs over the course of 2023. More than the best year of the previous administration, and that took place at a time where the unemployment rate was consistently below 4% throughout the year, and inflation, core inflation, came down close to that pre-pandemic benchmark of 2% over a 6-month basis. So that's a really very healthy economic picture.
What does it all mean for the Fed moving forward? Let's bring in J.P. Morgan's chief U.S. economist, Michael Feroli. Michael, always a pleasure. Our thanks to you. Good to see you.
Yeah, good to see you.
Is it fair to say that the print reduces expectations for at least a Q1 cut?
I think so. Certainly, I think to get to Q1, you'd really have to have kind of a panic situation or a steep downturn in economic activity. And it doesn't appear that that's a near-term prospect. So I do think this takes Q1 barring any big surprise over the next 2 months, I think this really should reduce the odds of that kind of cut.
Can you bundle household survey, negative revisions, ISM services employment, temp jobs down into a more pernicious narrative?
You can if you're inclined to. I think if you take the average over the fourth quarter, what you see is both job growth and wage growth in the fourth quarter was the slowest of the expansion, but still pretty good. As you mentioned, there are some indicators that we'll probably see further slowing in job growth in the months ahead. Whether that actually turns into a negative number, yet to be seen, but I don't think that doesn't look like a prospect for January or February at least.
Your counterpart over at Goldman Sachs, Jan Hatzius, was with us a few minutes ago, and he sees a March cut because he says core inflation is powerfully coming down, and that's what the Fed is going to want to see, and it's going to be enough for them to cut and not be so restrictive. Why do you disagree?
So I do think they're in a position to eventually cut. I don't think what we heard out of the minutes earlier this week suggests that that's something they have a plan for as soon as March. I think given the wage number we saw today, they probably want to be a little more comfortable that labor costs are moderating in a more significant way before I think they're comfortable to declare victory, which I think a cut is essentially declaring victory given their well-known reversal aversion. I think they want to be pretty confident that when they start, they're going to keep going.
What is happening on the wage front? Because we got a little bit of a tick higher, 4.1% now growth in December. We're seeing real wages really start to move up, which is good for consumption. Where do you think that goes?
So as I mentioned at the outset, if you look at the quarterly average, it's 3.7% annualized, which is the softest since 2020, but it's still a good number and probably a little bit above what you would want to see to be comfortable that inflation is on a path to 2%. So, as you mentioned, this month we were a little higher than expected at 0.4. There's a lot of revisions to these numbers. That's why I kind of prefer to focus on the quarterly numbers. And as I said, those are moderating, albeit still probably a little bit too hot for the Fed just yet.
So what do you think the path of cuts looks like this year?
We have them starting in June and then cutting once per meeting, every meeting thereafter for the remainder of the year. I feel pretty comfortable with that after this morning's numbers. Certainly, it doesn't feel like, as I said, January or March looks particularly likely. Whether they could go in May, that's a possibility, but I think June, feel pretty comfortable with that right now.
Help us understand, Michael, what's on the line for CPI next week and whether or not some of these international jitters are going to move sort of supply chain thinking in the weeks or months ahead.
Yes, we're probably looking for 2 or 3/10 on the core number for next week. I would say one of the concerns here is that a lot of the improvement we have seen in the last 6 months, which Lael Brainerd mentioned, has been due to softening in goods prices, and that a lot of that reflects the improvements we've seen in supply chain performance. If some of these international tensions cause disruptions in shipping and so forth, we could see a reversal in that. We haven't seen it just yet, certainly in most of the measures we're looking at, including some of the supplier delivery numbers that we saw this week. But it does remain a risk, and again, one reason why we might not want to jump on or take a victory lap here on inflation just yet.
Right. Although we've spent a fair amount of the morning talking about the nice position for the moment that the U.S. consumer is in, given wages versus inflation, and I imagine you're probably, I don't know, to what degree is disposable income a focus for you right now?
So it looks good, right? So after this morning's number, it looks like in the fourth quarter, nominal incomes are growing. Nominal labor income is growing around 4.5%. Against 2% core inflation, you have real income growing at around 2.5% last quarter. That should support pretty good consumer spending even without any movement in the saving rate. So right now the picture on the consumer we think looks pretty good. Balance sheets look good. We don't see a lot of problems, broadly speaking, in consumer credit. So I think the picture for the consumer looks, pretty well supported right now.
I know the consumer matters most, but what about manufacturing, which does continue to point to weaker numbers? Transportation was a job loser this month.
Yeah.
How deep does that pain go, and can the overall economy withstand it?
Yeah, so manufacturing has basically been going sideways for much of the past year. Surveys have looked terrible, much worse than the actual production figures. Now, if we do get the rate cuts that people are anticipating, I think that should help demand for durables, things like autos, which have been generally pretty depressed, though had a good month last month. Should also help housing, and housing, when you see demand there pick up, that should help the manufacturing sector more broadly. And finally, capital spending has been, generally kind of lackluster given the high rate environment. If that, again, moderates some here, I think you actually do have a path for a little bit better outcomes for manufacturing activity this year.
Well, at least the news flow is going to pick up next week, including some bank earnings from some well-known banks a week from today. Michael, good to see you. Thanks.
Good to see you.
Michael Ferroli.
From Wall Street to Washington, where the government is preparing for the potential of a partial government shutdown in the coming weeks. Emily Wilkins in D.C. with more. So what is the state of negotiations, Emily?
Sarah, the negotiations are happening, but at this point, it's not looking good because despite all the work that Congress has done on the spending bills over the last several months, they still don't have the most important component, the overall amount that they will spend for this fiscal year. Now, House Speaker Mike Johnson, Senate Majority Leader Chuck Schumer, they've been continuing to talk about what that top line number needs to be. But if they can't reach an agreement soon, 20% of government funding will lapse on January 19th. Now, this includes bills covering the Departments of Agriculture, Energy, Veterans Affairs, and Transportation. It also includes military construction, the FDA, and housing and urban development. So a really wide swath of the government here. And it could mean fewer air traffic controllers, reduced food inspections, and delays in grants for farmers. Now, although Speaker Johnson has vowed to have no more short-term stopgap bills, Tennessee Republican Chuck Fleischman, one of the House's top appropriators, told me that it could still be a potential option.
We could see the potential, if the parties are close, for the olive branch of a continuing resolution, maybe from the 19th to the 2nd. As a stopgap or something like that. That's not beyond the pale of reason.
Johnson is also looking to negotiate with the White House on a potential overall spending levels. And of course, if they do figure out the January 19th deadline, they then still have to figure out the February 2nd deadline to deal with the rest of government funding. Back to you guys.
Emily, I know Kevin Brady was on Squawk yesterday. He did say it's not like there's been no activity. There have been some spending bills passed on the House and the Senate side, not to discount the difficulty in reaching a further agreement, but would you argue there's been some traction?
I mean, the problem with that is that you're absolutely right. There have been, but they're not the same bills. And of course, the House and Senate need to pass the same bill for that to actually get to Biden's desk and get signed into law. And part of the reason that they have been different is because the House and Senate are working with different top line overall spending numbers. So that's why this has really been a really important point in the debate, a really critical thing for them to get done. Only when they get the top line spending numbers can you really begin to make sure that the House bill and the Senate bill are reconciled so they can pass through both chambers and get to Biden's desk in time.
One more thing to worry about. Thank you, Emily. Emily Wilkins. Appreciate it. Up next, the largest natural gas producer in the United States, CEO of EQT, with us ahead of the cold front that's expected to hit the East Coast this weekend. And we'll ask him about the conflict in the Red Sea and what impact it could have on prices.
Plus, Bank of America naming its top energy picks for 24. Chevron's among them. We'll get the full list when Money Movers continues.
50% off.
Welcome back. B of A naming its top energy picks for 2024. The firm predicting that it will be another challenging year for energy investors with expectations that oil will remain volatile. Oxy, Exxon, Chevron are their top ideas. They say all three represent some of the greatest absolute upside in the sector this year while avoiding exposure through outsized commodity volatility. We'll see. It's been a tough space.
Well, we'll stick with energy and take a look at natural gas. A warmer than expected, warmer than average start to the winter has been weighing on prices over the last couple months. But could the cold front we're expecting this weekend across the Northeast kickstart a turnaround? Our next guest runs one of the biggest natural gas producers in the world and joins us with his outlook. EQT CEO Toby Rice joins us. Toby, good to see you again. Welcome.
Hey, thanks, Sarah.
What do you expect for prices this year?
Well, we've seen a dramatic move down, really what started in the beginning of this winter. We entered the winter season with storage levels about 5% above normal. That's nothing to get too concerned about. But since the beginning of this winter, we've seen prices collapse because of weather, and production levels have been a little bit higher. As you mentioned, the weather has not just been below average. We've had one of the warmest winters since 1950 in December. But that's looking to turn around. We think, as you mentioned, we've got some cold weather coming in here in America and also in Europe, and that should get us a little bit more constructive on gas prices. Then on production side of things, you're going to see activity levels respond to these low prices. And I think an anchor point for people to understand is we look at the marginal cost of production in the United States for natural gas requires around a $3.50 price to hold production levels flat. Prices lower than that should lead prices to being to lead to lower activity cuts, which should balance the supply-demand fundamentals.
So lower production this year. What are you thinking, and what does it mean for your own business?
So we have seen activity reductions, but rig counts have dropped 20% over the last 12 months, and as we're looking at the tape right now, Cal 24 pricing being around 275, 280. Well below the cost of supply for the marginal producer. So we do think that you will see activity reductions coming. We've seen it, indication from some of the private operators. And as we're going through budget season right now, you'll see from the public's activity levels that should be more moderated to reflect the current commodity price that we're looking at in this year. But, a lot of people are looking at the constructive setup we have, a little bit longer term for natural gas with the build out of LNG. And there's lots of things to get excited about looking longer term for natural gas.
Pretty interesting milestone this week, Toby, as the U.S. overtook Australia and Qatar as the #1 exporter of LNG. I wonder how big that spread could get, do you think?
We're certainly excited about what we've done to date, but, we certainly celebrate that. But let's understand what our potential is. And in this country, we have the resource, the workforce, and the potential to quadruple our LNG exports from the 15 to 16 BCF a day today to over 60 BCF a day. That is our potential, and that's really where we'd really start celebrating is how close to our potential can we get. And the world certainly needs it. To replace foreign coal, which is the biggest source of emissions on this planet, would require an additional 180 BCF a day of natural gas production somewhere in the world. And if we care about energy poverty and eliminating that, to give people more modern fuels and improve their quality of lives, getting them off the wood and dung that's being used in this world as a primary source of energy would require an additional 130 BCF a day. So there's tremendous market opportunity for natural gas to play a more significant role in providing energy security to the world and providing a cleaner environment.
So what do we need on that front? Better regulation? Do you see that happening?
It's real simple. We just need to let the markets work. I think one of the things you've seen, when you're scratching your head, we have such an obvious solution to eliminate some of the major problems in this world. Why isn't the market solving this problem? And the reality is simple. Political forces have overridden market forces, and there's no truer sense of that when you're talking about energy. But if we take a step back, understand what we've learned over the past 5 years, natural gas is the solution, and let's allow these solutions to get on the playing field and let the markets work. We can do some really amazing things. And as you mentioned, it is going to take a little bit of regulation. Really, the lack of regulation has prevented us from getting pipelines built. So anything we can do to get more pipeline energy infrastructure built is the key to letting these markets work.
Do you point your finger directly at the Biden administration on that?
Well, this is a really big issue, but I think we need to look at some of the things that have actually taken place. I mean, pipelines have not just been canceled under the Biden administration. This is something that's been happening for a very long period of time. Ever since around 2017, we've seen a wave of pipeline cancellations. So this is not, I'd say, affiliated with one party, but I think we need to take a more practical approach. Because and understand what we've done in the past towards energy has not worked. Energy emissions are still skyrocketing in this world. Energy poverty is growing. There's more people this year that are living without access to electricity. That's never happened in the past 20 years. So let's take a step back. Let's look at what works. Natural gas is the key to lowering emissions in the United States. With our LNG, we're able to lower emissions on the global stage. And as you've seen, the energy security that we provided to Europe, we can do that on a bigger scale. So I think it's a good opportunity for us to step back and really lean on the winners, and that is natural gas.
I know you were big on that. You were at COP28. We talked to you after that about how natural gas is part of that transformation. Before we let you go, Toby, did want to ask about the Red Sea attacks by the Houthi rebels and whether there's any impact you see on the gas market and transportation.
Yeah, Sarah, I think one of the key points that we talk about American LNG and the reliability of American LNG, there's a lot of places that can deliver LNG, but none of it will be as secure as American LNG because American LNG is backed by our military, can help prevent some of these disruptions to shipping that we've seen. So another thing to consider when getting your energy security from the United States, American LNG is going to be the most secure.
All right, Toby, thanks for joining us. Appreciate the insight. Toby Rice, EQT.
When Money Movers comes back, I'll look at the tactics some industries are taking to fill voids in their labor force. Our Kate Rogers is in Half Moon Bay, California, with more on that. Morning, Kate.
Good morning, Carl. The construction industry added 17,000 jobs last month, but there is a shortage of talent in the pipeline. We'll tell you much more coming up after the break.
Nike among the stocks getting love on the street this week, being named a top pick at multiple firms. Bernstein says it expects to see positive revisions through the next few months with a multi-year margin story still intact. Price target 134. Barclays sees a wholesale recovery ahead, better margins, the company leaning into innovation, target 142. And finally, UBS argues Nike has the best growth outlook and that has yet to be priced in, target at 138. A lot of them looking past some of the structural challenges that others point to, Sarah, regarding China and so forth?
Yeah, I mean, this is a stock that is so loved by analysts that clearly they stepped out in front of the big post-earnings sell-off when Nike warned about the overall macro environment, because that's all Nike did. It warned about softer consumer spending, but said that they're going to ratchet up their profitable growth and their innovation. So investors, or analysts, I should say, clearly paying heed to that. Let's hit European markets. They are lower this morning after a choppy week. The British FTSE, German DAX, French CAC all posting losses in this holiday shortened trading week. Retail the big drag this morning as German retail sales come in well below expectations for November, falling 2.5% month over month. On top of that, we got the Eurozone CPI rising 2.9% in December, and that was a little bit up from the 2.4% in November. Food, alcohol, tobacco, they made the largest upward contribution to prices while the fall in energy prices moderated. The data will, of course, add to the debate over the trajectory of the ECB's next move, with markets expecting rate cuts to begin this summer. They've pushed it back a little bit when it comes to the ECB cuts. Earlier expecting it to come bigger and faster. And that's really the debate with the Fed as well. With the ECB on its single mandate for inflation, these reports weigh even more.
Yeah, good to keep an eye on them. We're off the session highs here. Dow's now up 57. Let's get a news update with Bertha Coombs. Hey, Bertha.
Hey, Carl. New York City subway officials say they expect service to be partially restored following a train derailment that left roughly 25 people injured yesterday. None of the injuries are considered serious. The train derailed on the west side of Manhattan on the one line after it collided with an out-of-service train, snarling the commute home for many New Yorkers last night. Firefighters battled a 4-alarm fire this morning at a historic industrial park in Elizabeth, New Jersey. It was once the home to the first ever Singer sewing factory in the U.S. Someone passed by the area, reported the fire around 5:30 this morning. It eventually grew so large the plume of smoke was actually visible from nearby Manhattan. And David Soul, best known for his role as Detective Kenneth Hutch in the TV series Starsky and Hutch, has died. His wife confirmed the news today to the BBC. The Chicago-born actor was also known for roles in Here Comes the Brides, Magnum Force, and Yellow Rose. He was about 80 years old. I remember Starsky and Hutch. That was an amazing show. And that car. We all thought that car was so cool, Sarah.
All right, Bertha, thank you. Bertha Coombs. Up next, how this morning's jobs number could change the outlook for equity prices. Deutsche Bank's chief U.S. equity and global strategist joins us, lays out his case for betting on the materials sector. We're back in 2.
humanly possible.
This morning's jobs numbers showing the economy added 216,000 jobs in December, 56,000 more than economists had been expecting. But some industries are still struggling to hire. Our Kate Rogers joins us from Half Moon Bay, California, with a look, Kate, at the construction industry.
Good morning, Sarah. That's right. The construction industry is certainly searching for workers right now. Job openings stood at about 500,000 workers as of the end of November. That's according to JOLTS analysis from trade group Associated Builders and Contractors. That group says the number is up more than 100,000 from the same time last year. And it expects that will pick up over the course of this next year as funding hits the street from three key areas: the CHIPS Act, the Infrastructure Bill, and of course the Inflation Reduction Act.
It's hundreds of billions of dollars over the next 4 or 5 years is going to be coming out. And that's going to have a big impact on skilled labor and the shortage we're facing right now.
And as with many of the trades, it is skilled workers who are needed, and recruitment techniques need to change. At South San Francisco High School, a course that was designed as a traditional woodshop elective has now been transformed into a 2-year trades course for the construction industry.
Really going from building a birdhouse to learning how to, form walls, put, roofs on buildings. So it was really out of just understanding what is it that students will need to be competitive in the work environment, and what can we do to help support them get there. We really focus on trying to ensure not just that students are prepared for college, but also a career.
Now, that's really at the heart of what the industry says could be impacting the workforce. There's a lack of recruitment, particularly of younger students, teens, early 20-year-old workers that could get into the industry, fill that pipeline of talent, and of course take the place of baby boomers who are aging out of the workforce without enough workers to fill their place. Guys, back over to you.
What about a college degree? What is pay like with or without? And do you need it?
So, Sarah, that's a great question. And ABC says you don't need it. They call this earn while you learn. So you could start in a high school course like the ones that we just showed you. There's another one we'll tell you about later in the day. You can move into an internship, and then you can move into positions that do have some competitive wages. You can see there, power line workers making about $40 an hour. And once again, no college, no bachelor degree required there. So it is a good option for people who may be thinking about college or on the fence about it, not sure if they want to make that investment. There are opportunities, of course, in the trades, not only in construction, but also in manufacturing. The two industries very closely aligned, and that sector is facing a big shortage as well.
Kate, appreciate that. Great logo on the hard hat as well. That's our Kate Rogers this morning. For a closer look at the December jobs number and the read-through from markets in 2024, we're joined this morning at Post 9 by Binky Chadha, Chief U.S. Equity and Global Strategist over at Deutsche Bank. Binky, it's great to have you. We got your 24 outlook a couple days ago. Roughly, 20 times 250 or so?
That's correct. That's the baseline view.
What do you think moves? I know we talked some materials here, some financials as well.
Yeah, so I would argue the biggest theme remains, as it has been the case for the last year. The market's been very, very focused on the weak spots and the possibility, basically, of the U.S. going into recession. So, in our view, what you want to think about is what's priced in, basically, across sectors and industry groups for recession. If a lot's already priced in, then if it happens, the risk reward is still positive. And of course, if it doesn't happen, as it hasn't happened for what looks like 6 quarters now, then at some point you're going to get a step function up and move up. So I would say where most is priced in right now is really the cyclical parts of the U.S. consumer. It's the financials. You mentioned materials. That's the one place where we've made a change. Everything else we've sort of maintained for now. And materials, I would argue, it's betting a little bit on some recovery in global growth and starting to nibble basically at the possibility that the long-awaited dollar down cycle begins as and when global growth hangs in there or the perception of that changes.
You think that equities are still priced for recession, even with the run-up that we saw, say, November, December?
So I wouldn't say that they are priced for recession at, a trailing multiple well over 20 right now. And if you look back and see where we are relative to the peak, January the 3rd, 2022, a long time ago, we're very close to that. Yeah.
Right. So that's why I'm wondering why it's good to bet on cyclicals now if you don't think there's a recession.
So that's at the market level. What I'm saying is that certain sectors and industry groups is where it is priced in, and that's where you want to be long. Yeah.
So materials that you think it's been too downbeat.
Exactly. Exactly.
We're going to get some bank earnings starting in about a week. S&P Financials at a 1.5-year high today. Is that starting to price in?
Absolutely. So that's been, the trade that we've been long. That's what we've been recommending, and it's been working. Yeah.
Some of the calls we've gotten from other firms on banks this week suggest that we get an overshoot on multiples, especially at the regional level, the next few quarters.
I think that's very possible. I think, as you said, the most important catalyst is really earnings, which start next Friday. And I think the thing to keep in mind here on earnings is that if you look at the bottom-up consensus for what it expects basically for earnings, it would be one of the worst quarters of growth outside of a recession. And if you juxtapose that against basically what's happening at the top-down or macro level, what you see is the consensus is still a little bit over 1% in terms of GDP growth. The direction of the consensus is getting basically, is for upgrades. And if you look at, nowcast indicators like the Atlanta Fed GDP, it's at a solid 2.5%. So I would argue, just like we've had for the last 5 quarters, we're likely to have a 6th quarter of, at or above trend growth.
But at the same time, that might mean fewer rate cuts than the market is expecting. And the market is seemingly focused more on that than the better data.
Absolutely. My personal view is that it's easy to talk about things that are going to happen in 6 months and 12 months, but there's a lot of water that flows under the bridge. And I mean by that, a lot of data, a lot of time for people to change their minds. I would argue if we continue to have at or slightly above trend growth, I would be surprised to see more than a couple of what I would characterize as basically fine-tuning cuts. I see the cuts if, we get a very significant slowing in growth. That's what we have in our house economics view. But I would say, that's been the consensus view, and it's been the consensus view for quite a while.
You do raise the specter of you call it the 1970s experience, kind of coloring maybe some reticence to cut as much as the market hopes.
Yeah, I think the question is, I think the pivot basically in December was a surprise, I would say, pretty much to everybody outside the FOMC, especially, sort of a 180-degree turn in 3 months. And so, like I said, 3 months is not such a long time, and we are having a lot of discussions about what's going to happen in 6 months and 12 months. It's the season to have those discussions, so it's completely understandable. But a lot of things could change by then, and the call for rate cuts is predicated basically 6 and 12 months out on a view on what's going to happen to growth. And I'm just simply pointing out that the consensus has had this strong, almost unanimous view that growth is going to fall off a cliff. So it makes logical sense that they're calling for rate cuts, but we shall see what happens to growth. So.
It's a good roadmap for at least the next 12 months. Yeah. Binky, thanks. Good to see you again.
Pleasure. Thank you for having me.
Coming up next, Jeff Bezos backing an AI startup looking to challenge Google's search dominance. We're going to hear from the CEO on how they plan to take on some of Silicon Valley's giants.
And we're keeping our eye on the financials, as Carl just mentioned. The sector hitting a 1.5-year high. Bank of America, Wells Fargo, JP Morgan, all in the green. JP Morgan hitting an all-time high. This ahead of the bank earnings that roll out next week. We'll be right back. Perplexity. It's an AI search engine startup looking to take on Google, raising $74 million in a round led by some big names. Our Deirdre Bosa spoke to the CEO for today's Tech Check segment. Deirdre, tell us about it.
Well, Sarah, one of the biggest questions since ChatGPT exploded onto the scene has been the future of Google search. Does its dominance continue in the generative AI age, or will search be rebuilt from the ground up by upstarts like Perplexity, which, as you said, just announced a $70 million plus Series B round to do just that? Now, it's cap table. It is a who's who of tech moguls, prominent VCs, and existing Gen AI leaders like NVIDIA. There's Jeff Bezos and Shopify CEO Tobias Lütke, who participated in the round, along with high-profile former and current Google execs like Susan Wojcicki, who led YouTube for years, and current AI head Jeff, and the founder of Gmail. Still, Google casts a long shadow, guys, as we well know. It has left many challengers in its wake over the years. There's smaller players like DuckDuckGo, which is pitching better privacy controls to even Microsoft's Bing, which has billions of dollars in capital to use and harnesses the power of ChatGPT itself. Neither have made a dent in Google's 90% market share in search. So I sat down with Perplexity CEOs Arvind Srinivas earlier this morning, and I asked him why this time is different.
Search has been about 10 blue links for the last 20 years. And 10 blue links was always a hack. At the end of the day, people just wanted an answer. The concept of answer engine existed even in the late 90s when the internet was exploding. Ask Jeeves was an answer engine. In fact, many Googlers used to come from Ask Jeeves and join Google at the time because the 10 blue links was the concept that actually worked with the technology that existed at that time. So what Perplexity does is a paradigm shift in search. It's moving search from links to answers.
So even though Google's already working on this and it is rolling out a similar product in that existing search, Srinivas says that it is still too cluttered. Perplexity, he says, is being built in this new AI era, focusing on a core user experience that is clean, minimal, and simple, sort of, guys, like how Google built search in the early stages of the internet. And there is this sort of outstanding question here in Silicon Valley, whether you need to build the next generation of AI apps in this era, or whether sort of the legacy companies are going to build the next consumer-facing apps here.
So is this one? This is clearly one to watch, Deirdre. What are the top AI startups that are going to rival some of the big players that we should be watching?
I will say, though, that it's an interesting one because it's targeting search, which has just been this big sort of existential question for Google over the last year. But in terms of generative AI startups, it's actually quite small valuation-wise. It's worth about $500 million. I realize that's a lot of money, but you think about an OpenAI that potentially is reaching a valuation of $100 billion, or Anthropic, $20 billion plus, on $1.5 million of revenue per year. So this one is actually relatively small, but it is so interesting because the CEO has worked for Google, has worked for OpenAI, and I was talking to him about his start. He comes from Chennai, India, and he says that while he was working at Google, he wanted to build a company, but he didn't think that he was going to take on search. And the idea that he thinks the moment is ripe to ultimately displace Google or do something that Google's doing right now is such an interesting one and so relevant for Wall Street. That is why Google has sort of been under pressure somewhat over the last year. I mean, its stock price has gone up because it is building the foundational technology, but there's still this question: how does search survive and in what form?
Yeah, key for Google investors, no doubt. Thank you very much, Deirdre Bosa. The CEO of Edgewell Personal Care is ahead. What's the breaking point for consumers when it comes to those price hikes? We'll discuss. Don't go anywhere.
Lodge.com.
Let's do a deep dive into the state of the consumer in the new year. Our next guest is bullish, at least at his own company, noting that the consumer has remained resilient and that despite expecting some wage and materials inflation, those can be offset by greater productivity. Joining us now is Edgewell Personal Care CEO Rod Little. Brands of Edgewell include staples like Schick razors, Banana Boat sunscreen, Playtex, Wet Ones. Rod, it's great to see you. Welcome back.
Morning, Sarah. Great to be with you.
So what are you seeing from the consumer? Because I got to say, lately, ConAgra, Nike, we've seen some big revenue misses and warnings.
Yes, Sarah, the consumer has been remarkably resilient. As we look at the state of the consumer today, I don't have December data yet around our category growth rates here in the U.S., but if you go back through the end of November and you look at that October-November period, the growth rate of our categories, so total category, very similar to what the past 52-week growth rate has been here in the U.S. So we're not seeing a slowdown in our categories. And importantly, outside the United States, with about roughly half of our business is done outside the United States, we're seeing that trend continue as well, with particular strength in Asia and Latin America.
It's not being reflected in the stocks, Rod. Clearly, something is worrying staples investors, whether it's the dividends aren't as attractive with high rates, or the idea that price increases have just been too high and now we're seeing volume declines. Are those concerns overblown?
Yeah, I tend to think the concern's the latter, Sarah, and you're right. Consumer staples has lagged. We've lagged versus other industries. And so when you look at what's in there, I do think there's some concern around where companies can price from here. And unit volumes have been down, and revenue increases have largely been behind the pricing gains that have occurred. I do think we're in an environment now where we're not going to be able to price at the same level as we have in the past. We don't plan on that basis. Last year, we grew 4% organic. Roughly half of that was price, half of it was unit volume. In the fiscal year we're in now, we expect to grow in that same range with both unit volume growth and some price growth. Again, less list price increase, but good revenue management work around mix, promotion intensity, promotion efficiency can still drive revenue gains for us above unit volume, and that's what we're focused on.
Although, Rod, we've seen some examples this week in packaged food, for example, where you had both volume and price flip negative, and I wonder, do you think that becomes the norm across staples?
I don't think so. Again, if the consumer changes, if that dynamic changes, but as we look at it, again, as I said, our recent period, the growth rates in our categories, so shave, grooming, sun care, skin care, feminine care, the category growth rates are there. Now, will they slow? Maybe. We're prepared for that if they do. But I would expect that what we've seen we'll continue to see, which is category growth rates. Sun care growing double digits, for example, shave growing low single digits. But every category we operate in is growing both here domestically in the U.S. and globally as well.
And just on pricing, if you could just distill it a little further, Rod, are we talking about back to 2019 levels? Are we talking about deflationary pricing?
Yeah, sir, there's no pricing coming out. We're not reducing price per se anywhere. But for example, in the United States, we don't anticipate taking any meaningful list price increases this year. Everything that we have taken has been sold in. It's in through retailers. They've accepted it, and it's there. We do have some incremental pricing still happening outside the United States, primarily in some Asian markets and Latin American markets as well. So there is still some pricing power there. And I think we're in a period where it looks like it used to look pre-pandemic, where if you have great innovation, product benefit, and experience, something that gives incremental benefit to consumers, they're willing to pay for it, and you can price for it. But you have to have the innovation, you have to have the improved product and experience behind it.
All right, Rod, certainly appreciate it with the update on all the big things we're watching: inflation, consumer spending, volumes. Rod Little of Edgewell with an update. I do think, Carl, for whatever it's worth, the concerns are greater in packaged food than in household products and staples that Rod makes, as far as the pricing growth and the volume declines like we saw at ConAgra this week.
For sure. Interesting. Yeah, the innovation conversation is really fascinating, and not the end of that discussion as well. As for next week, it's going to get really busy between CPI Thursday, PPI Friday, bank earnings, including JP Morgan, B of A, Citi, Wells Friday, CES, and JP Morgan Healthcare Conference. It's going to be a ton of news.
I think there's a 10-year auction in there, too, somewhere in the middle of the week, which we're still watching that issuance and those auctions.
You'll definitely keep us honest on that stuff. Meantime, we are holding 4,700, 4,705 in the wake of the jobs number today, which, of course, has some pretty interesting internals when you mix in some of the ISM. Have a good weekend. Let's get to the judge in the half.
Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, life after the streak as stocks pace to break that remarkable 9-week run. Now the investment committee debates where the markets are likely to go from here. Most importantly, how you should play that. Joining me for the hour today, Jenny Harrington, Jason Snipe, Jim Leventhal, Steve Weiss, everybody in the house here at Post 9. Let's go to the markets. We still are green across the board, but as you see, we are not nearly as strong as we were hour and a half ago or so. Jimmy, I turn to you first. So we're going to end this 9-week winning streak. It's the NASDAQ's worst week since September. You got the strong jobs report. Wages were slightly above. And then the ISM services was squirrely. It was weak, barely hanging on to 50.
Yeah.
What do we do with this week? What do we learn this week?
First thing, in answer to the question about, the 8-week streak, 9-week streak coming to an end, good, all right? Because we needed to come to an end, right? What are we going to keep going, 10, 11, et cetera? No, this is the pause that refreshes. And my take on this week, everybody, is that this is noise. This week, the downturn the first 3 days, the upturn today, it's noise in what's going to be a very noisy year. I think it's going to be a very positive year, and I can't stress this point highly enough. The tone has changed from the last 2 years of how high is the Fed going to hike rates to now we're not talking about rate hikes. And I don't care. I'm looking at you, Scott. Not that you're coming at me, but I'm just looking at you because I want to have a focal point. I want to have a focal point here, okay? I don't care.
Just show us.
I don't care how long it takes them to cut. I don't care how many times they cut. That's irrelevant. The fact is we're no longer talking about rate hikes. Why does this matter? It means that good news is good news. It means 200,000 jobs being created is good news. It means that, now listen, I'm not all that happy with a 4.1% wage growth year over year, but it's not going to provoke the Fed to start raising rates again. And absent that, it means it's good for consumption, which is good for the economy. Look, I don't like the ISM number, and I don't like the way that labor force participation went down. But there's noise in every data series. I think we've got to strip out the signal from the noise. And right now, the signal is inflation is coming down, the economy is strong, profits are growing, and this should be a good year in the markets.
All right. So, Jenny, my distillation from all of that is that Jim says the story's intact, right? He gave you all the reasons why he thinks it is, but that's what I take away from what he said. The soft landing, inflation down, economy good, stock market good, story's intact after this week.
I agree. And so, while the story's intact, it doesn't mean necessarily that we have the right now to go to new highs. And I don't think we do. I think when Jim said, hey, we're backing off a little bit, good, I agree, good. It was too much too fast. And so what I know we'll get to later is we've taken some money off the table. And usually when I take money off the table, it's paired with the immediate buy, right? But right now, I don't think things need to pair. And so everything's not moving in tandem. The market got kind of frothy into year end. The story's intact for this year. I feel good about this year. I know within a month or so I'll be back to fully invested. But right now I'm sitting on a little cash. And I think that's okay. When I'm thinking about the story being intact too, I think the story gets better and better as the year goes on because we have all these nasty things that are going to be out of the way. We're going to know if it's 6 rate cuts, which I don't think it is, or 3, or 2, or none. We're going to know for sure. We're going to be done with the presidential election. We're going to have way more clarity on if inflation stays like a little sticky or if it's done. But this is a year where really clarity comes in a way that we haven't experienced for the past 4. And so I'm actually feeling not good in a raw markets going to new highs way, but I'm feeling as good as I've felt in at least 4 years because as an investor, I can make decisions and invest and think about investments and think about forward cash flows in a functional way without distortions and disruptions in a way that I haven't been able to before. So to me, the investment picture is intact.
So Jason, I'm watching yields, and the market is clearly tracking where yields are going and reacting as such. I mean, the equity market, because if you have the 10-year, you get the jobs report and rates move up a little bit. and cut expectations go down a little bit. Then the ISM report comes out, and rate cut expectations go back up. Interest rates, the 10-year yield comes down, but I'm watching the 10-year right at 4%.
Yep.
And the equity market is clearly a little uneasy about where yields are ahead of the CPI next week. Fed meeting's not for several weeks till the end of the month, but we have earnings too. What's your great takeaway and outlook for this year? Because we haven't heard from you. By the way, Happy New Year. It's good to see you back.
Man. Yeah, no, so what I would say is the biggest thing I paid attention to this week was the Fed minutes, right? So what was evident and very clear to me was, hey, look, we are pricing out a March cut. That's really what's going on in the market. And I think there's a fair amount of digestion as well. Listen, we ran a lot over the last 9 weeks. And to Jimmy's point, you know, it is time for a little bit of digestion going forward. There are a lot of variables that will affect the market. We have earnings that are starting in earnest next Friday, this time next Friday, which I think is going to be great.
And by the way, I'm going to let you finish your comment, too. If we have rate cut expectations, if we guys can, in the control room, please, can we show that? It'll show you if the Fed was trying to get the market to price out a March rate cut, today's economic data didn't do the job because, as I said, you know, jobs report comes in stronger, wages come in a little bit stronger, rate cut expectations actually go down a little bit, but then ISM comes in weak, and then you're going to see when we show it what happened next, because you were, I don't know, hour and a half ago, you were like 70+% for a March cut. So anyway, we'll show that. I want you to look at that. And I'm sorry to interrupt you, but please carry on with what you're saying.
I think it's an important point, but let's also pay attention to the dot plot. Dot plot, I mean, Jerome Powell has talked about 3 cuts. He did not talk about 6 cuts. The market's been pricing in 6 cuts. I mean, for a lot of us on this desk, I'm sure this seems a little bit out of this world, right? So the idea that we're also pricing out a March cut, you know, and kind of letting the market, let's let the market play out. Let's see what earnings do in earnest. We'll see what financials do. We're going to focus on credit quality. We'll focus as well on provisions. I think that's going to be a big deal. They were loaded up for financials last quarter, right? So let's see what that looks like. And I think let's ultimately let earnings play out.
Okay, I'm going to come back to you in a minute because you have some moves that we need to go through, and Jenny does as well. But Weiss, I want to hear from you because I'd like your take on the same question I asked at the very top as to what your takeaway is from this week. If you feel, as Jim does, that the story, and Jenny as well, that the story is still intact, despite everything that happened this week with the way the market, you know, sort of came to grips with where we think Fed policy is going to be. Again, Dow's now negative. S&P is leaking a little bit. We're still hanging on to 4,700. But what's your take?
So my take is that the headlines are still accurate. There will be, the Fed will cut. But I had said on Monday's show, before the minutes came out, they're not cutting 6 times. Maybe they'll do 3 times, maybe they'll do 4. They're not cutting this quarter. They may not cut next quarter. It'll be the back half of the year. Because while inflation is coming down, it's still stubbornly high. The moves in inflation are not what we saw from the real extreme levels, number one. Number two, I don't believe that recession is out of the question yet. I just don't.
Well, the ISM services number that comes out today, you know, 50.6, I think it was, makes you wonder what's going to happen to that part of the economy, which, remember, manufacturing's been weak. Services has not. Now you can't afford to start losing that.
And I do think you will start, it will start declining. It's been unusually strong for an unusually long time.
Let me just, this is what I was talking about earlier, right? You see pre-jobs report, you're 65% odds of a March cut. Then jobs report comes out, well, it's a little bit stronger, so it goes down to 57. ISM services, which we're talking about as we speak, comes out barely hanging on to 50. And then you go back up to 73% for March. So we're going to have to see how this all plays out, but nonetheless.
So to get to 70%, to achieve those odds, to achieve a cut in March, I think you need to see more weakness, much more weakness in the economy. Because weakness at this point in the economy is really the only thing that's going to get inflation down. So, because you're not far above the Fed's target.
That's not necessarily true. I mean, you're going to find out with the CPI next week if we continue on trend. To come
and
lower.
I think we will, but again, it's going to be baby steps going forward. It's not going to be leaps and bounds. Wage growth is still there. Now, the jobs number was not particularly strong if you go through the details. healthcare hiring was strong, and it should be strong because we've got such a void in healthcare that you're going to see a lot more hiring. It's going to keep going and going. So overall, look, to me, the market, we're still going to see tech lead because they're recession resistant, forgetting about the ad spending, et cetera. And that's where I like to put my money. So I'll be looking to rebuild those positions. I still have core positions there, but not the size they were, because I sold before the end of the year. I still think that's the place to be because I don't have as much economic sensitivity as some of the other areas.
Jenny, you said that you agreed with Jim that the story is still intact after this week, but I look at some moves that you made and I see what feels to me like a little bit of nervousness about where we're at. Look at stocks that have gone up a bunch, ones that you own, and now you're trimming Uber for the third time, right? You've sold Iron Mountain, you sold Seagate. Tell me about these moves.
Don't forget United Rentals, Iron Mountain, Seagate, Uber, as you said. So
you trimmed United Rentals.
Right, and this is not a macro call. This is literally like portfolio management 101. You look at your portfolio, you look at the positions, and you say, what's the opportunity cost of continuing to hold this? How much more upside is there from here? So United Rentals, for example, we first added in 2017 at 77. It's up 600%. Historically, it's traded at 10 times. Now it's at 13 times. So we take it down from the 5-ish% position that it grew to down to 3%. Ditto for Uber. On Uber, it's a little like more of a fun story, and we can get back to that debate that we had with Brad Gerstner, where he's saying, look, there's way more long-term potential there. I think I agree with him.
He's not the only one.
No,
right?
he's
there are
not.
many on this show who own it and say now's not the time to get out, that this thing may be just getting started.
But then there's also analysts who are out there like, putting $62 price targets on it, $66 price targets on it. And as a portfolio manager, you need to say to yourself, if I only have 10% more upside in this, am I doing the right thing by my clients, continuing to hold that? If I think in short order, I can buy something else that over the next year or 2 years has 20, 30, 40, 50% upside. Now let's go to Iron Mountain and Seagate, where those were full exits. Seagate we bought a year and a quarter ago at 56 bucks. Seagate is really interesting because when I bought it, everybody hated memory. This is my third time owning Seagate and making a decent return on it. You buy memory when everybody hates it. You sell memory when everybody's positive on it. So the stock goes from 56 to 80, a 5% yield to an under 4% yield. You take your money, you get out. There's limited upside from here. The valuation's right. The yield's down to under 4%. I am quite certain that within the next month, I'll have something in the portfolio that replaces it with a 5.5% or better dividend yield, because the objective is in this portfolio, right, the equity income one, not the one that has the Uber and the United Rentals, but in the dividend one, it's maintaining this 5% yield or better, so you need to recycle. Iron Mountain, I actually bought in 2015, and that's it kind of languished for a long time, had a really juicy dividend yield, so I could sit with it. But Iron Mountain, which you all know from the the document storage, right? Just like you send your boxes of legal documents, they put them in their warehouses. They've also very quietly, and this was always the investment thesis, in the background been building up these data warehouse centers. Well, this year when data warehouse became extra hot again, this share price was up. What was it up? It was up over 40% this year. And now I've got a real estate investment trust with an under 4% dividend yield in the portfolio. And don't forget, that's not qualified dividend income. So even though it's under 4%, it's really worse on an after-tax basis. Same thing here. Maybe there's upside in Iron Mountain. I'm not saying either of these are bad, but they don't fit the strategy. And I think my upside, even just from sitting in cash for the next month, is probably better on both of these. I've got a nice short list of potentials. I don't know which I'll own, but there are things like UPS, which I've talked about, like Wendy's, like Ford, KeyBank, which I mentioned last week. I don't know which of those will make it in. Maybe it'll be something different. But when I buy those, I will think to myself, there's more upside in that new investment than there was sitting in these.
All right, then you'll tell us if you make a move there, of course. Jason, you trimmed ServiceNow, which was a huge winner, and I know how much you like Bill McDermott. But why trim that now?
Yeah, so, I mean, for me, listen, the stock was up 82% last year. Had a very difficult 2022. But what I know is enterprise software spend is slowing, right? We have to reposition this name. Again, I love the story, IT services. They do great work, streamlining workflows. And the integration, I think their long-term story is a lot more growth going forward. But again, when the stock has moved 80+% in a year, it's time to retrim it and look elsewhere for other opportunities.
So, Jimmy, I look at, this is a pretty interesting stat we got from the Flow Show out of Bank of America today. Highest cash inflow ever for a first week of the year. highest ever for the first week of the year.
I contributed. You're welcome.
in what has been a rocky week. Now, we'll get more specific in a moment, but what do you make of that?
FOMO. I mean, don't you think it's just fear of missing out?
Or cash?
What?
It was cash inflow,
I thought there was cash. I thought
cash in. Cash inflow.
You didn't participate.
Not cash raise,
I misread
cash
it.
inflow.
Yeah.
Cash
You
inflow.
were on the other side of that trade.
Yeah. So,
Exactly.
no, let's just make sure we're talking about inflows into the equity markets.
Inflows. Yes.
Okay. So, look, I mean, the tone has changed. I'm sorry to repeat myself, but the tone has changed from the last 22 months. The last 22 months has been, how high is the Fed going? How badly will the economy react? How badly will profits drop? We're not talking about that anymore. We're talking about when will cuts occur? How many of them will occur? And certainly there's a great debate about it. By the way, Steve, totally agree. 6 cuts is ridiculous. But the tone is completely changed right now, where people are rotating to be back on the balls of their feet in terms of investing, instead of rotating to their heels and saying, okay, I'm comfortable in cash. Look, cash still yields whatever it yields, 5.25%. But people recognize, just look at the last 2 months in the stock market, that you can make twice that in 2 months. And so I think it's as simple as saying FOMO, fear of missing out. And you know what? It's right. There is something to be missed out on here.
Yeah, I mean, and it's all going to come down, I guess, Weiss, to earnings, right? Yeah. Next Friday with the banks really kicks things off. Wells Fargo's Chris Harvey is talking about a reverse hat trick, and he's talking about the introduction of underwhelming guidance to start earnings is likely to remain a near-term net negative catalyst. We just talked about all the catalysts. Jimmy gave you a list of all the catalysts to keep this thing going and why he's so positive. Are we taking into consideration what might happen with earnings season?
I don't think we are. I think purely what we saw this past week has been people that have been looking to sell for months and just said, I'm going to ride it, number one, and then I'm going to delay paying taxes on my gains. So I'll wait till the first week in January, which is why I sold the last day of 2023. And that's what we've seen happen. So I don't think you've seen any displacement in the optimism. And people are not focused on earnings at all. As a matter of fact, when you hear a lot of the strategists talk, aside from what you just mentioned, earnings are an afterthought. It's the Fed cutting, it's that the economy is strong, et cetera, et cetera. And my view is that the economy is not that strong. Services, sure, but otherwise, no. We've been in a manufacturing recession for a long period of time. I don't see that changing except in industries that are going to be funded by the largest of federal governments. Okay, they'll keep going. So what I'd say is that earnings, I think they'll be fine. They'll meet guidance. They always do. You know, even in bad times, 75% of the companies do better. But I do think the guidance will take a hit. This isn't the quarter where that's going to happen, though. Where the big
guy
is.
over here,
it's going to be second quarter.
I know, is waiting to disagree with you.
Well, but on a somewhat minor point, I think people are focused on earnings. At least I am. Okay.
I am too.
And I think anybody who's running a portfolio,
But you're professionals.
Hang on.
You're professionals.
Okay, that's fine. Anybody who's running a portfolio is saying earnings better come through. I mean, seriously, if they don't, then you're right, all right? And I'll come on the air and say that to you. Earnings have to come through. We're projecting
I'll call
11.
you from on air.
I'm sure you will. You're projecting 11, 12%. The analyst community is S&P 500 earnings.
Is that a little
growth
too
this year.
optimistic?
Yes.
He says
I'm not
yes.
sure it is.
Here's why I think it comes through, all right? Let's just put this together. There's 3 components. One, GDP, real GDP is growing, okay? That helps the top line. And that is cemented by a consumer that's strong. I mean, those 200,000 jobs today, that matters for consumption, okay? The final thing, and this is where I think people are missing things, margins will improve. Why? Because the PPI, this is subtle, folks, but important. PPI has been much, much lower than CPI, and that is the cost of raw goods. CPI is finished goods, basically. That's where margins improve, is that differential between PPI and CPI.
Jenny.
So here's what I think about earnings. Everyone I know is super focused on them. And I think it's going to be an interesting season to watch because I suspect that earnings do come in. I actually think mathematically we can get to that 11%. And what's going to be interesting is in Q1, I expect we see things like we saw at Nike and FedEx, where they make the earnings, but what's behind it was ugly, right? Like headcount, CapEx reduction. We had to pull levers to get there. Earnings are made, but not because the economy is so strong in the beginning of the year and revenues were good and that supported earnings. But what I think could be really interesting and support not just the consumer, but corporations, which we're not really talking about too much, is as interest rates come down, as energy prices have come down, and they have, don't forget, this time this time last quarter, oil was at 90 bucks a barrel. Now it's at 72, 73. So I actually think that these quiet little things that we're not really highlighting put the wind at the back of earnings and get us to that 11% total growth on the year. I don't think that's that spectacular. I think it's a mathematical equation that plays out. I think one of the things we need to focus on with your and my enthusiasm, right, is actually where to be invested next year.
Well,
and again, I really don't want to be at the broad macro level. So when you see, So when you see me actually having a spring in my step for the first time in a long time, I'm enthusiastic because of the have-nots. And where I want to focus next year are the companies that don't need 3 rate cuts to get there, right? The companies that don't need to pull levers to get there. And I think there's a lot of those out there. When we take out that narrow sliver that performed last year, valuations are fine, earnings growth is fine. I think there's a lot to do with
the comps are easy for the first 2 quarters. You had negative earnings for the first 2 quarters of 2023. So they should recover somewhat. But here's what keeps gnawing at me, is that you can't go through that massive tightening cycle without it really severely impacting the company. You can country. You can delay it, but you can't avoid it completely. So last year was driven by multiple expansion. This has to be the year of earnings expansion to support that multiple expansion. Otherwise, that's where you could run into trouble. And that's my concern. I'm not bearish. I'm going to play the names that I'm playing. I do have a lot of cash right now, and I'm looking to deploy it, but in the names that I think can withstand a declining economy.
The other question I have, Jason, is whether the market suddenly has an Apple problem. Because it's the worst mega cap of the week. Right? It's the biggest stock in the market. Right? $3 trillion in market cap. It's down 5%. As I said, worst market cap. It's made up nearly 20% of the NASDAQ 100's losses this week alone. You've got a couple downgrades this week, which you don't often see. Maybe you see one here and there. You rarely see 2 in the same week. We ask this question all the time. As goes Apple, so goes the market? Question mark?
So I think with Apple, as it pertains to Apple, it's always a narrative shift. I think, to your point, the largest company in the world, revenue growth has been declining, right? You have a multiple of 30 times forward, with a long-term growth rate of almost 10%. I mean, this is a spread that's troublesome for a lot of folks. And I think all the time when there is volatility in the market, that's when we start to talk about the multiple, right? So the multiple's a problem anytime we start to see some volatility.
Well, I mean, when the stock goes up, near 50% last year, when you could make a credible case that the fundamentals of the current periods didn't justify a 50% move. In other words, if I told you at the beginning of the year, you know what, Apple's going to have 3 consecutive quarters of negative revenue growth, but the stock's going to be up 50%, you say you're crazy.
100%.
Based on what?
100%. And I think last year, and going into last year, Apple was a defensive play. Right? So now,
and iPhones are going to be weaker, and smartphones are going to be weak.
100%. And now this year, again, we're only in the 4th trading day of the year, so let's not cast this big story on what 2024 is going to be all about for Apple. But now it's a source of funds, right? It's down 5+% in the first week. But again, when you look at the multiple, you look at the long-term revenue, you look at the revenue growth, and you look at the long-term growth rate. Yes, of course, it plays right into what's happened.
I mean, Jimmy, now Foxconn guidance overnight. Is that another warning sign for the biggest stock in the market we need to pay attention to?
Yes. I mean, forgive the quick answer, but yes, you do.
But I always hear, too, that, Apple doesn't matter to the overall market as much as it used to. It doesn't matter. I hear that from when I raise the question, that's the comeback from many. Is that, in fact, true?
That's where I am. So, I mean, first, just some math, right? Stock's down 9% from its recent high, more or less. S&P 500's down 2% from its recent high. Now, the S&P is down as Apple's down. I'll give that correlation. But it's not down to the same degree. And look, the simple math, we know this. If the Mega 7, the Magnificent 7 are 28% of the S&P 500, that means there's 72% that's not those names. And I think, actually, you're not only seeing it in the last week, but you're seeing it over the last 2.5 weeks, that there can be a catch-up trade. Now, it certainly doesn't help. You don't want Apple going down another 10%, but folks, it could happen. And I said this yesterday, I'm going to say it again. When you get the sort of return, Scott, that you were just saying, what, 48% last year for Apple, or let alone the 200% for NVIDIA last year, you have to accept the volatility that comes with it. There is no free lunch. And I know we're talking about Apple, but I think the comment I'm making is more writ large with NVIDIA last year. July, it goes to 500, promptly sells off 20%, 20% down to 400. People are saying, oh my God, we're going to fill that gap. Then it pops up. I'm not going to talk about the gap. It pops up 25% to 500. comes back to 450. If you want to play this game of those sort of multi-double-digit returns or triple-digit returns, you have to pay for it in volatility. My advice to people in this regard is not to go say Apple's broken or sell these Magnificent Seven, but as Jenny would say, because you said it earlier, it's about portfolio management. It's about risk management. Choose your sizing. I'm underweight in Apple because I do think there's a little bit more downside. If it goes down 10%, I'll probably add to it from there.
I'm watching Microsoft Weiss too because it's $2.3 billion, so it's near $3 trillion in market cap.
Yeah, look, those are great headlines, great things to talk about, but what I see with Microsoft is a permanent compounder. I love permanent compounders, number one. Number two, AI is going to be huge for them. It's going to allow them to increase pricing, which, by the way, they've done on a couple of products already. It's going to require new subscriptions to get full access to their AI toolbox. So, to me, it's the premier AI play out there.
Trillion, I meant to say, obviously.
Yeah,
not billion.
So it's so why not? So is the multiple a little stretch at this point? Yes. Do I see the earnings growing into that multiple near term? Absolutely. And by the way, I'm not going to trade around this. The gains are too big. I'm too much a believer. And where would I put my money in? What's the next best Microsoft? Well, for me, that's Meta. So those are two of my largest positions. And I think that, again, the permanent compounders, not they permanently go up every day, but over any time frame, you're going to see stocks higher.
But that's not necessarily true, and I keep dragging us back to this.
It's been true with Microsoft.
Okay, but not really. You can look at Microsoft from, I think it was 2001 until 2013. The stock was totally flat, and it had had that huge run going into that. So what I struggle with,
why, right?
Oh, well, yes, but what I struggle with now, and I mean this like literally as a question, not as picking a fight. Right. What is the realistic return potential of Microsoft next year and the year after that?
You know, to me, I would expect them to do at least as well as the market, at least as well.
Okay.
I don't expect a 100% move again from the bottom like we had, but, you know, it's not the same company that it was. And I didn't own Microsoft during that time.
And so if you think the market's going to be up 8% next year?
Ballmer, you know, he's turned out to be a much better basketball team owner, than he was a CEO during that point. So you've got somebody in there that expresses strategy clearly, that has a clear strategy. I mean, how brilliant was it to invest when they did in AI? They've got $13 billion in there. Those are the type of moves I like.
I just think it's interesting to think.
And it's a subscription model now. Subscription model now, which is, you know, deserves a big premium.
Still going to take the break. All right, coming up, portfolio plays. A bunch of committee stocks are on the move right now. We have calls on them too. Retail, cyber, energy, and many more. We'll do the trades next.
humanly possible.
All right, got a number of stocks on the move. With committee ownership, want to hit some of those. Costco reported those sales monthly after the close yesterday, jumped almost 10%. Reiterated buy today. Jason Snipe over at Deutsche Bank. You own this one. There it is.
Yeah, listen, Costco's been a beast over the last year. So what I will say, I love the renewal income stream, from the membership cards. I mean, that has always been a great piece for Costco ownership and the growth of the stock. Listen, I mean, e-commerce was up 17% as well. Sales were up 10%. In the U.S., they're up 7%. In Canada, they were up almost 13%. So they are growing nicely. It's a nice multinational to own, and we continue to be bullish on the name, especially with what I will also say about the discretionary merchandise. That is also improving, and they have a very healthy consumer that shops there.
What about $740? That's the price target that B of A has on this. Does that make sense to you?
You know what? The only drawback I would say with Costco is it is an expensive stock, right? So 740 is somewhat of a stretch. If you're looking at retail, though, I believe it is the banner name. It's the one to own. So I'm comfortable with the price target.
All right, Jenny, Palo Alto named top pick over at Jefferies today. It's a reiteration of their buy price target to 350 from 285. What do we think? Because those shares are up a ton, too.
Right. I think you'll be unsurprised to know that when we were talking about selling, this is in the growth portfolio, when we were talking about selling trimming United Rentals and Uber, the conversation was also about Palo Alto.
Well, why didn't it lead with Palo Alto? Why didn't the conversation lead with Palo Alto in terms of trimming? Why? You know what I'm saying?
That's a
the
really
stock's
good
up
question.
110% in a year.
I think the answer is, I don't remember which of those the conversation led with.
Well, you didn't trim it. Why not?
Why
it's
did
up
we not?
300% in 5 years, so why didn't you trim it?
This is the challenge, right? So you have a company that when we bought it, by the way, this is wild. We bought it 6 years ago. It's up 550%. When we bought it, had this huge 5-6% free cash flow yield. That's down to 3.7%, trading at 46 times earnings. And so here you have, it kind of goes to Steve's point on Microsoft. You kind of have on the one hand, of anything out there, Palo Alto should be a permanent compounder because we know there is no end in sight ever to cyber threats. And they are at the heart, at the center of cybersecurity protection. So you're struggling with this valuation, this huge run up. But on the other hand, you have endless demand for their services. And it's just a struggle right now. It's the reason we didn't, it's exactly the reason we only trimmed Uber and didn't sell all of Uber.
As you were describing that, I'm thinking Uber. Yeah. It's endless demand.
Right.
All the other things that you said as well. Yes, it has an elevated valuation, but you're paying up for that.
I mean, check back in a week or two. I wouldn't be surprised if it leaves the portfolio, but it's just not that expensive.
I don't want to talk into anything.
Okay. It's a really hard one. It's a really, really hard thing to figure out. What does that 3.7% free cash flow yield become?
All right.
Does it grow? I'm not sure.
Jimmy, ExxonMobil and Chevron named top picks at B of A. A lot of people are trying to figure out where energy stocks are going to go this year. These two stocks among them.
Yeah, and to say the least, energy stocks and these stocks were disappointing in 2023. We know that. I do think that energy prices and these stocks are going higher. Now, why is that? For one thing, China. Look, it's hard to imagine, famous last words, hard to imagine Chinese growth getting worse. It could, but it's hard to imagine it getting worse. And the government there is talking about things to stimulate the economy. That will be good for global oil demand. What's probably more important is the strategic petroleum reserve, which we're going to spend at least the next couple of years refilling. It's at half the level it needs to be here in the U.S. That's going to place an upward demand on energy prices and on these stocks, if you ask me.
Okay, so we're going to get the headlines with Bertha Coombs. Hi, Bertha.
Hi, Scott. The Biden administration announcing today that it's preparing military support and aid to Japan after that devastating earthquake on New Year's Day that killed nearly 100 people. Military logistical support, food, and supplies are being sent. So far, Japan has rejected offers of aid from other countries, including China. The former Capitol Police officer who came face to face with that violent mob on January 6th is running for Congress. Harry Dunn announced that he's running for Maryland's 3rd congressional district on a platform of infrastructure, mental health, and crime. He called the January 6th protests one of the biggest motivators to run for office. And Tokyo's Toyosu Fish Market started its first auction of the year with a pricey bid of bluefin tuna today. The 238 kilogram, that's 525 pounds, tuna sold for 100 million yen, or 788,000, I think, there in dollars. That's more than 3 times the highest winning bid at last year's first auction. Makes you want to have a little sushi, doesn't it, Scott?
Yeah, it's going to cost you more, though. Bertha, thanks. Bertha Coombs. All right. Yields are ticking up. Stocks are ticking down. When we come back, betting on a big surprise. The committee laying out their top contrarian ideas. We continue that series next.
CNBC.
All right, as you know by now, all week long, the committee's been giving us their contrarian ideas for 2024. We want to continue that today. Jenny, you are first. Yours is what?
Commercial real estate, specifically offices.
Lean into it. Buy
Okay,
it.
lean in, but not broadly. Don't go out and buy indexes. I'm looking at a headline right here from the Financial Times that reads, U.S. office owners face $117 billion wall of debt and repayments. Pain likely to be widely spread. If you read that and you think, oh boy, get out of commercial real estate, stay away, you are going to miss some really amazing opportunities, because it is not all created equal. And the devil is in the details here. If you have the patience, skill set, and time to say, I'm going to put that headline aside and see what's really going on, I would say look at SL Green, which is in our equity income strategy, look at Boston Properties, which we own for some clients, look at Cousins, which I don't own but I love. All of those have extremely well-capitalized owners, extremely well-located buildings, Class A buildings. They're the survivors. What you don't want to own is you don't want to own the crummy little buildings. No offense to them, but Empire Realty, for example, yes, they own the Empire State Building, but if you look at their portfolio, the vast majority of it's in the garment district. They're not able to get the rents that these other three kind of gems are. If you look at Vornado, there's a lot, you think New York City office, but you look at it, there's a lot of multifamily in there, there's a lot of retail. They're very different. What you see in New York City, and I'm going to cherry pick this to make the point, what you see in New York City is quite extraordinary. So you see that $117 billion. But when you dig into an SL Green, for example, last year, they refinanced $3 billion of debt. almost all of that was done at the same rates that they were at. Actually, one small part of it was done at 3% less than what the previous terms had been. When you think about New York City real estate, right now there's 400 million square feet. Expectations are for 50 million square feet to come out of New York City over the next few years. So actually, supply is diminishing. That puts the wind at the back of the Class A, well-located, well-capitalized owners. If you look at the Park Avenue corridor, which is Grand Central Terminal up to 57th Street, rents are actually going up. That is hot, hot, hot real estate. So look at that. Look at Cousins, for example. Cousins has Atlanta, Dallas, Tampa, Charlotte, amazing properties. Stay away from San Francisco, stay away from Seattle, but don't let that headline scare you off. Don't succumb to the negativity of it.
Okay, Jason Snipe, bet on
biotech. Man, biotech.
Been a tough run, right?
Has had a very
slog.
Yes, 3 years down 3%. The last 10 years, it's up only 6%.
Okay,
so
why is it going to be different this year?
So, well, let me explain one more point that I think is that's hard for folks to kind of get behind in an election year. Price control is always on the docket. You know, when there's an election year, newsflash, there's election in November, right? So
yeah,
that
both
is
sides like to tee off on the
100%. It's a highly contested political issue. But what I will say, as it relates to the IBB, which I do own, which again we haven't seen any real growth there. Free cash flow is starting to grow again. So there might be some M&A activity there. Also, what I think is interesting, you know, about the sector as a whole. I know you own Vertex, Jimmy. Is pipelines. Pipelines are starting to develop and get stronger. So there's less R&D there. I mean, there's been some R&D spending. A lot of that is kind of behind us. So IBB is the one for me.
Okay. Weiss, my contrarian play for you is you're going to smile more in 2024. That's my contrarian bet.
Sure to exit.
It's a big value play.
Yeah, you're losing, baby.
I'm getting in big.
Yeah.
What's your
shorting
play
that.
here?
I do smile on some shows. For obvious reasons, not this one. My play is energy. So I think energy is going to disappoint. You know, Business Insider did this survey and went through 12 investment banks. Energy was the #2 most favored sector. So guess what's changed with China? They're the leading EV buyer in the world. That limits their use of fossil fuels, #1. #2, you've got wars to support. So you got countries like Russia and Iran, which are going to be pumping more oil than you can ever use. Number 3.
You're just not buying the bounce back story
I'm not.
that some are calling for.
Look at oil before 2021, right? Or 2022. For 10 years, it was flat. Look at the stocks now. Chevron, Exxon, they still haven't done anything over the 10-year period. So I think people are going to be sorely disappointed. It's a market driven by speculators who go one way, then go the other way. And I just think the underlying fundamentals, the demand story, and the production story are out of balance, will continue to be.
All right, good stuff. Coming up, so we got Mike Santoli joining us, and we're going to trade some of this week's biggest winners and biggest losers. We'll do it next.
50% off.
We are back. Our senior markets commentator, Mike Santoli, joining us now for his midday word. We call it your end of week word, too. I suppose. What's your takeaway from what we've witnessed this week?
Well, it's interesting. Everything, from the top-down perspective, if you just look at, 2% setback in the S&P 500, a little more than that in the NASDAQ, it seems pretty routine, and the character of the rally late last year did win the bulls somewhat of the benefit of the doubt that this pullback should be healthy. But you also see, I think, the fragility of the conviction levels of people who either want to see the economy remain resilient or those who feel as if the best bet is to have a more early and rapid easing cycle. So I don't think we resolved anything of that. It's interesting. You could have had either narrative this morning. Is the market seizes upon good news, a strong jobs report, and it bounces off the lows. Then you had the weaker ISM services. People say, aha, the market really wants bad news, so we get a sooner ease. Well, now we're flat. So it's sort of enough to confound everybody. I still think it's a low volume kind of sell the winners response from late last year that might morph into something more if we don't get any reassurance that growth seems okay for the first quarter.
I mean, we really loved, the 10-year going below 4%.
Yeah.
We don't love so much when it's back above it at 403, and it's been a steady climb this morning, albeit not that much, but nonetheless,
yeah,
we are back at 403.
I mean, it's a little bit of a more just like a brushback pitch of the most bullish scenario. I think 4.25 matters more. I don't think 4% is a weird or tough to absorb level if we're talking about normalizing toward 4% GDP, nominal GDP, which is 2% real, 2% inflation. That's where the 10 should probably trade. Corporate spreads have been really tame here. So I don't think alarms are being set off, but it does show the sensitivity we have. We're just retracing stocks and bonds back to the December Fed meeting levels.
I'll see you on closing bell. Mike, thank you. That's Mike Santoli. Coming up, dividends in danger. One firm raising the red flag for 2024. Already a rough year we're coming off. So we're going to debate that next.
So in 10 minutes time now at the top of the hour, we see the release of the weekly Baker Hughes rig count numbers. Total rigs prior 622, oil rigs a prior of 500.
All right, welcome back. How about this from Wolf today, Jenny? I'm looking at you. We expect to see more dividend cuts in 2024. as economic growth slows. Now, I mean, Wolf's been more negative than most over the last 6 to 12 months. We know that Walgreens cut the dividend this week, right, for like the first time, I think, in something like 50 years.
Yeah, but it's been expected for like a decade.
Stock got smoked. How are you thinking about this?
I think it's a silly comment to make. What we saw at the worst of the pandemic was Goldman put out a report that basically said the same thing. 11 months later, they're like, oh, dividends are wonderful. If you look to history, there's no precedent for companies broadly cutting their dividends. You see dividends growing from $485 billion in 2019. Next year, they should be $614 billion. Every single one of those years, including during the pandemic, you see dividend growth overall for the broad market. If you look at our portfolio and want to use that as an example, in our portfolio, which generally holds 35 stocks last year, we had 2 dividend trims, not cuts all the way, 14 companies increased their dividends. I think that's more likely. I think there's going to always be a company to cherry pick like Walgreens. For me, the last one was VF Corp. It stinks. But the reality is most companies raise, even Microsoft and Apple. Those aren't dividend income, but they're dividend growth, right? Even those guys are raising their dividends. So I think you never bet against dividends or dividend stocks.
Jimmy, you told the producers, quote, I violently disagree with this call.
Violently.
Yeah, well, I do, because I've been saying this for
Watch
quite
out.
some time. Yeah, you know, all of these companies that have been hated, these cyclical, economically sensitive companies over the last 2 years, you know what they've been doing while everybody's been crying recession? Is they've been out earning. They've been earning a lot of money. They've been generating free cash flow. I'm sorry, Steve, I love you. They've been generating cash balances, and they've been increasing and implementing dividends along the way. That's not going to change as the economy continues to grow.
All right, up next, 2 big winners, 2 big losers for the week. We're trading them next.
In 5 minutes' time now at the top
85.55.
We see the release of the weekly.
All right, 2 big winners, 2 big losers. We focus on Verizon. Jenny, up 7% this week. That's the second best Dow stock behind Merck. You own that. Matson is the other one, MATX, up 6%. It's a U.S.-based shipping company. But you want to talk about Verizon for a quickie?
So Verizon's about as dull and boring as it gets, right? It's got a 7% and change yield. It trades like nothing. Nobody cares about it. Nobody likes it. You know, when we were talking last week, and I said, sometimes you don't need a catalyst to do well. You just need to have future cash flows ahead. That's where Verizon is. It's better than owning a bond. There's like, I don't know, low single-digit EPS growth ahead. Everybody knows what happens. There's huge economic sensitivity. Everyone uses their Verizon service all the time. Don't look for a catalyst, but just know that if you're getting 7% yield, your money's going to double every 10 years, and you don't really need to worry or do too much about it. Just ride it out.
Cruise stocks crushed it last year, not so much this week. Norwegian's down 10, worst stock in the S&P, and then VF Corp is down 9% this week. You sold that just, as we were heading towards the end of December.
Right, and that was another one where it was just a gift, right? They announced earnings, they cut the yield, the stock plunged, robotic algorithmic trading sent it way down, and then people are like, oh, actually, their cut of the dividend is good for the business. Stock ran up. I thought pigs get slaughtered. I listened to you on Nike, Jim, when you were talking about getting out of Nike, and I thought, same kind of story there. Let's not play with fire. Get the heck out and take your profit while you can. You just got lucky.
All right, we'll take a quick break. We'll come back and we'll do final trades.
Shortly expecting the US Baker Hughes rig count numbers. I'll be leading with the oil rigs.
Well, we're going to assess the week that was today on Closing Bell with Courtney Garcia and Tom Lee. Find out what he thinks happens next week. Got a lot on the plate between CPI, earnings begin. So we're going to watch that closely. I hope you join me 3 o'clock Eastern time. Big interview, by the way, on Monday as well. Kathy Wood of ARK Invest is going to be with us. The CEO, CIO, halftime report. That's 12:30 Eastern time. So a couple things to look forward to there. Let's do final trades. Stephen Weiss, your first.
GXO. So this isn't a hedge intentionally, but it is a hedge. If I'm wrong on the consumer, GXO is the #1 independent 3PL, phenomenal, automated, all the big brands, Apple, Nike, et cetera, et cetera.
Farmer Jim.
CVS clearly breaking out. It's a favorite not only of mine, but of Jason's and Surratt's.
Okay, Jason.
So I like Marriott here. Consumer discretionary earnings will be very solid this year, and I like Marriott.
All right, Jenny, what you got?
My other contrarian play was going to be Aptiv from our growth portfolio. Don't bet against EVs. 14 times earnings, 25% earnings growth ahead.
All right, so S&P's barely positive, Dow's negative. We'll see what transpires. I'll see you in a couple of the exchanges now.
Thank you, Scott. Hi, everybody. I'm Kelly Evans. Here's what's ahead. A stronger than expected jobs report, and Wall Street still sees a 70% chance of a March rate cut. Are they getting that wrong? That's what our economist thinks. She'll tell us why and when she sees the first cut in the cards now. Plus, by one metric, stocks aren't off to a great start this year. Well, by many metrics, but this one says it could set the tone for the rest of the year. So why is our market guest so excited? He's here to make his case and tell us all the places he's seeing opportunity this year. And with earnings season nearly upon us again, we look at three names that Danielle Shea says could be positioned for gains into the print and one she's staying away from. It's all about big tech as well today. Let's start with the markets, though. The Dow was down 100 points at the lows, up 183 at the highs. We're down 0.25% right now. We're going to snap 9-week win streaks for pretty much all of these, even with the S&P fractionally higher right now. Same for the NASDAQ. The 10-year hit a fresh high of 4.103 earlier today, right after the jobs report, but we did reverse lower after the weaker ISM data. Let me not get ahead of Steve Leisman. He's sitting right here to give us the full scoop on all the data.
I actually have an up and down on that. You'll see in this nice chart we have. But here's the thing. I think the stronger than expected jobs report offered markets a lesson in what the Fed has kind of been talking about. The improvement in inflation, the slowing of the economy, it's not a straight line. Though beneath the hood there is some slowing going on. Let me just show you here the top line numbers. Non-farm payrolls, 216. There were downward revisions again of 71,000. 10 of the past 11 reports have been revised to the downside. Unemployment rate, though, down to 3.7%. A tick down in the participation rate, that wasn't good. Average hourly earnings, though, up just a little bit, 4.1% on the average hourly earnings. There was some weakness in the report that I think call it under the hood. It looks to have captured the market's attention here and caused it not to be quite so concerned about it. 3-month average for the total shows it's declined to 165,000 from 334. The private sector has fallen to 115 from 271 last January. So the 3-month average is slowly cooling. Private sector up 164,000 this month, though, but government was 52,000 of the total there. Leisure and hospitality still making up ground from the pandemic. Healthcare, that doesn't matter what's going on in the economy. We need to hire nurses and doctors. That was up 38,000. One leading indicator, though, temporary help, down 33,000. It's been down several months in a row. Other cooling signs, as Kelly mentioned, came from the ISM service sector, with the top line coming in below expectations. The price component and the employment index both fell. And this is what I was talking about here. All this data creating a lot of volatility in the outlook for the Fed. Before the jobs report, a 65% probability that March cut fell to 57% rose to 57% after the jobs report, and then it rose again after the ISM at 68%. All that's to say the market is still pretty sure of that March cut, but maybe now has embraced just a bit more of the doubt. The big question is this. After a year when the job market remained strong and inflation came down, how much should we really care about the jobs market and its impact on inflation?
Let's ask Diane Swank. I bet she has some thoughts on it. Our next guest says diverging data is putting the Fed between a rock and a hard place in its inflation fight, and she thinks the biggest mistake would be cutting rates too soon. Diane Swank is chief economist at KPMG. Well, what are your thoughts today, Diane?
Well, I think Steve did a good summary there. One of the things I would go into is the devil is in the details. And one of the surprises in the report was in the household survey, and that almost all of the loss in employment that we saw in the household survey versus that establishment report, payroll report, was due to the fact that people left the labor force. Mostly those over 55 left labor force just en masse during the month. And that's really stunning. We also had record number of people out on vacation for the month of December. Ever for the month of December. So revenge travel has become systemic now. I think that's really interesting. We had an all-time high on multiple job holders. That in the 2000s, back in the 1990s, it wasn't this way, but ever since the 2001 recession, we've seen multiple job holders rising during a tighter labor market because employers have been more willing to be flexible with workers. Of course, it's a bit of a sad commentary that multiple job holders are necessary in an economy, and I think what we're seeing is none like the 1990s when multiple job holders actually fell as the labor market tightened. We see multiple job holders go to a record high. Those also going on voluntary part-time employment went to a record high this month. So in that data, we also, the wage data, you talked about it only creeping up slightly, Steve. We saw that huge surge in non-supervisory manufacturing wages due to the UAW contracts and some spillover that really surprised me in the retail sector as well. That was not expected, and the gains that we saw there are things that the Fed are watching because they're worried that wages may not come down to be consistent to hold inflation at its 2% target over the long haul.
Well, I just want to bounce the following off both of you, and I was looking back through, some of the real rates and what's been going on with markets, and we've had this big increase in real rates over the past week, literally 165 up to 185. I don't think it's a coincidence that we're seeing stocks stumble in the meantime. And Steve, I wonder if this is because the Fed has been pushing back on the rate cut narrative. We've seen some officials doing so. We saw the minutes kind of doing so. Is the market trying to tell us, no, they should be cutting here? Even the inflation expectations have not picked up.
No.
They're in October, 2.5% on the 5-year break-evens. We're down at 218. So it seems to be saying to them, you have the space, you can take the cuts, but I don't hear their rhetoric kind of setting us up for that.
I don't think so either. I think the Fed has other considerations that it needs to take into account, which is the consideration of what if that is the wrong call? Mm-hmm. What the Fed does not want to be doing is be in the business of reversing itself again. So it's going to be darn sure that inflation is vanquished and extinguished before that happens. I do think, Diane, I need to just warn you that I'm in the process of a conversion here. I'm converting almost entirely to ADP wage data. I'm not quite there yet. I got a meeting next week with Neela Richardson that's off the record for the moment, but is going to create
it's really great data.
Let me tell you what the story I just found out is, which is that the Atlanta Fed wage tracker uses a survey sample of 2,000 employees. Do you want to know what ADP is?
100 and something
10
thousand.
million.
Wow.
10 million. And it's not survey data, it's paycheck data.
No,
and
it's actual. Yeah, no, I'm right there with you.
So I'll tell you that's the reason I did not highlight in my report. Maybe I should have told viewers.
So has ADP wage data been softer than what the BLS just said? It's been coming down.
I doubt Miss Betsy Spring has in the background the chart we used this morning. It's been coming down and coming down carefully. Here's the other thing I know. Powell,
especially for job switchers.
Right. Powell has used this data 3 times. A non-public part of it, he has mentioned it, that they're getting some of this data.
Interesting.
And I'm talking to Neil about us getting this data, making it public. So here's the deal. The deal is that's the ADP non-farm. I'm not yet converted to their payroll report yet, but I am to their wage data because it's 10 million actual paychecks. And they also, by the way, get the actual hours. If I asked you, Kelly, how many hours did you work last week in a survey? You wouldn't know. I don't know. You don't know. But these are actual paycheck data, so I'm very excited about this.
The only thing, and I'm excited because you're kind of making the point that we were just making about maybe that. But Diane, in answering that, just a little bit of a wonky econ question for you.
We can only do that on the show.
Would I rather have a sample than an incomplete full data set? In other words, would it be better to have 1,800 people represent the entire economy than to have 10 million people not quite represent 12 million or something like that? You know what I'm saying?
I think basically we have to use all the data together, and that's what we do. And I love Neela, and I love what she's done with the ADP report and the data. It really is very useful now. There's interesting things in that data. One of the interesting things is that if you pay doctors more, they retire sooner.
Oh, interesting. The other thing, though, Diane, there it is. Look at that. Betsy got it up. I got to give her a shout out on TV. This is the story here. Diane, can you see that chart? What we're seeing here, that's the Atlanta Fed. Guys, you have the other chart, which shows job stayers versus changers. What that shows is the premium to changing jobs is less now than it was before.
Narrowed.
It's narrowed. So it was double digits. Now it doesn't. There it is. So it's just come up. We're doing live television.
Changers orange.
This is action economics right here. And you can see that gap there narrowing, Kelly, right?
Well, Diane, do you think this actually makes the case for the Fed having plenty of room to cut rates?
This is the issue, is that the Fed needs more evidence. The biggest mistake you can possibly make in central banking, the cardinal sin of central banking, is to cut and have to raise again. So, whether they cut in March or May, that's not going to make a lot of difference for the overall economy. But waiting that extra time to get more data, to feel really comfortable that inflation is not only going to the 2% target, but is going to stay there, that is what the Fed needs. And I think that thinking like a central banker is really important here, because that's one error they do not want to make.
But Diane, you don't mind if I interrupt you and just remind you, though, Powell has said we can cut before we get to the 2% target. So there is a certain, how shall I say it, anticipatory nature to the process.
No.
So it doesn't have to be there.
Absolutely.
They have to be sure that they're going there. Here's the question that I have.
Going there, and it's going to stay there.
I'm going to preempt Kelly's next question, okay? I'll see if I get this right. Is 2 more jobs reports and 3 more inflation reports, boom, that's 5. Is that going to be enough to convince the Fed by March? Could it be enough by March if you have the easing of the job market along with 3 inflation reports that show this trend back to 2%?
It could be. There's no question it could be. It's not my bet, but it could be.
Right.
Hey, this is the one thing that I think of Voltaire these days. What is this quote? Uncertainty is an uncomfortable condition, but certainty is absurd. Doubt is an uncomfortable position, but certainty is absurd. And I think certainty about anything right now is absurd. And
Does it matter, Diane, though? I guess the question I have, and I ask myself this question because we spend an awful lot of time pounding the table, March, May, June, July. Does it matter? The only thing I think it matters about is this. Is the market, I think, is very, very anxious to see if the curve will disinvert. And when that happens, it will create a series of potential financing events and things that can happen. For example,
good or bad?
Well, both, I think. I think, for example, if short-term rates are below long-term rates, you might think about a floating note. But when they're on top of each other where they are now, or they're inverted, you wouldn't really want to think about that differential right now. Once that happens, it creates a series of financing things that CFOs, Wall Street investment bankers, they're going to be interested in that. So one of the questions I have gotten from guys is, Steve, when do you think this all happens? Because then that creates this cascade of things like that. Also, it's a more normal state for the economy.
Right, it's better for the banking sector, but I just look back on the history, and is it the bad kind of disinversion that comes when the economy is really slowing?
Right.
Let me give Diane the last word here. Diane, what would tell you that we're really... do you need a negative payrolls report before it's really lights out, and otherwise you think the expansion keeps going?
Well, we need more than one negative payrolls report to think the lights are out on the expansion, given how close we're already nibbling at that. As Steve said, we slowed on private sector employment report. That said, I think a soft landing, it's important to remember that's not the same as no landing. And so if we really do have this slowdown in hiring that does edge up the unemployment rate, that's a squeeze on margins. And that's what we saw in the ISM survey today.
That's a great point. And the employment piece was down sharply. Maybe it's an aberration like people are saying, and maybe not, because it'll be a couple more months' time to see. Thank you both so much today. We appreciate it. Thank you, Diane Swank, and of course, our own Steve Leisman. The Dow is back near session lows, erasing a 130.83-point gain. Let's get more from Dom Chu. Dom, how's it looking?
So it looks just about like the way it did maybe in the pre-market trade ahead of the opening bell on the heels of that jobs number that came out earlier this morning. So we saw what was implied to be about a 180-point downside in the market then. We got the 180-point upside, later on this morning. So we're just about flat on the session right now. So if you want to call this kind of like a Goldilocks scenario, I guess you can say on balance, after everything was digested, things have been taken in stride overall. The NASDAQ composite right now is up just about flat on the session, 14,514. The S&P 500, 4686 is the last trade there, just about flat on the session as well. And the Dow Industrial is lagging just a bit here, down about 0.25%, 107 points, 37,336. An interesting look at the state of play right now. Yes, we're only a handful of days into the new trading year so far. However, if you take a look at the overall picture for this year-to-date gain right now, okay, well, I'm not showing you that, but I'm showing you the intraday moves. But if I was to show you the chart of the year-to-date action, you would see that financials, you would rather healthcare, you would see energy, and you would see utilities as the best performing sectors so far on that basis. Now, let's talk about one of the moves that we are seeing overall today in the financial side of things. We have seen a slate of moves mixed overall, but generally to the upside so far today. Names like Synchrony Financial, Capital One, BNY Mellon, American Express, and JP Morgan Chase are all up on the day ahead of the big bank earnings kickoff to the season next week for earnings pictures. Now, JP Morgan Chase actually gets that kind of star over here because it hit a record high in trading today. But all these other guys get check marks, Kelly, because each of these names hit their own 52-week or more high so far today. So keep an eye on those financials. That's the current state of the market right now. Send things back.
Yeah, you wonder if it goes back to kind of the uninverting curve that Steve was talking about. Dom, for now, thanks. We appreciate it. Our Dominic Chu. Stocks are on track to close the first trading week of the year with 4 consecutive down days, and that could be bad news. The Stock Traders Almanac warns the first 5 trading days aren't open for the rest of the year. But my next guest is a little more optimistic and, in fact, says he's rarely seen this many good investment opportunities. Here with me now is Steve Auth, the Chief Investment Officer of Equities at Federated Hermes. It's great to have you here. Welcome.
Likewise, Kelly.
Especially because your mood is so different from a lot of the, well, okay, maybe it's not as different right now. We've seen a lot of optimism around the turn of the year, but you're saying you really see a lot of opportunities out there, even with stocks near all-time highs.
Yeah, I mean, we're the broader market, Kelly, we're thinking 5,200 as our target for the end of the year, so it's not heroic, probably single-digit return kind of market. Now, maybe we're setting up for 10% off of current levels. But we think the excitement is underneath, because obviously most of the return in the market last year, well known, was the Magnificent Seven, and everything else didn't do much. And now there's so many stocks out there that are still 10, 20, 30, even 50% off their old highs. As we break through, if you get into an economic situation like you've been discussing that's not a big recession, we think it kind of happened already in an asynchronous way.
You think it happened already?
Yeah.
This kind of series of, as we've talked with others, or Steve Leeson, about rolling recessions or mini recessions. Look at the ISM manufacturing, 15 months negative, that kind of thing.
Right. Our rocky landing idea that we were going through an asynchronous recession for the last 18 months, chips, housing, commercial real estate, the regional banks, et cetera. And I think we were going to look back and say, gee, the recession already happened. So once you get to that point, then all these stocks, these higher risk stocks, smaller cap stocks, value stocks, cyclical stocks, emerging market stocks that have been held back because the recession is about to happen, and the date of it keeps getting pushed away.
Right, and you were optimistic all of this year, and the market and the facts have come around to that point of view. So you think it's kind of, we can keep going. Even where we are. And you have some names here. New Fortress Energy, it's a small cap. PNC, the regional bank. Argenix in biotech. Tencent in China. You're not afraid of emerging markets here either.
No, those are the most oversold stocks in the market. And, with the dollar starting to soften up, interest rates coming off, and expectations being so low. I mean, everyone's calling China uninvestable.
Hong Kong, didn't they just have 4 down years in a row on that market?
Yeah, and that's usually a bell ringer. When something's uninvestable and it's in the cover of Barron's, can't invest there. So Tencent, as an example, is, let's call it the Facebook of China, and it's trading at a single-digit multiple. It's down 60% off its highs. All you need is just a whiff of good news, and those stocks are poised to have big moves up.
So do you have a point of view on the Mag 7, which is jokingly being called the Lag 7? You're specifically avoiding that? Is it fine to keep holding it? I mean, some of these were literally considered value stocks a year ago.
Yeah, and I think with the stock picking theme still plays out. We're kind of looking for specific names there. I'd like to look at a Google as maybe a less expensive option. Even Meta, which we talked about 10 cents before. But broadly, to me, the Mag 7 have great fundamentals. People know that. The stocks price those. They'll do okay. We have them as market performers as a group. And so within that, I think you can make a little bit of money. But I don't think that's where you're going to make more than single-digit returns this year.
And one interesting thing, given the discussion we were just having about, is the data pointing to the Fed, giving the Fed urgency to cut or not. You're more in the camp that thinks we aren't going to get as many cuts, And I'm sure you looked at the jobs report this morning and thought, yeah, that's what I'm talking about.
Yeah, it's just not going to happen.
Sure?
Yeah. I have to invest money, so I have to have a base case. I could be wrong. But, we kind of try to understand the Fed based on the psychology of the institution and the guy running it. Right now, Jay Powell embarrassed himself 2 years ago when he took too long to hike. And he's sitting there. His guys have done the study, the 70s Fed, Arthur Burns. They cut 3 times early. Then they had to, hike again. And he doesn't want that to repeat. He has 2 goals. One is full employment and one is inflation. He's at goal number 1. So it's not like he needs to cut to get employment to be better. It's as tight as it's been in a long time.
At 1:30
and he's still not at
Eastern
hole
time,
number
we
2.
expect
And
comments from Fed Spark
well,
and
even the
speaks
wage
to the
number, I
Maryland
know people are
Bankers
saying the hourly,
Association.
there's different
Next is
reasons, but it
expected,
was
as
what?
well
It was
as
a
a Q&A
positive
with the
surprise
audience
today,
and
right?
media.
It's still running at 4%. And that is in a structurally tight labor market, which he sees, which is sort of the supply side problems he had in the 70s. It's going to be very difficult for them to kill inflation. It's going to stabilize, our guess, between 2 and 3%. Not terrible, but there's no anxiousness to cut. And by the way, one reason I'm so confident about no 6 cuts, it's an election year. Once you get to the July meeting, he really can't cut until December.
Because it'll look too politically.
Yeah.
Quick final comment. Then we spoke with David Bahnsen the other day, who says, look, this market could be range bound for years because it's fully valued. It's 20 times. You know, the earnings expectations are simply already too high.
Yeah.
Do you have a response to that?
Yeah. This is what we haven't broken through to the old highs yet, Kelly. So we're still in a bear market, and this is like 2013. Everyone's saying we can't go any higher because everyone had that double top on the S&P in their heads. Same way here. When we break through, and we'll do it with these other stocks that are not anywhere near overvalued. A lot of the stocks you just mentioned are in single-digit multiple range here, low double digits. So there is room for the broader market to move higher without being remotely overvalued at these interest rate levels.
All right, Steve Auth, with the confidence and many ideas that you mentioned, thanks for joining us today. It's
Thank you, Kelly.
With Federated Hermes. Still coming up, crude is on track for its third positive week in 4 as the situation in the Red Sea continues to worsen. Energy expert Dan Yergin joins us after the break with his thoughts on where the conflict and oil prices could go from here. Plus, 4 big banks kick off earnings season next Friday, and big tech's results are right around the corner. So listen up, all you retail options traders out there. Our trader will tell you which names could get a pre-earnings boost in today's 3 Buys and a Bail. Stay with us.
This is The Exchange on CNBC. Athletics.com.
Welcome back. Oil is about to post its third positive week in 4 as Houthi strikes continue to keep Red Sea commerce at a near standstill. Shipping giant Maersk saying they will divert all vessels south around Africa's Cape of Good Hope for the, quote, foreseeable future. Here's what U.S. Department of Energy Secretary Jennifer Granholm told Squawk Box this morning.
This conflict itself has really only had a limited impact on energy prices. You know, for us in the U.S., the gas prices, for example, are at $3.09 today, 3.089, something like that, more than $1.93 lower than the peak after Putin's war. 30 states, the average is less than $3 a gallon. So we aren't seeing the price per barrel or the impact at the pump. But obviously, the United States is on it and is leading this coalition to protect those commercial shippers.
Let's talk to our next guest about where we might see the biggest fallout as this conflict escalates. We're joined by S&P Global Vice Chair Dan Yergin. Dan, it's great to have you here. And how serious a conflict is this?
Well, I think it's serious, but it could get more serious. Obviously, we're starting to see an impact on oil prices, geopolitical risk coming into a market that up till now has really been dominated by supply and demand, and the supply exceeds demand. And the Houthis show no sign of backing off. And so I think the next stage would be if you saw a real response. And we've seen Maersk today saying, for instance, they're going to stop sending their ships through the Red Sea for an indefinite period of time.
What does the behavior of the oil price tell you, or is it too soon to know?
Well, I think we're starting to see that oil price that really hasn't responded to geopolitical tension, to what's happening in the Middle East, starting to respond. The reason it hasn't responded is because of this phenomenal growth in supply from North America. That today, North America oil and gas is greater than the production from the Middle East, which has been a real stabilizer. But the Red Sea has become an important channel for oil. Before the October attack by Hamas, about 40 oil equivalent to about 40% of what was passing through the Strait of Hormuz was passing through the Red Sea. That number is now down to about half that.
Wow. We spoke with Amrita Sen the other day, and I asked her if we should expect, bigger sanctions enforcement on Iran as this ramps up, which could obviously affect the global oil supply. But she said it might not because so much of that Iranian oil is going to China. It's circumventing the U.S. dollar system, kind of implicitly sanctions. Do you think that's true? How should we be thinking about the risk of losing some of that supply into the market?
I think it could be certainly tightened up. I think we could see the sanctions stepped up. Also, there are other things going on. There's a disruption in Libya, about 300,000 barrels a day. So there is an overhang of supply, but so much of the tension basically revolves around Iran and its proxies in the Middle East and the increase in violence. And we've seen the U.S. responding to the 120 attacks on U.S. troops in Syria and Iraq with this takeout of somebody, a militia leader in an Iranian-led militia leader in Iraq. And I think you have to be very concerned with the Houthis, who seem to show no restraint and are clearly guided by Iran, including Iran providing them intelligence on which ships to attack.
So as a student of history, where would you be watching for this to broaden out or escalate further? And if it's kind of watching markets and the oil market and thinking, well, again, it doesn't look overly exercised about what seems to be a widening conflict. What does that tell you?
Well, I think the big difference from the past is the position of the United States, Canada, and the Western Hemisphere. And if we just look at supply and demand, there's more supply coming into the market than demand in 2024. I think it would be if you started to see real disruption, and we haven't seen that. And what you can see is that tankers simply go around the Cape of Good Hope, so it adds costs. But I think there's just this general nervousness. The other thing, Kelly, is that about a third of container ships go through the Red Sea. Yeah. And so it's not just oil and gas, but it's the overall supply chains. We thought that disruptions were behind us, that part could, as we go into February, that could be a bigger problem.
No, it's fascinating to think about the implications here, where our ability to increase our own energy supplies might undermine the urgency with which we tackle the Mideast situation. In a way, if oil was at 130 and the price of gasoline was upwards of $4 a gallon, I have to imagine we'd be seeing a lot more going on to try to restore calm to the region, don't you think?
I think that's absolutely true, and I think this is an election year, and I think from the viewpoint of the Biden administration, there are enough problems in the world that it doesn't need more. And so I think at this point, it will try and deter the Houthis. And if it stays where it is, we'll see an impact on price, but not a dramatic increase that would really cause a greater sense of urgency. But I think the position of the United States, by far the world's largest oil producer, it has been not only a rebalancing supply and demand, it's been a rebalancing geopolitically as well.
Oh, it's fascinating. And in the meantime, like you said, we'll see if it does put more upward pressure on inflation in the months ahead. Dan, thanks so much. We appreciate your time today. Dan Yergin from S&P. Still ahead, earn while you learn. That's one way to try and solve the historic shortage of U.S. construction workers. We'll have those details coming up. Plus, the bear case for Airbnb. It's begun, according to Bernstein, but they say they're the last bull at the rodeo. Expecting strong growth in the year ahead. The analyst joins us to make his case, with the shares still down nearly 40% from their all-time high nearly 3 years ago. Don't go anywhere.
/higher.
Welcome back to The Exchange, everybody. I'm Tyler Matheson with your CNBC News update. House Republicans plan to move forward next week with holding Hunter Biden in contempt of Congress. The president's son defied a congressional subpoena last month to appear for a private deposition, saying he would only testify if the testimony came in public. A U.S. fugitive accused of faking his own death to avoid rape charges has been extradited to Utah from the United Kingdom. The fugitive, known as Nicholas Rossi, also faces complaints made against him for domestic violence in Rhode Island. Rossi's run from the law took a twist when he was arrested in 2021 after being recognized at an airport in Scotland. Since that time, he had insisted to authorities that he was an Irish orphan named Arthur Knight, who had never been to the U.S. Well, gamers can have their toast and eat it, too, if you've got $40. You can go to Walmart and buy yourself an Xbox Series S toaster. Yes, the two-slice toaster looks like the console and burns the Xbox logo into your toast. This is important for many people. This is not the first small appliance, by the way, from Xbox. It sold a mini fridge at Target back in 2021 and 22. And Kelly, I think the idea of Xbox etched into your toast is the next big thing in the household at yours.
I'm tickled. They just should have come out with it maybe for the Christmas season, and those who couldn't get an Xbox could say, well, here's your Xbox toast. And
here's your Xbox. I got an Xbox toast. What kind of Xbox you got? Well, you got the Xbox toast. You play games on it? No, but it makes a nice English muffin. And I want to tell you, Kelly, we are christening our new set location here in Studio A with this broadcast right here.
You are in Studio A right now?
I am where you used to sit.
Wait until people see it. It is gorgeous.
Oh, it's vast.
And it looks
it's
good.
Vast.
Looks good on you.
Nice.
Thanks, Tyler.
Enjoy the toast. See you in a little bit.
Tyler Matheson. Coming up, 3 buys into bail tech earnings edition, featuring this surprising name our trader is bailing on. Its shares are off to their worst start since 2016. Think you know what it is? Tweet me at KellyCNBC. It's a biggie. That's your hint. We'll reveal it after the break. Dow back in positive territory by 16 points. Still negative on the week, though. Stay with us.
Humanly possible.
Welcome back. It's a choppy start to the year for big tech. Piper even saying the Mag 7 has become the Lag 7 and saying they've underperformed SMID-cap since the October low. But our trader isn't giving up on big tech, and she's looking ahead to earnings in a few weeks for names that could see pre- and post-report boosts. Joining us with her 3 buys into bail is Danielle Shea, Vice President of Options at Simpler Trading. Danielle, great to see you. Let's run through the first couple so we can get to your bail, which is interesting. And the first buy is Meta. What makes this one you'd want to hang on to, coming off what's been a relatively hot streak?
So I like this stock, Kelly, because the long-term trend looks great. The pullback here
was relatively soft into the 21 EMA on the daily chart. But most importantly, they've done really well and they've reacted really well to earnings the past several quarters. So when I'm looking for stocks that may rally going into an earnings report, that's exactly what I want to see. So I like this one, especially with the relative strength that it's demonstrating today. And I'm going to be trading this one ideally up into about 365, 370.
Okay, so we're at about 352. So that gives people a feel for it. Next one is Amazon. And all of these, are these names that you would buy going into the report and then wait and see? Or you think the charts work either way?
So, Kelly, what I do with these is I buy and I hold them in long-term accounts where I'm not getting in and out, but also for earnings specifically, I trade them in the options market. So with Amazon, if I'm going to buy this before the report with options, what I would do is when it triggers to the upside, I would buy those options and ride those options for an increase in implied volatility going into the report, but then sell them to capitalize on that rise in price before a vol crush comes through. So with that trade, what I'd like to do is when I start to see that stock shift to the upside, I'd buy it here, targeting about 150, 155, get out before the report, and then trade a post-earnings move as well.
Okay, so that would be about $5 of upside from where we are now. I like your optimism on these because not everyone's feeling it, although Microsoft is a little more consensus. It's only 3% below the November all-time high. You'd be owning this one as well. Why do you think this one, but also some of the others, are going to experience better momentum in the next few days, weeks than they have so far this year?
So, Kelly, I like the consolidation on Microsoft, and it has typically performed really well during that pre-earnings time frame. So this is a trade that I like to do quarter over quarter. Generally, I'm going to come in about 3 weeks before the report, buy options on this name with the idea that I'm going to ride it up into the excitement before the news. Now, the problem here is that Microsoft has been a little bit stagnant, and that's the number one criticism that I'm getting. People are saying, Danielle, Microsoft's not moving. And so I'm looking at it and I'm thinking, I'm still going to trade it. I'm still holding it. I would like to see it back up at those previous all-time highs, but I'll tell you that if this stock does start breaking down, that'll be the biggest canary in the coal mine for this earnings season.
And what would that break down? This is kind of a dumb question. So maybe the upside is 380. That was kind of the late November high in that territory. How much downside before you bail?
Let me see. So
before
checking out
368 or so right now on the chart.
So I look at the 50 simple on the daily chart. So that'd really be below 365. Let's give it 363. That would be a key line in the sand where I'd say, you know what, this is triggering to the downside. And at that point, I'd be pretty cautious about continuing to hold this on a short-term long, but I'm still absolutely going to hold my long-term stock.
All right, that brings us to your bail, which is Apple. It was the mystery chart we showed before the break. It's off to a bad start with a couple of downgrades this year. What do you see going on here?
So when you look at Apple, I don't like the way that it reacted to the last several earnings reports. So first of all, that's a bad sign. And when you have that, the stock typically isn't going to rally as well going into an earnings report. So for that reason, I'm not eyeing it for a bullish trade prior to this report. But then also you have some critical breakdowns in this stock. So if you look at the chart, on the daily chart specifically, it's broken down below the 50 simple moving average. That's a critical support zone, and it broke down on high volume as well. So whenever a stock does that, it tells me that there's something wrong with the technical aspect here. So that was one sign, but I'll tell you that the next zone of support is going to be around 180. So if we end up breaking that 180 price point, that is a key line in the sand, and that's where we could really see this stock break down. So
Go ahead.
I've been edging out of this stock, and I haven't shorted it yet, but I would short it if it breaks 180.
Whew, we're just under 182 now, so that gives you the stakes, people, as we watch that stock as really still a barometer in many ways for the market. Danielle, as always, thank you so much today. We appreciate your time.
Thank you.
Danielle Shea, Simpler Traders VP of Options. This week's losses, by the way, push Apple's 14-day relative strength index below 9. It's the most oversold name by that metric. And for the full list of Wall Street's most oversold names, you can go to cnbc.com/pro. Still ahead, a jolt of construction job openings. We have over 100,000 more of them now than a year ago. To help close that gap, one trade group is looking to high schools. And Kate Rogers is just south of San Francisco with that story today. Kate?
Kelly, that's right. 17,000 construction jobs were added last month. But as you mentioned, there is a talent shortage that will impact the workforce moving ahead. We'll tell you much more coming up after the break on The Exchange.
can change your life.
Welcome back to The Exchange. The construction industry is actually one of the highest paying fields outside of the business world, but it is still struggling to attract workers. As we learned this morning, construction added another 17,000 jobs last month as it remains one of the steadiest growing parts of the economy. But could that number be even higher? The industry is now pairing up with schools to try and fill more roles. Kate Rogers is out in California with those details today. Kate?
Hey, Kelly. Well, you said it. The construction industry is certainly searching for workers. As of the end of November, there were about 500,000 open jobs. That's according to JOLTS analysis by Associated Builders and Contractors, a trade group. That number is up 100,000 from the same time last year, and it's also at the highest level since 2022. Now, one way to fill the gap, of course, get younger workers interested while they're still in school. Southern Nevada Trades High School opened in August of last year, looking to do just that, with its first cohort of 75 students. They'll take a full curriculum of classes including English and math, but they also take career technical education in construction.
It's been very popular with families who are saying that the students are maybe not interested in traditional education or potentially not necessarily wanting to go to college. And so it offers an opportunity for those students to come and get hands-on learning. We have an integrated curriculum so that students are constantly being reinforced with this is how what you're learning will impact your future in your workforce and in the trades.
Now, they're certainly going to have options once they graduate from school, as construction and manufacturing spending is continuing to grow, in part thanks to funding hitting the street from the CHIPS Act, the Infrastructure Bill, and the Inflation Reduction Act.
It's hundreds of billions of dollars over the next 4 or 5 years is going to be coming out, and that's going to have a big impact on skilled labor and the shortage we're facing right now.
Now, Kelly, this is an issue we've talked about for many years now, not only in the construction industry, but a lot of baby boomer retirements are taking place, and there just are not enough younger workers moving into the workforce to take those positions as they open up. Back over to you.
And you're at a residential site, but obviously we know huge government spending in construction as well. It seems like roles of all kinds they need, right?
That's right. Yeah, they certainly do need roles of all kinds, and the best news for younger workers who may be considering college but aren't sure if it's the right fit is that a lot of these jobs do pay well. There are technician jobs, welder jobs that start between $30 and $40 an hour, Kelly, and you don't need a bachelor's degree to fill them up. And as you mentioned, this is a residential site, but obviously non-residential construction and the government-funded projects have been a lot of where these openings are turning up and will continue to be opening in the future.
All right. Kate Rogers, good to see you. Thank you so much. We appreciate your time. Coming up, analysts at Bernstein have a warning for Airbnb bears. They say they're looking at the wrong metrics. The bull case for a stock that's already up 55% over the past year. That's next. Welcome back to the exchange. Bernstein is calling out the Airbnb bears today, saying worries about the company's future volume growth being too optimistic are just flat out wrong. Instead, Bernstein argues Airbnb has outperformed on volume and will continue to do so. For more, let's bring in the analyst behind the call, Bernstein's Richard Clark. Richard, it's good to see you. Welcome.
Thanks very much for having me.
So I'm curious how you, on the one hand, sort of saying, look, the bear case has begun, and yet you remain bullish. What's behind that?
I guess, as we've come out into 2024 and people are very aware of what performance has looked like over the last few years, we've had a few people question the fact that Airbnb has only grown room nights by about 8% on a per year over the last 4 years. And that's a lot less than what the market expects it to grow at over the next 4 years. And so we wanted to have a look at that and say, well, actually, rooms or properties maybe have grown at 8%. But what's really happening, what's the real volume measure we should be looking at is customer numbers, and that's grown more like 10% because the properties on average have got bigger. And so therefore, looking just purely at property numbers is not showing the true volume growth that Airbnb has delivered.
And so how, I understand fundamentally why you need volume growth for the stock to do well, but there's still an argument to be made for, profitability. So just kind of balance those two factors. How important is volume growth? Why do you think that's the real metric people need to be watching?
Yeah, I mean, I think there's a lot of operational leverage in selling travel. I mean, it's a business that doesn't have a very large cost of sales, particularly for Airbnb, because it's very low in its marketing spend. And so if you do deliver that volume growth and price growth, but people tend to prefer volume growth, you will deliver the margin expansion on top of that. So I think it's always been the key metric that Airbnb needs to show that it's gaining share of the lodging market. And we believe it comfortably has been and comfortably will continue to do so as we look forward.
What do you think is behind the kind of bear case on the stock? Is it's that Airbnbs have gotten too expensive, that the growth rate has peaked, all of the above?
Yeah, I think that's key. I think one, the stock does trade on a reasonably high multiple, so the bar is set quite high. And I think there's a concern that Airbnb maybe is a value product and it needs a value proposition relative to hotels that means that customers will keep using it. So because your average Airbnb on a property level is 40% more expensive today than 2019, that brings about that concern. But actually on a per customer level, it's more like high 20s% more expensive, which is much more in line with inflation. So we don't think that value proposition has meaningfully changed.
How can that be the case that the property is 40% more expensive than it was 4 years ago, but the customer is only paying 20% more?
Because the properties have got bigger. So the Airbnb supply growth over the last 4 years has been much more in 4, 5 bedroom houses. And actually the number of private rooms, shared rooms, kind of the origins of Airbnb, that part has actually shrunk over the last 4 years. So the number of 5 bedroom properties on Airbnb is up north of 60% over the last 4 years. So you've seen the average property get bigger. It's housing 8-9% more customers than they were going forward. And I don't think that's a metric that the company discloses and probably is being missed when people are thinking about the volume and price growth that Airbnb has delivered over the last through the pandemic.
It's interesting because that kind of goes back to the other question I would ask, which is we've seen crackdowns in New York, a lot of other major cities, which seem to get right at the heart of the offering of Airbnb in the first place. Hey, come, stay in my apartment for a week or something like that. How much of a threat are those kind of regulatory responses?
I mean, less of a threat now than they would have been 4 years ago because Airbnb has become much more of a rural, suburban, small city product. That's where the business has grown. It's much more international, much more diverse than it was. So New York was less than 1% of sales. No individual city is more than 1% of sales. Very diverse business. And really where the growth is in areas where there isn't incremental regulation coming to bite.
166 price target, $30 of upside, and I think it was in the Internet Mag 7 that we talked about with Mark Mahaney the other day. So it has been on a good run. You're sticking with it. Richard, thanks for joining us. We appreciate it today.
Thanks for having me.
Richard Clark. That does it for the exchange. Up next on Power Lunch, we turn our attention to the national debt at a record high. Congress can't agree on where to spend, and the U.S. could face a shutdown yet again just a couple of weeks' time. We've got the implications and what it will take to get a deal done. Tyler is getting ready. I'll see you on the other side of this break.
Fed Sparkin repeats previous remarks. That's an event in Maryland.
Protect your trades from macro headline risk with Financial Juice Pro. Now only $99 a year for our real-time service.
Welcome to Power Lunch, everybody. Alongside Kelly Evans, I'm Tyler Matheson, and we're watching the markets very closely as stocks are trying to hold on to gains. The jobs report coming in stronger than expected, maybe taking a little steam out of that Fed will cut soon camp.
And some long weekly winning streaks are likely to be broken today. 9 weeks in a row for the Dow, which dates back to late October. Similar story for the S&P and NASDAQ. The NASDAQ down 3% this week. Apple a big culprit there, and the 10-year yield right around 4% now after jumping up to 4.1 on the jobs report before a surprisingly soft ISM services report sent it back into the threes.
Let's start things off with more on that December jobs report. 216,000 jobs created. That beat expectations. The unemployment rate held steady at 3.7%, but behind that number, a potential red flag for the economy. The labor force participation rate saw its biggest one-month drop in almost 3 years to 62.5%, meaning the pool of available workers is shrinking. And my next guest says that could put upward pressure on wages and inflation as the Fed is contemplating its next move on interest rates. For more, let's bring in Corey Kentenga, senior LinkedIn economist. Corey, welcome. Good to have you with us.
Thanks for having me.
Explain to us the labor force participation rate, how they measure it. It moves a little bit month to month, usually not all that much, but this was a fairly significant drop. Why?
So the labor force participation rate measures the number of available workers. So that's going to be employed workers and unemployed workers. So whenever we see people joining the labor force or dropping out of labor force, that's going to push this number up and down. What we saw this month in December was that there weren't really a lot of workers who were joining or dropping out. It was pretty much flat for unemployment. So we had gains in employment. We had workers gaining in employment, but we also had some workers entering the labor market. We had a decrease in the number of workers who were re-entering the labor market. So the labor force participation rate has kind of been holding steady since about August. We occasionally see dips and we occasionally see spikes, but it's been pretty steady, which suggests that we've exhausted labor force supply.
So when I see the number 62.5, is that then a percentage of all the people who are working or seeking work as a percentage of the total working age population, or what?
That's right.
Okay, good. God, I knew something for a change. That's amazing. So does this in and of itself suggest that the labor market is getting tighter or likely to be tighter, which would put pressure on wages as companies go out and compete for labor, which would put pressure on on inflation, which would then put pressure on the Fed to keep interest rates higher than they might otherwise?
That's right. But I think with the labor force participation rate, it's important to zoom out for a second.
Okay.
It's been declining for a while, for about 10, 20 years. So we've just seen a kind of a secular decline in labor force participation rate.
Is that demographics?
Part of that has to do with the fact that we are getting older. The population is aging. I mean, the aging population is one of the reasons why we keep seeing healthcare post strong jobs reports, right? So we are seeing the population aging. There are going to be long-term consequences of that. Right now, employers are still dealing with the aftermath of the pandemic where they didn't have enough workers once demand shot back up. That has started to normalize a lot more. So for employers, they're still seeing a lot of applications. At LinkedIn, we're seeing applications per applicant up about 16% compared to last year. So there are still people looking for work. They may be currently at employers. They may not just be unemployed at the moment.
Corey, quick question about wages. This was a big topic of discussion last hour or debate. The ADP report is running a little softer than the government's reading. This, of course, obviously all comes to bear on whether the Fed needs to respond to higher wage inflation. What would you tell us is going on that front?
So what we're seeing right now in this December report is that there's a bit of acceleration in wage growth, nominal wage growth. There may not be much there, actually, because this is average hourly wages, and that depends on the composition of workers. When we see lower wage workers either dropping out of the labor force or losing their positions, that's going to raise the average level of wages. So there is this composition effect in the average hourly wages measure that we get from the Bureau of Labor Statistics. So I wouldn't say that this 1 month read is too worrisome. What we would worry about is if we continue to see prints where wage inflation is running above 4%, because there are concerns that might be feeding into price inflation.
Right, although one part of the granularity that I guess we're getting from ADP is this idea that when people switch jobs now, the increases, the wage hikes they're getting are not that pronounced. Certainly nothing like we saw a year ago. So that was an important source of wage inflation, but it looks like it's going away.
Right. So we have seen that wage inflation is up when you change jobs. Typically, one way to make gains, right, is by changing jobs. If your current employer doesn't want to pay you more, find a new one. So we're actually seeing folks gearing up this January to look for new positions, because January is typically the month where people start their job search. And we've asked our members at LinkedIn if they are going to look for a new position, even though less people are quitting. And it seems like a lot of folks are considering finding a new position. About 40% of our members surveyed. And that depends on what generation you're in as well. Younger folks are definitely going to be looking for.
So let's bring this conversation around third and into home plate with respect to interest rates. Where do you think interest rates will be a year from now, given the trajectory of the economy? There is no reason for the Fed to cut rates right now because they see the economy slowing. It doesn't seem to be demonstrating that in any consistent way. So where do you see rates a year from now?
So I expect rates to start to be cut possibly in the summer. So a year from now, we might see rates get in that 3% and 4% range. Really what the Fed
funds rate? The Fed funds rate?
The federal funds rate, that's right.
That's a pretty dramatic decline from where it is now, 5.25%, 5.5%.
Well, the Fed is going to want to get ahead of the curve. There's still a lot of monetary tightening in the pipeline. We have a lot of fixed mortgages. We have people who get their wages only taken once a year. I only get a wage increase once or twice a year. So there's a lot of tightening that the Fed's already done that's in the pipeline. And what they're going to want to do next year is get ahead of that curve and start to introduce some liquidity back into the economy in order to keep things going.
Corey, I think you need to talk to your boss about those wage increases. I would recommend a massive increase for you.
But no job switching.
No job switching. You stay where you are. You come back and join us. But tell your boss that the Power Lunch team says pay him more. Corey Kentenga, thank you.
Thank you.
Now, right after that stronger jobs report came a weaker than expected ISM services report. So does it keep the market's rate cut hopes alive or not? Let's ask my next guest, who's one of the few still thinking the Fed will cut aggressively next year. Joining us now is Drew Mattis, Chief Market Strategist at MetLife Investment Management. Drew, it's been a while. It's good to see you again. Welcome.
Good to see you, Kelly.
So I'm interested to hear that you're on the more, can I call it dovish side here? What do you foresee?
Well, we're on the dovish side because we're expecting a recession. You know, where I have some difficulty with kind of where the consensus is right now is the idea of rate cuts and a soft landing. When we have an inflation rate that's above 3, that doesn't square the circle. You know, if you were to kind of, you know, I don't know, land on planet Earth and look at the United States economy and see a 3% inflation rate and an unemployment rate of 3.7. You wouldn't be asking yourself when we were going to cut rates. You'd be asking yourself when we're going to start increasing rates.
Right.
And I think, you know, there's a bit of a disconnect in the consensus between, you know, what people are thinking on the rate cut side and what's plausible in terms of what the Fed can tolerate with regard to inflation.
But why does your disconnect? It sounds like you're saying, forget all of that, focus on recession. It's still coming, and they're still going to have to respond to that.
Yeah, look, I looked at the unemployment rate today. First of all, the survey response rate was just abysmal. You know, it was 50% of the people didn't bother responding. So, you know, in terms of, you know, prospects for kind of revision, this is the report that's going to get revised. But then if you go into the details a little bit more, what you see is that some things stayed the same, which was, about 25% of Americans who are working in this report actually saw a decline in their weekly wages, either because their hours got cut or, within the details of the report, they saw actual, declines in their average hourly earnings. So, in terms of, this is not a rising tide lifts all boats type report. This is, some people got to surf the wave in and other people are left stranded.
I'd like to dive in a little bit more on how you get to a recession scenario. If, as you just said a moment ago, you landed on planet Earth and you saw U.S. inflation at 3% and unemployment rate at 3.7% and payrolls gaining, you would say this is not the time to protectively cut interest rates in anticipation of a slowing economy. You would raise them because the economy is firm, inflation is still alive above the Fed target, and the job market is stable and solid. So how do you get from that forecast or observation of present conditions to conditions where you say the Fed is going to cut 6 times in 2024 because they have to do it protectively against a recession prospect?
I guess I would fall back on the idea that when things fall apart, they fall apart fast. When we have a long-term productivity boom, it's a long-term productivity boom. It happens gradually over time, and its positive effects are felt in the economy over a very long period of time. When the unemployment rate starts moving higher, it tends to move higher quickly. And so things fall apart, they don't gradually erode. And I think, as we look ahead, there are signs of weakness in the economy, and really the one kind of standout is the employment picture that's actually kind of working against that narrative. If you look at the ISM report, manufacturing is in recession. The service sector is barely treading water, according to that report. If you look at components of the unemployment report, they are showing increases in unemployment across a number of states. So, I know there's been a lot of talk of the so-called SOM rule for the United States, where if the unemployment rate goes up by enough, then it means the economy's in recession. If you do that on a state-by-state basis, you've got a number of states already in recession. You have more states in recession in November than were in recession in October. And if you kind of put it out on a map and look at it, it looks like a disease that's spreading across the United States. It's not, I think that when a lot of people talk about soft landing and we're talking about a recession, we might be talking about the same thing. It's just that I remember that a recession looks like something out of 1990 or 2000. And a lot of people don't have experience seeing a recession that didn't look like 2008 or 2020.
True. And California, to your point, has seen its unemployment rate rise by at least a point, maybe more than that already.
It's high in New Jersey as well.
That's right. New Jersey, we're a case in point. So, Drew, where does that leave the market? Do you think the market, I feel like it matters to the market if we're going to be in recession or not.
Well, I do think it matters because, I think it matters in terms of, where rates go. It's not just a matter of the Fed funds rate. It's where do 10-year rates go? Where do mortgage rates go? And when should you be thinking about risk assets? Right now, everyone's thinking risk assets are great. That could change very quickly if the unemployment rate moves higher and everyone begins to save a little bit more money because it seems like there's a risk that people might lose their jobs. And so when I talk about the economy, rolling over quickly, that's part of the problem is once that dynamic gets moving, it's very hard to stop it. And fortunately, though, for the Fed, the way to stop it is to actually kind of lower rates and try to manage that process. And we think that they'll have to do that. Although, to be honest with you, we would have expected that to be more weakness by now. But just because there's not evident weakness now doesn't mean that what we're seeing is stuff that points to a strong economy. And I think for those who are looking for a soft landing, if you believe in a soft landing, it means you're going to have a stronger economy with high inflation. And so you have to be thinking either that there's a recession later to get those Fed rate cuts or that the Fed's going to abandon its inflation principles. And I just don't think that's likely.
6 rate cuts, a quarter point each time. That's $1.50. So that would take rates down to 4% or a little below. Is that where you see them at the end of the year?
That's what we're seeing at the end of the year. We're expecting 10-year yields to stay about where they are today. So the curve completely flattens back to, straight across the board.
Better than an inverted curve, I guess people would say. Drew Mattis, good to see you, my friend.
Thank you.
Coming up, a perplexing new startup. Perplexity is using AI to go after Google's dominant position in search, and it just won backing from Jeff Bezos. Details in Tech Check next. Plus, is it shutdown season again? Congress has only 9 days to negotiate 4 spending bills to avoid a partial government shutdown. We will discuss that when Power Lunch returns.
According to the New York Times, the US moves closer to filing an antitrust case against Apple. Apple drops to a session low after New York Times report.
Perplexity, an AI-powered search engine startup looking to take on Google, raising $74 million in a round led by some big names. Deirdre Bosa spoke to its CEO for today's Tech Check. Hi, Dee.
Hey, Tyler. So Google has been so far dominant for search for decades that few startups have been able to even raise significant capital to compete with them. Until now, that is. Perplexity, backed by some, as you mentioned, very high-profile investors, from Jeff Bezos to NVIDIA, believes the generative AI shift has led to a paradigm shift that creates a new opening in search. I spoke to CEO Aravind Srinivas earlier this morning on what's changing the age of Gen AI. Have a listen.
Search has been about 10 blue links for the last 20 years. And 10 blue links was always a hack. At the end of the day, people just wanted an answer. The concept of answer engine existed even in the late 90s when the internet was exploding. Ask Jeeves was an answer engine. In fact, many Googlers used to come from Ask Jeeves and join Google at the time because the 10 blue links was the concept that actually worked with the technology that existed at that time. So what Perplexity does is a paradigm shift in search. It's moving search from links to answers.
He says it's all about the user interface. Google was born in the internet era and, of course, navigated mobile very well, but its bread and butter search hasn't transitioned, he says, quick enough to the generative AI age. Srinivas says their AI search experiments thus far, from Google that is, are cluttered, they're filled with ads, and there's too much cognitive overload for users. So he is creating a product in Perplexity that is clean, minimal, simple, and relies on a number of large language models, from GPT-4 to Anthropic's Cloud to Google's Gemini and beyond. And guys, Perplexity, it may represent the next act for generative AI at large. Last year, it was all about enabling the models, chips, and cloud computing. This year, Srinivas and many others here in the Silicon Valley believe that we will see the rise of consumer applications. And mega caps like Google, they may not be the clear winners this time.
How much you often hear in situations like this, and it used to be the Jack Welch rule, and that is that if you're not number one or number two in the business, you might as well get out of the business. You hear about first mover advantage, and that first mover advantage right now would seem to reside elsewhere.
Right. And if you think about the advantage in the generative AI age being data, right? First party data in particular, nobody has more than Google. And that's why, you know, I asked him, are there going to be one winner, two winners in the space, just like Google has dominated search with 90% of market share? He says, not necessarily, actually. He thinks that there's going to be more, but he thinks that Google is still going to be valuable with that first-party data, which powers a lot of the large language models out there. And he also thinks that they're going to make a big bet on cloud to kind of offset what may be happening. But this is really speaking to Wall Street fears about Google's position since the generative AI hype cycle began. Will it displace search? Will someone like a Perplexity come up and do it better, maybe a better application built in the generative AI era, or can Google move fast enough? Nobody denies that Google has developed the foundational technology, that it's not necessarily behind, but can they create a product that users really want to use? And we know that OpenAI and ChatGPT was able to front run them on that front.
I just tried it out. I had a good answer for how long for a sausage casserole. Gave me little links up top, and it got it basically right. I wouldn't say it's majorly differentiated from the others. Still makes you go through the whole sign-up rigmarole, which early Google didn't make you do.
But that's the thing. It's not that differentiated, and I asked him about the commoditization of these large language models, and that's why he says that this year it's going to be about the consumer applications. What Sequoia published a piece, the VC firm located here in the Bay Area, says that you either got to be close to the GPUs, the compute power, or the consumer. And he believes, and many others believe, that we're going to see companies be closer to the consumer this year, whereas last year it was all about the GPUs.
All right. Thank you very much, Deirdre. We appreciate it. And I'm getting hungry. Deirdre Bosa. Further ahead, years in the making, United Launch Alliance's new heavy lift rocket, the Vulcan Centaur, is set to lift off for the first time early Monday morning. The mission is to send a commercial lander to the surface of the moon in what would be a historic first if all goes according to plan. Maybe a small step for man, as they say, but potentially a big one for investors. We'll explain next. Welcome back to Power Lunch. Let's get out to Chicago for a look at how this morning's data is playing out in the bond market. Rick Santelli with the latest there. Rick?
Hi, yes, what a wild day. You know, if you looked at some of the key parts of this morning's jobs report, what jumped out at me was 4.1. Let's look at a 10-year chart of year-over-year average hourly earnings. The fact that it was 3.1 to 3.5 pre-COVID, and you can see it on the left side, just shows us that it's been buoyant, and it actually looks like it wants to turn a little higher. And participation moving down to 62.5, that's never good. Look at an intraday chart of 2s. Look at an intraday chart of 10s. It's almost as though they did a round tripper, okay? They were right around, what, 438, 439, right around the number. It goes up, it comes back down. So basically we're near unchanged after seeing 439 and 410 on the extremes. But here's the thing. Look at how much steeper the yield curve is. If you look at the 2s to 10 spread, hovering at minus 35. This is the big point. This is 2024. Watch out for long-dated treasury rates to be a different path than what many are thinking, short rates, which are going to follow the Fed. Let's go talk to a trader. Hey, it looks like we have Big Dave today. Happy New Year, Dave. All right, so what'd you think of today's jobs number?
Well, I guess it's supposed to be a little encouraging. The market's up a little bit. They like it. Don't know what this is going to lead to as far as all the rate cuts, though. It's not a horrible jobs report. You'd think we might start getting some rate cuts here.
Now, when it comes to rate cuts, at the end of last year, we saw the equity markets propelled because everybody's thinking 6, 7 rate cuts.
Yeah,
the Fed's maybe closer to 3, and it's an election year, makes it confusing. What do you think?
So here's my concern with it. Once they start cutting, even just once or twice a little bit, if inflation starts picking up, it could really show that they don't really maybe have it under control.
Ooh, that's a really good point. And you know, there's a lesson to be learned here. We had inflation data out of Europe this week, and they were expecting 3.9 in Germany. It comes out 3.8. All the major publications were like, great news, great news. The previous month was 2.3.
That's not supposed to be good. They wanted around 2%. 3.8, that's not a good number. They're telling us it's a good number. It's not really that good of a number.
Well, the market's telling us it's not a good number. The gilts closed up 25 basis points this week, and the boons closed up 14. Right now, 2s are up 12. Our 10s are up 14 basis points on the week. So I like your argument. If the Fed doesn't ease, the market's going to expect more and aggressively.
Correct. And if they start easing and all of a sudden inflation's coming off, it might show, wow, they don't have this under control, and we might start to move.
You know, the whole notion of, is inflation going to be linear or not? Meaning, is it going to come down in an aggressive fashion? And maybe it will, but I don't see that happening in the UK. I don't see it happening in Europe.
And neither do I. And we hit, what, 34 trillion in debt this past week?
You know what? And how many places did you hear about that?
You have to dig. You have to dig deep.
You know what, though? You don't need to dig so far. No. I'll tell you who's going to tell you all about that every minute. 10-year, 20-year, and 30-year yields.
And Rick Santelli. Those are the people that you're going to hear from.
Absolutely. Dave, thank you. Tyler, back to you.
We're going to hear from that 10-year and from Santelli. Thank you very much. Kelly?
Let's get to shares of Apple, which have turned sharply lower intraday. There's some news out that Steve Kovac can bring us. Steve?
Hey there, Kelly. Yeah, this comes from a New York Times headline that just crossed saying the DOJ is moving closer to wrapping up its antitrust investigation into Apple. We've known this has been going on for a long time. DOJ, like so many other regulatory bodies around the world, really, looking at Apple's control over the App Store, how that impacts the fees it charges for third-party apps, the same things that we've been talking about forever. I will note, however, Kelly, this story does not say when this lawsuit is finally going to drop. A lot of people, in fact, expected it to happen last year. Still did not happen, but we do know Jonathan Cantor, the antitrust chief official over at the DOJ, is one of the key players looking into Apple over all these issues around the App Store, around control over wallet, and things like that. Not to mention the Epic Games case, Fortnite maker, that lawsuit between the two companies still going on, still being battled out in court. We're expecting to hear from the Supreme Court pretty soon whether or not it'll take up that case. That also plays into this whole theme around Apple and its App Store dominance as well, Kelly.
We had just been talking about the weakness in the shares, Steve. They're down 5.5% to start the year. Market cap, again, almost being surpassed by Microsoft, which is in the green today. The reaction by investors here suggests what? I mean, even though this was telegraphed, they don't seem pleased about it.
Yeah, that was really curious. I mean, again, I just read through this New York Times story. I didn't learn much new that hasn't been reported before, that we haven't reported on this network before about what's being looked at into Apple. Again, these are all the same issues that have been on the table for many years now, going back to, I don't know, 2018, 2019. But again, they did say there was a meeting between Apple and the DOJ as recently as last month. So that is something new. But also this story is saying there hasn't been the so-called final meeting between Apple and the Department of Justice where basically the regulatory agencies come to the company they're about to sue for antitrust and see if they can come to some sort of last-minute agreement or, read them the last rights before the lawsuit drops. That hasn't happened yet. When we hear about that, though, Kelly, then we can say this lawsuit is imminent, and then, of course, Apple will go to trial against the DOJ in an antitrust trial, just like Google did, and we're waiting for that verdict as well pretty soon.
No, great analysis. The shares are only down 0.5% now. They have dipped lower still at about $181. Danielle Shea last hour had just told us if they do go sub 180, she'd consider shorting it. It's been a rough start for them. Steve, for now, thanks very much for bringing that news to us. We appreciate it. Steve Kovac.
And let's go to Bertha Coombs now for a CNBC News update. Hi, Bertha.
Hi, Tyler. Two big headlines involving the New York Attorney General today. First, Donald Trump's civil trial could cost him $370 million. State AG Letitia James argued today that he should pay that price in penalties for decades of financial fraud. The filing came out less than a week before closing arguments are expected to begin in that fraud trial. The former president has repeatedly denied any wrongdoing. And just days before a New York civil trial involving the CEO of the National Rifle Association is set to begin, Chief Wayne LaPierre announced that he is resigning. New York Attorney General Letitia James was seeking his ouster in the trial, as well as financial penalties for alleged corruption. LaPierre, who is 74, cited his health as the reason for stepping down. And you won't see any ads from Jeep, Chrysler, or Ram trucks during this year's Super Bowl broadcast. Chrysler parent company Stellantis said today that it won't take out any spots on the big game as it focuses on cutting costs. The automaker has also pulled out of several auto shows as it contends with falling sales. Tyler, back over to you.
Bertha, thank you very much. Bertha Coombs. After the break, the national debt of the United States hitting a record $34 trillion. We'll talk about that and its impact when we return.
50% off.
Welcome back to Power Lunch. Another government shutdown could be looming in just 2 weeks, although we should be used to it by now. With the total U.S. debt passing $34 trillion, a lot of people are hoping for a more permanent solution this time around. More on that in a moment. But first, let's bring in Emily Wilkins to explain where things stand right now. And Emily, the border standoff seems to be playing a big role this time.
The border standoff is playing a big role. The supplemental is playing a big role. And also playing a big role is that Speaker Mike Johnson has made it clear that this is really the last time he wants to be dealing with this. He either wants to get it done, part of it on January 19th, part of it on February 2nd, and that if that doesn't happen, he's just going to continue current spending levels. And look, Congress has spent months working out the details of funding the government, but they still do not have an agreement on the overall amount that they want to spend next year, and that is really critical. It's holding things up. Tennessee Republican Chuck Fleischman, a top House appropriator, told me that the longer it takes to get that overall spending number, the more challenging it's going to be to prevent a partial shutdown in 2 weeks.
Once we get the top line number and the allocations, then it's going to be exceedingly difficult, not impossible, but difficult to get a deal done by January 19th. However, if we could get a top line number within a day or two, I think it's entirely possible that we could put something together.
Now, if they can't reach an agreement soon, 20% of government funding will lapse on January 19th. Now, this includes funding covering the Departments of Agriculture, Energy, Veterans Affairs, and Transportation, plus military construction, the FDA, housing and urban development, a lot of stuff. This could really mean that fewer air traffic controllers will be at airports. It means reduced food inspections and delays in grants for farmers, as well as a number of other impacts really across the government. If lawmakers can't come to an agreement, and if they keep funding the government at current spending levels, they'll also trigger a 1% cut across the board. That translates to billions of dollars less, with defense agencies being hit particularly hard. And when I was talking with the congressman yesterday, he said that really, the shutdown is the worst option. The second worst option is that 1% cut. Absolutely no one wants that to happen. But to do that, they're going to actually have to find a way to get these bills passed.
Emily, thank you very much. Emily Wilkins in Washington for us, setting up our next conversation as a shutdown looms and the debt continues to balloon. Our next guest says the longer-term problem is that our two political parties are so far apart and seemingly unwilling to fix the problem. Let's bring in Aaron Klein, senior fellow with the left-leaning, I'm sort of obligated to say, Brookings Institution. Aaron, welcome. Good to see you there.
Good afternoon.
I'm glad you're with us. Let me try and untangle this a little bit. Emily talked about this being, we don't get an agreement on a top line for spending for next year. As I understand it, this is really spending for this year, that we're talking about fiscal 24, right?
Yeah, no, the government runs on an October 1 to October 1 basis, and Congress has kicked the can down the road so far that we're talking about January 19th or February 1st for the funding levels for this fiscal year, which basically runs through this September. So it is about the amount of money that's going to be spent into the economy this year and about whether or not the government is going to have a partial shutdown.
And how much of this dispute, among the many disputes that seem to afflict Washington these days, how much is this dispute tied up with the question of military funding to Ukraine and Israel on the one hand, and border security funding on the other? Or is that sort of a separate issue?
So it had been a bit of a separate issue in terms of the White House's approach to adding a supplemental. This is what we're talking about is the regular money that funds the government for the entire year. What the White House proposed was extra money known as a supplemental, which happens often, to focus on Ukraine and Israel, and we're willing to make some border security adjustments in permanent law, as well as some more money to the border to get that through. So these are two separate tracks that have become interwoven as the political traffic jam backs up.
Mm-hmm. Do you see a way, let's talk about the broader question, which is the longer term debt situation the United States is in, that matter of overall funding for fiscal 2024 as apart from the supplemental. Do you see a way forward, or are these parties so locked into their positions that a shutdown is almost inevitable?
So look, there's a way forward, but for that way forward, you have to have a negotiation. A negotiation requires identifying the other side. Is the other side House Republicans? Is the other side Senate Republicans? What is it the other side wants? Do they want cuts to discretionary funding? Do they want border security and immigration? You have to have a negotiation. And right now it's difficult to know within the Republican Party who you're negotiating with. Look, this top line number that the congressman referenced before had been agreed to with Speaker McCarthy. Now there is no Speaker McCarthy, and we're going backwards in the negotiation as the House Republicans change their leadership.
I still wonder, Aaron, if we don't have a reckoning going up, because the structural deficit, well, I don't want to get too technical, but now that interest costs are basically going to be half the deficit for the foreseeable future, and the more we run these deficits, the more we're going to add to the debt, which means we're going to have perpetually high interest costs for the foreseeable future. How do we get out of that situation?
So the longer term political reckoning that has to come as it relates to spending and revenue is nowhere on the agenda. That's not a 2024 issue. That's going to require, I think, a pretty structural realignment of the political parties. There used to be a consensus in Washington. When I first started in the Senate, we had something called pay-go, pay-as-you-go. It was a remnant of the Clinton era where we built up surpluses. Republicans and Democrats, President Bush the first through Clinton, kind of agreed that you had to pay for what you spent. And, since then, it's just been when the Republicans are in control, a tax cut frenzy with voodoo economics that these tax cuts pay for themselves, which they never do, digging a very, very large hole, and then a series of major calamities that have required large amounts of money, like COVID, like the 2008 financial crisis. And, now we're seeing things on the defense side. And so until there's a real change in parties and the voter priorities or an extra event that pushes that direction, the long-term issues are just off the table right now.
Yeah, some people say that's why they think longer-term bond yields will remain higher for the time being. We'll just have to wait and see. Aaron, thanks for your time. We appreciate it.
Thanks for having me.
Aaron Klein. Still ahead, ready for takeoff. A powerful new rocket preparing for its first ever flight with major implications for the whole space industry. We will get the key details when we return.
Brent crude futures settle at $78.76 a barrel, which is up $1.17 or 1.51%.
Welcome back to Power Lunch. A powerful new rocket is preparing for its first flight, and it could significantly impact the space industry. Morgan Brennan is here to explain, and this is on Monday?
This is on Monday at 2:18 a.m. Eastern, and I will be down on the Florida Space Coast. Thank you very much for this. This is a major moment.
Wow.
This is a decade and billions of dollars in the making. The maiden flight of United Launch Alliance's powerful Vulcan Centaur rocket. As I mentioned, the liftoff is scheduled for early Monday morning. The mission launching the startup Astrobotics NASA-contracted lander, which is filled with government and commercial payloads to the moon, in what would become, if all goes according to plan, over the next couple of weeks, the first time ever a privately owned spacecraft has landed on the lunar surface. Now, Vulcan is ULA's new heavy-lift rocket. It's going to replace the legacy vehicles powered by Russian engines. Vulcan's engines are built by Jeff Bezos' Blue Origin. It is a crucial moment for the Boeing-Lockheed Martin joint venture. This is the first original rocket that's actually been developed by ULA. Customers include the U.S. government and Amazon, and it comes as the company fields prospective takeover offers. It also comes as the launch landscape has dramatically shifted in recent years. SpaceX launched 96 successful missions last year, which was, by the way, an industry record. ULA, as it transitions to Vulcan, just 3. More competition is coming, including SpaceX's Starship that's under development, Blue Origin's New Glenn, which is under development, has yet to fly, NASA's SLS, which is used primarily and exclusively for Artemis moon missions, and a number of less powerful rockets from Rocket Lab, Relativity Space, and others. The question, is there room for everyone? That remains to be seen, but as ULA's CEO Tory Bruno and others have repeatedly told me, with thousands of satellites and spacecraft needing to be launched over just the next few years, a capacity crunch could be coming. We may have more need than we have rocket supply to get everything to space.
What is this vessel going to carry to the moon? It's not coming back, is it, or is it?
No, it's not coming. Well,
so what's it going to leave there?
So the Astrobotic lunar lander.
Yeah.
So it's got 7 different countries. It's got payloads for 7 different countries. It's going to be doing scientific research.
Some Amazon boxes on it.
But it also has some commercial payloads, including, and this has been more controversial for a variety of reasons, but the cremains of some Star Trek luminaries on board. It's not going to attempt to land on the moon until later in February to time it with the sunrise on the moon, which is a very different cycle than the one we see on a daily basis here on planet Earth. It will have exactly 10 days to carry out all of these missions, collect all of the data, beam it back to Earth, and then everything basically shuts down when the sun sets again.
So it's going to orbit the moon for a few days?
It's going to orbit the moon for a few weeks.
Oh, weeks, okay.
And then it's going to attempt this landing. And by the way, it's not the only commercial lunar lander that is attempting to do this. We actually have a little bit of a competition there, too. Intuitive Machines, which is publicly traded, though very small cap at this point, is also preparing to launch its own lunar lander. Remains to be seen which one is going to land first, if, in fact, both of them land successfully.
Is NASA still working on anything on this front, or is it all private sector?
So this is all. So it is public-private partnerships with NASA under a NASA program that basically prepares the lunar surface for humans' return later this decade.
Wow,
interesting.
All right.
Thanks,
I'm not
Morgan.
gonna.
It's happening to the moon.
Enjoy Monday at 2:18. I'll be thinking of you. Shares of Peloton surging for a second straight day, getting a boost from its new partnership with TikTok. Coming up, we'll trade it in 3-stock lunch. We will be right back.
2025.
Time for today's three-stock lunch. We are trading some big movers as we close out the first trading week of this new year. It's been a little bumpy here with our trades. Art Hogan, Chief Market Strategist with B. Riley Wealth Management. The year may change, but Art Hogan never does. First up, Microsoft, the tech giant, closer to overtaking Apple as the most valuable U.S. company. Your trade on Microsoft, Mr. Hogan.
Hi, Tyler. I think Microsoft's an easy call. Obviously it had a great 2023, but if you look at 22 and 23 combined, it's only up about 8.5%. Valuation looks very attractive here at about 35 times. Pays a nice little dividend, and it's got a pile of cash. More importantly, it is one of the AI darlings that is already monetizing, and that's the most important piece. I think 2024 will be how do you monetize artificial intelligence? They're already doing it. They've got a head start. They've got the first mover advantage that you just talked about in one of the last segments. So I think Microsoft is a buy here, and it's on our focus list. So we'd like the stock a lot.
All right. What about JP Morgan? They report next week. They hit a 52-week high again today. They're up 27% in the past year. You sticking with this theme of, kind of the juggernauts?
Yeah, that's in the business when you think about the big banks. Obviously, the best balance sheet. That's why it has the premium valuation, trading at about 11 times and 1.6 times on the tangible book basis. Throws off a 2.5% dividend. But we think Jamie Dimon's done a great job of directing this bank to be in the best place that it can be. So what you don't like to do is have a stock making a 52-week high before it reports earnings. Not as nervous about this one. I think this is definitely a buy. Certainly, you may want to wait till after their report, but I would tell you that for the rest of this year, I think the financials, one of the underperforming sectors of last year, is going to get a lot of love. And if you want to have access, if you want to express that opinion, JP Morgan's a great way to do it. This is also one of the names on our focus list. We're 2 for 1 today.
All right, let's move on to Peloton, surging for a second straight day on its TikTok partnership. Is the worst over for Peloton, Art? And frankly, I rode my Peloton last night, and I saw something very interesting to me, and that was logos for Lululemon on all the bikes, which tells me that they are getting out of their own apparel business and maybe partnering up with Lululemon, which makes sense.
That's exactly. Yeah, it does make sense. It's what they need to do. They tried to roll out their own apparel brand. That didn't do well. I certainly think, to your point about the worst being over, certainly. Is it going back to $4? Likely not. They've stemmed a lot of the bleeding. The problem is this is one of those companies where you can love the product but not like the stock. And why do you say that? Negative earnings. They haven't been able to post positive earnings since they've been a publicly traded company. They have a pile of debt, and they've got a niche market. So to your point, this might make a very attractive acquisition for a company that's in the apparel business or someone that's looking to add fitness to their offering stack. But I certainly think that as a standalone company, we've probably seen as much as they're likely going to do in the short term, and the short-term horizon doesn't look like it has a whole lot of positive catalysts.
All right, there you go.
Fading it.
All right, thanks very much, Art. Good to see you.
All right, great to see you.
You bet.
We'll power through as many more headlines as we can in closing time next.
Yemen's Houthi Supreme Revolutionary Committee to the BBC says any country to involve itself with the US-led Red Sea coalition will lose their maritime security and will be targeted.
Do you want to stay up to date with the latest and be on the bleeding edge of news for non-farm payrolls? Then sign up today and get our special offer of Financial Juice Pro for a year's worth of our service for the price of 1 month and save 92%.
Welcome back. Just 90 seconds left for us and several more stories you need to know. So we'll narrow it down to two, starting with Costco, whose shares are higher after they reported just over $26 billion in sales last month, a 9.9% increase from the year prior. Impressive, led mostly by e-commerce demand as well. They said comp sales also got a 3% boost on an additional shopping day last month, thanks to the timing of New Year's Day, which fell on Monday. I contributed also there, and I found great bargains in some clothing for my sons, and it was never bought clothes there before.
Oh, our kid, that's all they wear.
Is that right? No kidding.
100%.
Yeah.
Oh,
great bargains.
Great stuff. I got some seasonal candles.
And good meat, good steaks they have there. All right, U-Haul releasing its annual growth index. It measures the largest number of one-way movers by state. The number one growth state in 2023, Texas, for I think the 6th time in the last 8 years.
Wow.
Rounding out the top 10, Florida, North and South Carolina, Tennessee, Idaho, Washington, Arizona, Colorado, and my home state of Virginia. California saw the most net losses of one-way movers, thanks in part to the rising cost of living there. Many of the states that are attracting new people, obviously, are low or no state income tax. And by the way, Texas has the most Fortune 500 headquarters of any state, 53.
Good job, Texas.
All right, thanks for watching Power Lunch.
Closing bell starts right now.
All right, Kel, thanks so much. Welcome to Closing Bell on this Friday. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. This make-or-break hour begins with the state of stocks. Given this rocky start to the new year, we're going to ask our experts where things could go in the weeks ahead, including Tom Lee. He's coming up in just a few minutes. In the meantime, your scorecard with 60 minutes to go in regulation looks like that. It's been a pretty volatile day following that stronger-than-expected jobs report, but then weaker ISM services reading. So we're in the red, modestly so, across the board. Let's zero in on tech for a moment, given the Nasdaq's down about 3% this week. Boy, Apple, worst performing mega cap this week after a couple of downgrades there. Yields, they've been up and down as well today, and that's a big reason for the gyrations in the major averages, we think. A jump after the jobs report, a fall after that ISM, and then another rebound, which definitely seems to be hurting equities. The 10-year now sitting above 4%. There it is, 404. It takes us to our talk of the tape, the slow start to 2024, and what lies ahead with some critical data and earnings looming next week. It's all coming fast. Let's welcome in Courtney Garcia, Payne Capital Management Senior Wealth Advisor, with me here at Post 9. Happy New Year. Welcome back.
Happy New Year. Thanks for having me.
So what's your big takeaway from the way this year has started?
The big takeaway is what we saw in October, where everything rotated, right, out of the Magnificent Seven that was the place to be in the early 2023. Everything has shifted now, and you're seeing your interest rate sensitive things like small caps, real estate, energy are all starting to outperform. And I think that's only going to continue as we look into 2024. And that's where you're seeing some of the euphoria with artificial intelligence is going away. People really want to see that actually reflected in earnings. And I think things are going to go back to fundamentals. And that's where you want to look at some of those value opportunities.
I mean, it's not like you've had, a ton of money coming out of mega caps and going into the Russell. I mean, it's been a pretty equal opportunity sell-off. I mean, the NASDAQ and the Russell both are down about the same on the week, each more than 3%. So what is that telling us?
And I don't think we want to too much extrapolate from this 1 week. I think really if you go back the last 2 months, I think that's actually going to show a stronger picture here. And some of that is you're going to get people are just taking profits across the board right now because it's kind of interesting. But the investor sentiment levels have been overly optimistic. Yet at the same time, and we're seeing this with our clients, people are still very cautious and they're keeping their cash on the sidelines. If you look at cash levels, the end of that last week of December, cash levels actually went up, meaning even though people they're optimistic with the markets, people think the interest rates are coming down, they're still keeping their money in cash. I mean, they're not actually ready to get in the markets. They're not actually believing that those money market rates are going to go down. And it's not necessarily what we're advising, but you're definitely seeing that right now.
But does that mean that, some of that next leg is going to be a bit muted because there's just not enough cash, new money coming in?
I would actually say that still leads to an opportunity because that money can still lead its way in. I think people aren't overly optimistic. They're not throwing all their money into the markets. You're not seeing that euphoria. I actually think that could lead to a further upward trend.
You sound like you're a believer in the idea, though, of that rotation being longer lasting. Money coming out of mega cap winners and going into other unloved areas or small caps or what have you. Absolutely.
And we're actively talking to our clients about right now because if you didn't rebalance your account so far, you're going to be overweight in technology in those 7 companies. And especially, I have a lot of people who say, oh, no, I've got an S&P 500 fund and a total market fund. I'm good. You have no idea that about 30% of that is those 7 companies. And if you haven't made a change in your portfolio, you're going to want to take some of those profits and add to other areas. I'm not getting out of the Magnificent 7. I just want to take some profits there and take some better opportunities.
What if it's a giant head fake, though? You know, I look at that ISM services today and I say that's the one thing that you cannot have deteriorate. This whole notion that, you know, even Janet Yellen, the Treasury Secretary today, said in an interview that we can describe what we're seeing now as a soft landing, and my hope is that it continues. But what if the economy continues to soften a bit more than it is now? Still stays out of recession, but continues to be a little bit weak. Doesn't that take some of the oomph off of those other more cyclical and small cap areas of the market?
Not necessarily, because we need the economy to soften to a certain extent so that interest rates do in fact come down, right? Expectations are there, but we need a softening for inflation to continue to come down. It's just we don't want to soften so much we go into recession, right? So it's that kind of that perfect scenario that we need to get into. And I think that's what you saw with the jobs numbers today. It was kind of bringing into reality the fact that, yes, the economy is softening, but we still have a really strong labor market. And I think when people are expecting those 6 to 7 rate cuts next year, they're probably getting a little overly optimistic. I think rates are probably still coming down, just maybe not as much as people had gotten excited about in the last 2 months, and it's probably going to be a little longer lasting.
I'm sorry to interrupt you there. I don't know many people, if any, that are expecting the kind of year that we just had to be backed up in terms of, you know, performance out of the S&P, 24% or whatever. But what's in your mind as to what seems realistic for the S&P? You know, mid single digits, high single digits, low teens? What sounds reasonable to you?
When you have a year like last year where the markets were up double digits like they were, you actually tend to have like a mid single digit year next year, but again, in the upwards direction. So I think odds are on your favor that we'll continue to have a positive year. We're going into an election year. I think things are actually, especially as interest rates come down, leading up well to that. So yeah, I don't know if it's going to be the same kind of outperformance last year, but specifically the companies who did outperform as much as they did, I don't think that's where the performance is going to come from. And that's what you need to be aware of.
But you think it's coming from the laggards, the healthcares, the
Small
energies.
caps,
We
yep.
mentioned small caps. Well, why healthcare and energy?
Both of those are actually going to be beneficiaries of, well, specifically healthcare is actually going to be a beneficiary of lower interest rates, right? I mean, you're going to see more M&A activity. You're going to see as they need to borrow more money, it's going to become more feasible for them. So I think you're going to see a lot of that as we go into 2024.
Yeah, what about energy? I mean, energy is a big wild card. You got a lot of people trying to get on that side of the boat saying, okay, you know, it had a great year a couple years ago. Last year was a total dud, and now's going to be the year yet again because supply demand is still out of balance. Well, what's your take?
Well, I think that's the big thing. It's just a supply and demand question, and I think that really still leads into our favor, energy, and specifically a lot of the energy companies back in 2020 when prices really went out of whack, they had to become so much more efficient. So kind of regardless of what's happening with energy prices, as long as they stay relatively in the range that they've been in, I think those companies are going to continue to, you know, show the good profits that people are hopeful
about. What do you feel like is riding on next week's CPI? You know, today you had these, as we wrote in the top, we have these gyrations in interest rates and also in the performance of the markets. You know, the jobs report comes out, wages and the jobs report are a bit stronger than expected, so yields start to tick up. Then the services report comes out, yields tick down, and now they're moving back up in the 10 years at 4.04. What's the area that you get concerned in?
I think we need to continue to see inflation coming down. That's the ultimate thing. And I don't think one number is necessarily going to affect things too negatively. It's not going to be this perfect straight downwards trend. But I think over time we need to continue to see those numbers come forward because ultimately the Fed has said over and over again they're data dependent. If the data doesn't support them pausing and lowering interest rates, you're not going to see that happen.
But I just wonder, you know, because the market was so uneasy it felt this week, you know, even though, as you said, 1 week doesn't a new story make necessarily, that a disappointing CPI is going to have maybe a larger impact because we're already kind of wondering, okay, maybe we were a little over our skis on the idea that they're going to cut 6 times.
And I think that's the big thing. The cutting 6, if not 7 times, depending on what you look at, that's the thing where I think probably people have gotten a little bit over their skis. And so any little bit of poor information, people are going to start to realize, okay, maybe it's not going to be that. The Fed's only said it's probably going to be 3 times. But bigger picture is I think likely interest rates are still coming down. But yes, you're right. I think some of that exuberance of the 6 to 7 times is probably going to come back.
Let's bring in CNBC contributor Stephanie Link of Hightower into the conversation. Steph, it's great to add you. So what's your big takeaway then from the way that this week has started and this year has started?
that the economic data is supporting the soft landing that all of us are talking about. I always worry that when we're all talking about the same thing, but you got to look at the numbers, Scott, and it's not just the job report today. I mean, look at ADP, look at Challenger Gray, look at initial claims, which is a leading indicator. That's at 207,000 4-week moving average, so far from a recession. But then I also look at durable goods, and I looked at factory orders, and those numbers came in better than expected, with business spending intentions going higher. So there are parts of the manufacturing part of the economy that are seeing a pickup because of the onshoring, the reshoring, all the infrastructure bills that have been put in place. So you kind of add it all up. The growth is there. Obviously, we all want to see the inflation numbers come down so that the Fed can cut, but it's not. It's still at 4.1%. It's still okay, but it's elevated. So that's why I don't think the Fed is going to cut 6 times this year. And if, by the way, they do, that means we have a massive decline and a turnaround to the downside in the economy. And I just don't see it at this moment in time. So the 3 takeaways, I think fewer cuts, I think better earnings, and I think the consumer has actually been really strong. And I'm really encouraged by Costco. And I know Costco is a beast in itself, but you had a 100 basis point acceleration, x the 1 extra day that they had this month from the first quarter, 100 basis points acceleration. And you had a 400 basis point acceleration in non-food purchases. That's discretionary. So my thinking is maybe services is coming down a little bit from the torrid pace that we've seen, but maybe that we've seen the bottom in the goods side of the economy and the goods buying in the economy. So let's keep an eye on it, but I'm pretty encouraged.
You start to worry at what point that the strong numbers that you always cite as a point of strength in the market story undercuts the cuts, and then the market has to reprice itself.
Well, I think that's what we're dealing with this week. I think 6 cuts got way ahead of themselves. I definitely do not think they're going in March. I think maybe they do 3. We'll have to see. I mean, we're all data dependent, including the Fed. So CPI number next week is huge, and PPI is pretty big as well. And then earnings, we'll listen to what the companies have to say and how they're dealing with all of these moving parts. But I do think whether the Fed cuts 3, 4, 5, 1, or 2, earnings are going to come in better than expected because demand is actually better than expected. And I really feel very strongly that the margin side is going to stay strong, especially because wages are coming down, input costs are coming down, supply chains are getting fixed.
You agree with that comment, Courtney, that earnings are going to come in better than expected that Steph just made?
I do, actually. And I think the idea that this earnings recession is ending and we're only going to see improvements from here, I think is really what we're looking forward to. I think she makes a really good point that the consumer is strong right now, right? Ultimately, we are a consumer-driven economy. And even if wages do start to come down, people are starting to spend into their savings that they've really built up during COVID. So maybe we do start to see a little bit of a slowdown. But as long as we have a tight labor market, people do have the means to spend, and we have a very confident consumer, and that likely is going to lead its way right into earnings.
Yeah, I mean, Steph, you like the same sectors in a sense that Court does, right? Healthcare, energy, maybe in some respects small caps too. But, here we are again with a lot of people talking about the very same places that they think are going to work this year.
I know, and that bothers me a little bit. We don't all want to be on the same side of the boat, but I really do believe that there's real value in these sectors. I mean, the valuations are tremendous. The free cash flow, let's just say healthcare and energy, let's just take those two. I mean, the free cash flows in both are substantial. The last 12 months in healthcare, we've had almost $400 billion in M&A, and it's gone practically unnoticed. And I think you're going to see a real step up in that activity in the healthcare space. But by the way, you're now all of a sudden starting to see it in energy, especially with the big guys, with Chevron and Oxy and Exxon. They're making acquisitions taking advantage of these really cheap valuations. So both sectors think their sectors are cheap and companies are cheap, and so do I. And so I think you can see real returns and a catch-up trade this year. I'm not giving up on tech, Scott, but I do think there's better value elsewhere, and it's encouraging.
Let's talk about a couple things. I wanted to ask you about this adding to energy and the fact that you used to be in Chevron, talked about it all the time, kind of got fed up and sold it, and now have bought Exxon. So give me that first, and then I want to go a little bit deeper on this mega cap tech conversation.
Yeah, no, I mean, look, Exxon, they've been executing a lot better over the last couple of years versus Chevron, and that's a reversal. And so it's a little frustrating with Chevron and the charge-offs and the write-downs that they have to take. They're not immune, I know, but they seem to be more frequent. And so I just didn't think that it paid to kind of wait. It's cheap for sure, but I like the better operator. Exxon has about $38 billion in free cash flow. I love the Pioneer acquisition. As opposed to Chevron, the acquisition that they made actually is more focused international, and I'm not as crazy about that. So, because I think the Permian deal for Exxon is really a good one, and they're going to be the #1 player there. So 5.7 times versus 7.9 times for its 10-year average with a good yield. So that's why I added to that one. But I'm now, by the way, 700 basis points overweight energy relative to the benchmark.
And you're underweight, things like Apple, even though you own it, which is where I want to segue to. So it's been an interesting week, to say the least. It's the worst performing mega cap tech. It's down 6% in 1 week. We rarely get downgrades on that stock. This week it got 2. Now you got the New York Times headline about regulators, looking at the possibility of an antitrust case, which on an intraday basis took that stock lower. And then for obvious reasons, it took the market down a bit with it. Big weighting out of the S&P, the Qs. It's accounted for 20% of the Qs move this week, too. So it has such a large influence on everything. And the Dow, too, of course. What happens if the market has an Apple problem?
There's a very good chance the market has an Apple problem. It's 7% of the S&P 500. And I don't know why anyone wants to pay 30 times for negative growth. I've said that to you many times, and I'm very small in it. And in fact, on Tuesday, we talked about I'm inclined to sell the rest of the 50 basis points that I have. There's other places to put your money. But yeah, okay. So let's say we have an Apple problem, and the market has an Apple problem because it's such a big weighting. And, oh, by the way, it's so over-owned and so loved. Well, guess what? That maybe the overall market doesn't do very well or does much in the first half of the year, but other stocks and other sectors will, because of what we just talked about in terms of where there are opportunities, where the valuations are really super cheap, where you're getting good shareholder returns and you're getting good dividends, and you have good stories, good free cash flow stories. So to me, maybe the market as a whole kind of just, trades around a little bit. But I think underneath the surface, you could be a good stock picker and sector allocator and offset the problems with Apple and maybe some of the other Meta stocks, some of the other FANG stocks.
Freudian slip. Meta's green.
Freudian slip, for sure.
Yeah. Amazon's green, Nvidia's green. So, and the Qs, by the way, are still green, albeit slightly. But what about this notion, Court, about, Apple being upset for a bit? What does that mean to the market here in the early part of the year?
It is a problem where it's such a large part of the market, and especially as indexing becomes so much more popular as an investment option. If Apple goes down, it's going to take a lot of that down with it. And that kind of goes to what I was saying, where you want to make sure you're taking profits from some of those things, adding to other areas, and not just throwing all your money in an S&P 500 fund. Because by doing that, I don't think a lot of people realize how much you are putting your money into Apple and Google and Microsoft and Amazon. If you are, look at an equal weight rather than the traditional S&P 500.
But see, that's why we bring it up, because there are a fair amount of people who invest that way, or at least it's part of their investment strategy. You own one of the index funds. And that's why we talk about the stock all the time, because the size of the weighting that it has, the influence it has, and why it matters so much if it goes through a period of some kind of upset. Remember, that stock was, 167, 169. Then it had this run in the upper 190s towards 200 as the overall market ripped from the end of October to the end of the year. If it goes through a period and some of these other mega caps can hold up, that's all good. Nothing to see here. If it's picked up by other areas.
To a certain extent, it's such a large section. I mean, the overall markets are going to feel that, right? And you're saying a lot of people invest that way in indexes. I agree. I actually think it's a great way to invest. I think a lot of people forget there's a lot more indexes than just the SP 500. You can look at the Russell 2000. You can look at your international companies. You can look at alternatives like real estate and energy. There's so many more things than just the S&P, which people think is the entire market. So it's not the only index you want to buy, and I think that's what we want to point out here.
Steph, what happens if there's no cut in March?
I think that that's what we're starting to price in, Scott. I really do.
No, I feel like we're pricing it back up. I mean, I'm sorry to interrupt you, but if you looked at the way that the market is now pricing March, it's when the jobs report came out at 8:30, it was stronger than expected. Okay, so the probabilities go down a little bit. Services comes out and it's like, oh, okay, well, now we're back up to what it was like 73, 74% around noontime today. But what happens if we don't get the March cut?
I mean, if we don't get the March cut, that means the growth is better. And actually that inflation is probably around the 3.5%, 4% level. That's why these CPI numbers are super important. But in today's jobs number, I mean, it implied that productivity is going to continue to go higher. Unit labor costs are coming down. And so that's very positive for inflation over the long haul. And if you look at the quit rates in the JOLTS numbers yesterday, I mean, that's a leading indicator. And the quit rates fell pretty substantially. And so that's a leading indicator for wages. And so I think we're going to see inflation come down, but growth remain elevated. But wages and inflation isn't going to come down enough for the Fed to really say, okay, we can actually go. I don't think it matters. I think as long as the growth can hang in there, earnings are going to hang in there. And that's what we need to pay attention to.
Let me ask you this. I'm looking at a journal headline right now that says Southwestern and Chesapeake near a $17 billion merger. It just speaks to, what may be in play this year. More M&A, more deal making. I mean, this obviously is straight out of the energy patch. But when I read you a headline like that, what's your reaction?
It's exactly what I expect. It's exactly what we've been seeing from some of the big companies. But these smaller companies see value in getting bigger and getting scale to compete with the big guys, right? So especially as the big guys are getting bigger. So I think the free cash flow, look, cash break evens at Chevron and Exxon is about $35 in oil. Where are we today? We're double that. So these companies are minting money. So I would much rather see them do M&A versus overproduce and also return the cash to shareholders, which is exactly what they're doing. These stocks are trading at 5, 6, 7 times earnings, which is nuts. So I like what I hear, and I think, look, I mean, the S&P 500 energy is about a 4% weight. No one is there. Even though a lot of people like it, I think there's more that can happen where we can see it be a larger contribution to the weighting overall.
Expect more deals?
Absolutely, yeah. If rates come down, we think they will. That's absolutely going to lead to more M&A, and that's going to affect energy. It's going to affect healthcare. All the things we're talking about, that's a big part of that.
All right, great stuff. Courtney, thanks.
Thanks
Good to
for
see you
having
again.
me.
Steph, thanks as well. We'll see you soon. That's
Thanks.
Courtney Garcia and Stephanie Link. Let's send it over now to Christina Partsinevelos for a look at the biggest names moving into the close. Christina.
Give me my rent. Shares of Medical Property Trust are plummeting today. The nation's largest hospital landlord stock dipped about, well, look at that, 29% right now after the company announced that one of its tenants, Steward Healthcare System, is $50 million behind in rent payments. Meanwhile, a quarterly profit beat is pushing Constellation Brands higher, although the wine and spirits distributor missed sales estimates and cut its fiscal year outlook. The company saw an 8% drop in wine sales amid a nearly 12% plunge in wine shipments. The company anticipates its wine segment will experience, quote, near-term headwinds. I guess customers weren't there or here for the right Riesling. Scott?
Very funny. We'll be back with you shortly. Christina Partsinevelos. We're just getting started here. Stocks struggling to start the year. The S&P is down just this week. Up next, we're going to hear from one of the biggest bulls on the street, Fundstrat's Tom Lee. Let's see what he makes the case for in the weeks ahead. We're back after this.
com.
We are back. Stocks off to a rocky start this year. The first week of trading, the S&P's been down about 2% or so. Joining me now to discuss what it could mean for the trajectory of the market this year, longtime bull, Fundstrat's Tom Lee. Happy New Year. Welcome back.
Happy New Year, Scott.
Are you wavering at all by virtue of what's gone on this week?
We're not wavering, but it's clearly not a good start to the year. I mean, markets almost got to an all-time high at the end of last year, and the first 4 trading days of this year have been really terrible. I mean, I can see what the market's struggling with because, as your guest previously talked about, part of it is when the Fed cuts, and I think people are still jumpy about a strong labor market and if inflation is softening. But our base case still remains that, we're going to see all-time highs in January, and then I think the market is tough in the first half of this year because of some of those things, but we'll overall end up strong by the end of the year.
But you're not rethinking your own outlook at all by, how, I mean, you obviously sound somewhat concerned by the way this year has started. Maybe it didn't go according to your plan. So how's that all factoring into your psyche?
Well, yeah, I mean, I think it is disappointing because, the year tends to play out in January. So the fact that we're, sort of had a failed Santa Claus rally in the first 5 days is pretty important, and the market looks like it's going to be negative. Just tells you that the fundamentals, which have been improving, aren't necessarily going to convince investors to be buying stocks. So I do think it's telling us it's going to be a tough year. But the reason we're not wavering is that the reasons we think 2024 will be a good year for stocks has to do with the fact that the PMIs are bottoming and inflation's falling like a rock, and the Fed has pivoted and is now managing a business cycle. I mean, those are really good anchors and supports for why stocks can do well, but, it's not a great start. I mean, it'd be much better if we were up for the week.
Yeah, well, I mean, bulls would feel better. What about this ISM services report? I mean, I know you talk about PMIs, but is that concerning to you?
Well, it's there's pluses and minuses. I mean, to me, I think the ISM services employment number and, the manufacturing number show you that the labor report we got today may not be as strong as it looks. And I think that's actually good because we don't want a labor market showing signs of rejuvenation. I think the trend there is sort of softer employment growth. And from a prices perspective, I think it's pretty supportive of what we've been seeing, which is, prices are falling. And as long as housing and cars don't surge, housing growing at 3% is fine. That's consistent with 2% inflation. I think inflation is going to eventually be viewed as, approaching target, and that's actually good. So, Scott, the data isn't always in a straight line. I think it's a little messy this week, and I think it is disappointing to see, but I think too many are going to be quickly turning bearish and then put on their hard landing or skeptic hat or the Fed hawk hat. And I think that's going to prove to be a mistake.
So you look for about 10% out of the S&P, but more or less is what you think we're going to do from here. How many cuts do you need to get that?
Well, it's not as dependent on cuts as it's dependent on really inflation approaching, what we'd all accept as close enough to 2%. So that the Fed is no longer fighting inflation. So it's not going to be as important as cuts as really sort of the quality of the inflation data. And I think the second is that, we do need to have a rebound in earnings and global growth, which I do think is underway. And, as you know, inflation is normalizing outside the U.S. And when you have that combination of inflation sort of normalizing and real growth recovery, I mean, that's good for stocks. So it's not dependent on the number of cuts.
Well, I don't know. I could almost make the argument that it's one and the same. I mean, if you get the number of cuts that the market has seemingly priced in, it means that inflation has continued to move down rapidly towards target. And if you don't, it likely means that inflation has gotten a little bit more sticky than the bulls had wanted it to be. So it impacts the ability and the wherewithal of the Fed to actually start cutting rates and doing it nearly as many times as the market still expects.
Yeah, I hear you. I think the problem people have is when they talk about cuts, they're assigning singular drivers for it. I heard someone say, well, if they make a lot of cuts, it's because the economy's in trouble. That's not the case. The Fed could be cutting rapidly because they've concluded that inflation is actually approaching normalization, and a nominal Fed funds at 5 3/8 or almost 5.5% of the upper end is not appropriate when you're at 2% inflation. I mean, that's 3% real Fed funds. At the same time, the Fed may not have to cut. The market could actually conclude this by seeing interest rates fall. So we could be in a situation this year where the 10-year is at 3.2%, and FOMC members may be wavering, but the stock market will rally because it knows the Fed is behind the curve and needs to cut. So I guess this is the reason why I'm saying the cuts aren't as important as really the quality of the inflation improvement. And maybe it's more important to see what rates actually do.
Before I let you go, I want to ask you about Apple. I know you're still bullish on mega caps, but you don't expect them to outperform to the magnitude that they did in 2023. This stock has obviously not looked good this week. It's down more than 6%, variety of reasons. And we listed them earlier: downgrades, chatter about antitrust, et cetera. If the stock goes through a period of upset, as I asked our prior two guests, I want to ask you the same question. What happens to stocks?
Well, it's, FANG, the destiny of S&P really does hang on FANG because it's such a large weight. I don't think FANGs are sell this year because, they actually derated over the last 2 years. Their earnings outperformed the stock price performance. But you are getting periods like this where, people get nervous. It's one reason why I do think the story in 2024 is going to be a lot more about small caps and sort of some of the laggard groups. Financials are our number one large cap sector pick. But I mean, if I owned Apple, I wouldn't be a seller here. Their franchise and sort of returns on investment are still enviable. So, if it's down 6% but was up 44% last year, I think people have to kind of look through that.
All right. We'll leave it there. Tom, I appreciate your time very much. We'll see you soon.
Thanks.
All right, Tom, that's Tom Lee, Fundstrat. Up next, trading biotech's bounce. That sector's seen some strength lately for a change. The XBI up more than 20% over the past 3 months. Hedge fund manager Michelle Ross joins us next with the top names she is watching right now. It's ahead of the big JP Morgan Healthcare Conference as well. We'll get you set up for that, too, when we come back on Closing Bell.
SPX.com.
Welcome back. Biotech under pressure today, but up more than 30% in just 2 months, bouncing off the lows set in late October. Group in focus at JP Morgan's annual healthcare conference, which is set to get underway in San Francisco next week. StemPoint Capital CIO and managing partner Michelle Ross with me here at Post 9 to discuss. Happy New Year. Nice to see you.
Happy New Year. Nice to see you as well.
All right. So is this bounce believable? Because it's been a rough stretch of 2 years plus.
Absolutely. And what we are seeing is clearly there was a macro tilt to this. We have inversely correlated from the 10-year. And as yields had gone up, we were under pressure. As they came down, biotech definitely made that move. But I really want to be clear, there are fundamentals that are at work here that are making this longer term in nature, in our opinion, and we actually believe we've seen the lows.
Tell us some of
last
the
year.
fundamentals that lead you to believe that.
Yeah, so obviously we're very focused on the science and the scientific advancement we've seen, the clinical trial data that could be a meaningful impact to patients and ultimately change the standard of care for a number of different conditions. And the second, the very big one, was M&A and is M&A. It's been something that is a key piece of our sector and had been kind of frosty and frozen there for a few years. And it was one of those effects. It was kind of slowly and then suddenly all at once it did show up in Q4 in a big way.
Thank you, Bristol Myers, right, which went on a spending spree.
Yep.
And you expect more of that. Does that ball really get rolling out at the healthcare conference out in San Francisco?
Well, it's a great question. And I think there is a little bit of a trepidation from my peers in the industry thinking that, did we just pull that forward? Did we pull forward some of these announcements? We had 6 deals in December. And as you mentioned, Bristol Myers doing 2, AbbVie doing 2. It was something that really could have been the expectation for that conference. So I don't want to say that by any means I'm making a statement on that conference and timing, but I would anticipate 2024 has more in store.
So what's your assessment of the weight loss craze? By now, the story's well known for the stocks that have been bought as a result. Novo, Lilly, and maybe 1 or 2 others. Is that played out? Does it still have legs? How am I supposed to think about that as an investor when all I've been hearing about is this class of drugs?
Yeah, I think it is a tremendous market opportunity. I think what Lilly and Novo have done in truly creating something that peak potential is in the hundreds of billions of dollars. I mean, that is staggering and something that, we do look at as what is going to happen in the evolution of this. Now, for us, and what I would state is there are going to be next generation and additional compounds that can truly allow this to grow to a larger degree, meaning taking this to an oral pill. That would be the next generation, or looking at ways to change the side effect profile or augment it to prevent some of the, side effects that people are seeing right now.
Are there other companies that I need to keep my eye on as a result of what you're talking about?
Yeah, I would say that one in particular that we focused on is a company called Keros. And Keros does look at the opportunity to prevent some of the salvage of muscle, so muscle wasting that people have commented on in the past. Could you look at this as something to augment, as well as a number of other companies looking at the oral aspects of being able to bring this as an oral product in the future?
You own this name?
We do.
You do. Other names that you brought that I don't think I've ever talked about before, maybe we have, and I just don't remember. Syndax is one?
Syndax.
What do they do?
Syndax had a wonderful year end in 2023, and that was on the back of 2 very important data sets that it presented at a medical conference in December. And the reason it's so important is these are late stage clinical trials that were successful. They are now with the FDA for approval, and they're both in the oncology indication. They're areas of unmet medical need. This will have a massive improvement for patients going forward, and we think the market is primed for them and what they're going to be able to do.
All right, we'll keep our eye on that one, ticking higher by about 2%. What about Cabaletta?
Yeah, Cabaletta, as a scientist by training, it really makes me excited what Cabaletta is working on and doing. They are looking at something called cell therapy, something we've been familiar with in the oncology, in the cancer setting. They're taking that now to the autoimmune setting. So very hard to treat conditions where the immune system is at the core, at the center of this. They are resetting the immune system and recharging our T cells in our body to basically have phenomenal results. Cabaletta is one of a handful of public companies doing this. Very exciting year ahead for them.
What about election year politics, which in a general election year is typically not good for
Yeah.
healthcare, because both sides are just teeing off on the drug companies. How should I think about that?
No, it is a very important point. We have typically looked at and seen different things happen going into an election year. It becomes a very bipartisan issue. The rhetoric does increase. I would say, though, there was a win that Biden can claim from this year, which was through the Inflation Reduction Act. He did put into place an attempt to lower drug pricing over the next few years. Now, that could be looked at as a win on his side and something that is not going to come out as what could continue to be done for this class going forward. So I think time will tell. It is obviously part of the volatility that we experience consistently looking at this space.
Last question, since we started talking about rates, why this sector really seemed to get jump-started as the 10-year went from 5 to 4. What happens if it's sticky here for a little bit? What does that mean?
The great thing about biotech investing is the amount of dispersion that you can find, and why I'm so excited to be able to talk to you about great advancements and new themes and new approaches. And we talked about this last time with the GLP-1 class working despite where the 10-year was going. So macro is a piece of this, but it is by no means the entire story here when investing in biotech.
All right, you'll keep us informed about the names we need to know. Thanks so much.
Thank you so much.
All right, it's Michelle Ross, StemPoint Capital, joining us. Up next, we're tracking the biggest movers as we head into this Friday close. Christina Partsinevelos standing by once again with that. Christina.
Well, Boeing shares no longer out of favor with Wall Street. And one analyst is arguing that the AI hype has yet to materialize, and that call is hitting one software name. Details next.
Looking again now to the early market on close imbalance, still sitting at 462 million to the buy side.
We are less than 15 minutes away from this Friday close on Wall Street. Let's get back to Christina Partsenevelos for a look at the key stocks she's watching. Christina?
Well, it's shares of software analytics firm Palantir Technology sliding almost 2% right now after the company was hit with a downgrade. Jefferies arguing that the AI hype is, quote, overblown, and the so-called AI boom has yet to materialize, which is why the analyst questions Palantir's valuation, but still likes the actual business and fundamentals. The stock is down close to, like I said, 2% today and down over 6% in the past week. Meanwhile, Boeing becoming a more popular pick as of late. Analysts at both UBS and Wells Fargo named it a top pick in aerospace and defense. The stock is up 1.5% today and actually had a big run up since October, bringing it to levels we saw back in early 2021, but still has a lot more work to do to get back to those pre-pandemic levels. Got it.
Have a good weekend.
You too.
We'll see you next week.
Well,
It's Christina. Oh, I think she was saying she has something coming up in the market zone, which she does. Who knew? Up next, it's been an ugly week for tech broadly. The XLK dropping more than 4%. It hasn't stopped the street, though, from showing this one chip name some love. All the details, what it might mean for the mega caps just ahead. Closing bell, including the market zone, coming up.
So looking now to the market on close, imbalance at 1 billion to the buy side.
All right, coming up next, we're breaking down Apple's rough week. There's the ugly chart. Lot of red. The stock falling more than 5% over the past few days, now facing another new headwind. We'll give you the details and much more when we take you inside the market zone.
So the SEC commissioner to vote on the exchange rule filings expected next week, and the Bitcoin ETF applicants.
We're now in the closing bell market zone. CNBC senior markets commentator Mike Santoli here to break down the crucial moments of this trading day. Steve Kovac joins us with new details on a possible antitrust lawsuit against Apple and its supplier Foxconn warning on guidance. Christina Partsinevelo's back, as you knew she would be, on why Wall Street is still bullish on NVIDIA. Mike, I begin with you, though. Looks like we're trying to make a run back to 4,700 here on the S&P before we close it out.
Yeah, it's been a little bit of a sticky number, a few days this year so far. Relatively, I guess, benign response to some conflicting data today. It still continues to look like this sort of low-energy, profit-taking / we already own enough of all these stocks type of reaction all week. Didn't really seem to have to reprice rate expectations too much. Most of the data, as much as they were a little bit noisy, confirm in general terms the soft landing thing. So I don't think we can argue all we want about what the market expects from the Fed, when they're going to get it, whether they're not going to get it. I don't think it matters that much. We stay clear of imminent recession and inflation doesn't flare up, and you could probably navigate that okay.
Well, Tuesday CPI,
yeah,
right?
Exactly.
So that's the big test.
It is, because there's a ton of conviction that inflation's still going in the right direction. Everyone's waiting for the lagged effect of shelter to really start to drag on those numbers. So yeah, it certainly matters. And again, you got this retracement of Treasury yields back up to 4%. Not a big deal at this point, but you don't want it to gather momentum.
So Steve Kovac, I mean, first the analysts come out against Apple this week, and now you got a headline talking about antitrust. And the stock's down about 6% on the week. It's the biggest loser out of the mega caps.
Yeah, what a year this week has been for Apple. And this antitrust report took it from green to red. It was up about, I don't know, 0.1% before this headline from the New York Times came out saying the DOJ is, quote, closer to that anticipated antitrust lawsuit against Apple. This is all regarding the ecosystem around Apple devices, the App Store, the fees, everything we keep talking about. We've been expecting this for years now. It was supposed to happen last year. It was supposed to happen in 2022. Maybe we're getting closer. We'll really start to get a sense of when this is going to drop there, Scott. Likely after the Google case wraps up with the DOJ, and maybe as soon as early this year. But let's also talk about Foxconn. That is, of course, the company that makes most of Apple's gadgets, based in Taiwan and with production in China. They said December quarter revenue was down 5%, and sales from electronics flat from slow demand, and guidance saying sales are going to be down for the March quarter. But those comps are going to be a little wonky because if you remember at the end of 22, a lot of COVID shutdowns throughout China caused Foxconn to close their factories. So a lot of things got pushed into the following quarter. But look, bad sign for Apple and consumer gadgets overall as far as demand goes, Scott.
All right, Steve, appreciate that. Yeah. That's Steve Kovac. Now to Christina Partsinevelos on why Wall Street is still bullish on NVIDIA, which I mentioned is still higher today by a couple of percentage points.
Yeah, it shows interest has not waned for NVIDIA. Bank of America reiterating as well for the company that predicting that actually NVIDIA could go on a buying spree since it'll have about $100 billion of incremental free cash flow over the next 2 years. The Bank of America analyst estimates that about $30 billion of that cash could go to buybacks, and then roughly $70 billion could go to, quote, new growth initiatives. So recall back in 2022, NVIDIA tried to buy ARM, and so clearly it didn't work out, but clearly it has an appetite for software and IP-driven assets, so that could be where it's buying. Or it can go hunting for storage companies to be a fully rounded AI systems vendor offering everything from A to Z. And then you have some bullish notes from Truist and Mizuho, both putting out the notes today. Mizuho thinks NVIDIA will stay on track with its product launches like new server AI GPUs, even with the new restrictions on AI chips to China. And then there's another note saying that NVIDIA will continue to lead the GPU market while increasingly winning over the developer community with software and services, which helps with market adoption of its products. So that cycle just keeps on going for NVIDIA. Stock, though, is still down on the week, about 1%, Scott.
All right, Christina, thank you. Christina Partsinevelos. So, Mike, I know you don't love the idea of as goes Apple, so goes the market. But how are we thinking about what's going on this week with that stock in particular and what it means?
Down almost 10% from the high. Obviously, the rest of the market is hanging in there a lot better. I was just looking back. There have been these stretches of time. It's not easy for the S&P to shrug off Apple or for Apple to be sidelined during a rally. But 2018 into 2019, the S&P went up 20%. Apple was flat point to point. It also happened in 2013, 14. So there have been these times when you're able to kind of set it aside. In terms of the way the market reacted to this news, it was interesting because the S&P took an immediate drop at 215 when the headline hit, but it was almost all due to Apple itself. It wasn't the rest of the market spilling out. So you can do without Apple leadership. I don't think that you can necessarily lose all of the mega caps, obviously, and still have the index hang together.
All right, we may not get 4,700. We're close. We're going to settle out right around there. Could be a few points below it. Nonetheless, looks like we made a nice little run here into the end. We'll see what next week brings. A lot on the tape, CPI, earnings, et cetera. I'll see you then. I look forward to that. Into OT with Morgan and John.
All the major indices in the green, just barely, unless you count the Russell. That's down. Everything down for the week. That's the scorecard on Wall Street, but winners stay late. Welcome to Closing Bell Overtime. I'm John Ford with Morgan Brennan.
It was a volatile day for the market as the major averages snap a 9-week winning streak. We started lower, we ended higher. Coming up, Moody's Analytics chief economist Mark Zandi on what the stronger than expected December jobs report could mean for the Fed and the economy.
Plus, Barclays co-head of investment banking, Taylor Wright, on which sectors could see the most M&A activity this year.
Well, let's get more on this rough start to the year for the market. Mike Santoli joins us now from the New York Stock Exchange. Mike, I mean, we just said it. It was a volatile day. We started lower. We ended higher. We had a hotter than expected jobs report. We had a softer than expected ISM services report. What to make of it all?
You know, Morgan, it seems as if the market was a bit apprehensive in terms of how to interpret the economic data, but it didn't stray too far from the premise that we have a slowing economy, but one that's not falling apart. There's still support of worker income growth. You still basically have the unemployment rate at 3.7. ISM services, can we shrug it off? Can it bounce back? That's a question right here. I don't think the market wants to see a lot more weakness. But at this point, after a 9-week, 16% rally in the S&P 500, you're backing off by 2%. The most kind of heavily favored stocks of 2023, the ones that had a lot of deferred profit taking, have led the way down. It just seems relatively orderly and routine at this point, even if we're still in a bit of moment of confusion about how to price what the Fed's going to do and what yields might do from here after they've leaked higher to about 4% on the 10-year.
Mike, I want to talk about Apple for a moment because in the 2 o'clock Eastern hour, right after the New York Times headline crossed about the DOJ going after Apple potentially over antitrust stuff, the major indices dipped, ended up in the green, but didn't recover. At least, the S&P, the NASDAQ didn't. All the ground that it had lost. This one's fascinating to me, not because it's a shock. We've known that the DOJ and some others have been after bigness. It's that Apple, of all of the big tech companies, to me, is nothing close to a monopoly. As a platform that's got less than 50% share. I mean, it doesn't have monopoly share in watches. You have to create a market that exists as Apple unto itself. Premium smartphones, or it has a monopoly in software on its own devices. Sure. In order to create something. Big tech has been such a big part of public markets for the last couple of years. This kind of assault, potentially, on them is market relevant.
It is. And, traditionally, and by that I mean over the last couple of decades, when you get one of these headlines, when regulators are said to be really looking into the competitive mode of one of these big companies and the stock reacts, it's tended to be a fade. In other words, you tend to want to bet against the idea that this is going to really be relevant for the long term in terms of the value of the company. That said, I do think that there's a relatively sweeping nature to this reported investigation. And even if Apple does not have absolute dominant market share, it has a massive market share. And if they are said to be excluding other apps that compete with their own products within that ecosystem, I think a case can be made. And I don't think the market, look, it was down a little, less than 1% on the day. It's down 10% from its high. You had fragile sentiment in Apple as it was. And I think there probably also was a sense out there of, oh, wait, maybe this is what the stock was partially telling us in its weakness recently, that there was this work underway. But I think you have to pay attention to it, along with the idea that maybe there's less urgency to the iPhone upgrade cycle, that maybe they've seen the peak of their own kind of brand dominance in certain areas. You know, no panic time, but it is something that I think you're going to have to filter into the valuation.
Yeah, and of course, this idea that maybe multiples were stretched, right?
Yeah.
I mean, and you talk about, it was just like a week, 2 weeks ago that you saw Apple testing that $200 level. I guess it was the middle of December, which was basically the same level it reached during the summer. It was an all-time high, so that was being watched as sort of a key technical factor on whether this was going to be a bullish breakout for Apple or whether we were going to see a pullback here. So perhaps some technical positioning as well as we start the year. And by the way, not just Apple.
That's right. Yeah, it's somewhat emblematic of what else has been going on in some of those other stocks. Now, Apple has underperformed some of the other ones, so you have to keep that in mind. It does not have the tailwind of just this organic top-line growth that's just there and you can rely on for a while. So that's been part of the struggle with that stock in particular.
All right, Mike. Thanks. We'll see you again in just a bit. Morgan, I think the question here with this Apple thing for me is, are we China? Or are we a country where the capitalist system sits on top of rule of law? Where if you want to create a law where bigness is bad when you tie ecosystems together, then create it. But to try to enforce a law that doesn't exist, or to try to, through the court system, create law, business can't sustain that in an unstable environment. And that to me is why you end up with these pockets of time where people are saying, well, is the Chinese market investable? Because, the government does something and stocks tank because we don't know what to expect. I get the comparison, although I think there's still like a very stark difference, and especially when we talk about rule of law between the U.S. and China and what that means from an investor standpoint. But to your point, I do think there is a ticking clock here because we are in an election year in terms of regulators who have been making the case, building the case for a number of years now to try and get those cases out there, what that looks like, how it goes through the court system, et cetera, time will tell. But the fact that it will go through a court system, assuming that this actually moves forward and a case is actually presented, I think is the big difference. There is a difference. Is it stark? That, to me, is the question. Well, let's get to our market panel. Joining us now is 248 Ventures Chief Strategist Lindsay Bell and Citi Global Chief Economist Nathan Sheets. Guys, happy Friday. Nathan, going back to the jobs report this morning, doesn't this take 6 cuts off the table or no? Is that what the market was in part trying to digest?
I think today's data overall were very much a mixed bag. Yeah, you got a bit of an upside surprise on the payrolls numbers, but it still paints a picture of a gradually slowing economy. Maybe a little bit of wage pressure that the Fed's going to want to keep its eyes on, but on balance, an easing labor market. And then that was reinforced by the services ISM, which was quite soft, probably influenced to some extent by seasonal adjustment issues. But if you entered the week thinking the Fed was going to cut in March, I think you can leave the week with that same view. My personal perspective is wait and see. I kind of expect them later in the year, maybe later in the second quarter, but nothing to really move the dial today or during the past week.
Lindsay, you think the Fed cuts in March and 6 cuts are even possible?
I don't see 6 cuts, but I think there's a lot of moving parts that you have to take into consideration. I think a March cut is really going to be predicated on what happens with inflation, and we get 3 inflation readings, the first of which comes next week before that March meeting. So I think there's a lot of data that we need to digest. The Fed needs to digest. They're going to continue to be data dependent before making any decisions. But I do think that the minutes that we got from the Fed this week from their December meeting show a Fed that is, while they believe rates may have peaked, they don't necessarily want, to me, they took the March cut off the table in those minutes. So Chair Powell was pretty dovish in the press conference after that December meeting, but these minutes were much more hawkish. And I think that's what investors grappled with all week, was mixed messages, even contracting messages from lots of different data points this week.
Yeah, which, by the way, the market has been wrong before. It's that old mantra in some ways, Nathan, of don't fight the Fed. The other piece of this puzzle, though, and certainly one that, there's skepticism surrounding, is the consensus estimates for 12% S&P 500 earnings growth this year. Is that too lofty?
Well, I never want to count U.S. corporates out, but by the same token, that is very rapid earnings growth in a macro environment that is likely to be lackluster. You know, it is consistent. What we're seeing is consistent with a soft landing, but that means slower nominal GDP growth. And I think that will take a bite out of the